All right, welcome back everybody to day 2 of the TraderLion annual conference. Super excited to have you guys today. We've got an amazing lineup of speakers, and yesterday was fantastic. We had over 25,000 traders tune in. Let's try to knock that out of the park today, and I'm pretty sure we can do it. As you guys know, this is part of 4 days of stellar presentations from market wizards, fund managers, trading psychology experts, and US investing champions. This is the best resource to learn how to trade, whatever your time frame is. So just a few speakers, from the conference, a small sampling. I literally couldn't fit all of our speakers on one page. Stan Weinstein, Linda Raschke, Dr. Brett Steenbarger, Ross Haber, Mark Minervini, Mark Ritchie II, Amit Rai, Oliver Kell, Marius Stamatudis, some fantastic speakers, and I had to admit a ton, but you'll see all of them over the course of these 4 days. So tune in. This is the right place to be if you want to improve as a trader. And before we dive in, I'm very curious right now. Let us know where you're tuning in from in the chat. I'd love to see kind of the wide variety of places. Yesterday was very international, and I want to see either the country or the state that you guys are all tuning in from. So let us know down below, actually in the chat right now. Let us know where you're tuning into the conference for, and kudos for tuning in. That means you're serious about improving your trading, which is, the best thing you can do. So let's go ahead and dive right in to today's lineup. So kicking us off will be Oliver Kell, the US investing champion of 2020, the record holder as well, discussing swing trading from entry to exit. Next up, we'll have Jared Tendler discussing correcting damage from high expectations and perfectionism. And then at 12 Eastern, we'll have Himanshu Sharma discussing visualizing relative strength with RRG charts. I know a lot of people are, I got asked this yesterday multiple times. How do you track rotation? It's a key question, and RRG charts are a great, way to do that very effectively. Then we'll have a lunch break at 1:30. Then at 2 p.m., we'll have Deepak Uppal, a top performer in the USIC both last year, and he's competing again this year in the Money Manager $1 million plus division and doing extremely well. And he'll be discussing risk management for consistent returns, an excellent presentation, and just a fantastic trader and educator. Moving on at 3:30, we'll have Jeff Holden of SMB Capital discussing strategies for winning in trading, providing kind of their perspective on things. Then at 5 p.m., we'll have Brian Feroldi discussing the business growth cycle and providing that investing perspective, which I think is valuable even for traders to learn. And then finally at 6:30, we have Stephen Goldstein discussing understanding and minimizing the performance gap in trading. So a great variety of topics today, and kicking things off amazingly with Oliver Kell, who I always learn from every single time I hear him speak. I'm sure you guys will enjoy every single one of these expert presenters. Moving on to how to get the most out of the experience. First, I would say please go ahead and subscribe to the TraderLion channel. We've got an amazing array of resources for you, not just this conference every year. We also do regular interviews with top traders. For instance, just next week, we'll be posting my recent interview with the current leader in the USIC, who's up 300%, as well as 700% on the year. And we go through in depth his strategies, his system, his entries, his exit, sample trades, winners and losers. We always make sure to show those as well, how they manage risk. And you don't want to miss that. And the way to do that is subscribe to the TraderLion channel. We've also got free webinars. We've got tutorials, key clips. You don't want to miss it. And it's 100% free. And we're shooting for 100,000 subscribers very, very soon. And you can help us get there if you're not already subscribed. So go ahead and do that. It's 100% free and would help us out immensely. Also right now, please go ahead and take the time to leave a like down below. That helps the YouTube algorithm know that this stream is valuable, and will push it to more traders to help them, improve their performance. So please go ahead and take just 1 second and leave a like down below. With that said, one more thing that I really want to emphasize is that along with this conference, we've created kind of a VIP class and reference over on the TraderLion site that you can sign up for using the VIP access by scanning this QR code right here. It just takes 1 single minute, and it's 100% free. And what that gets you is access to the slides, location to take notes, ask questions, and we'll be kind of adding more resources there. And not only do you get the slides and other resources, you also get entered into special giveaways for, amazing things such as Mark Minervini signed copies of his books. Other authors are also contributing. So if you want to be entered into those giveaways, go ahead and sign up for the VIP access. It's very easy to do and it's 100% free. Also, as many of you guys did yesterday, go ahead and engage in the chat with others and with the speakers on Twitter. Share notes, key takeaways. We'd love to see that. Tag me, tag TraderLion. We'll go ahead and retweet it. And thank you for sharing those notes. And then also, a great part of this being live streamed is that anytime you can go back and rewatch your favorite presentations. We've already got timestamps on yesterday's presentations. Even now, you can kind of scroll back in time and rewatch today's live stream. If you want to hear me give the spiel one more time, you can go ahead and do that. But at any time, you can go ahead and rewind. If you need to, go to the bathroom, get a drink of water, whatever, no problem. You can, pick up right where you left off. And it's easy as scrolling back on YouTube. So that's a great benefit of this being an online conference. Moving on, this is very, very, very valuable to us. We put a lot of work into this conference every single year, and it's 100% free. So we do have one small ask from you, and that is to help kind of spread the word. Let friends know about it. Let other traders that know about it. Tweet it out on Twitter. We've got a specific link right here in the chat that's being put in right now that you can click and basically share the link to the conference. And we'd really appreciate you guys helping us accomplish our goal of spreading sound, risk-focused trading strategy. So please go ahead and do that. Just takes a quick moment. And again, it's our ask for giving you guys this resource. And we really would appreciate it if you go ahead and do that. Also, I wanted to include this slide because I said it yesterday and I still was asked in the chat, will this be recorded? Yes, it is. Because it's a live stream, as I mentioned, you can actually scroll back in time at any point, and the recording is available right at the same URL. So you can always access this right here, and we'll be posting each individual presentation on their own throughout the next few months. So you can take you can look out for those as well to get a nice reminder, refresher on those presentations. So you can rewatch your favorite ones as many times as you want. If anybody asked in the chat today, please let them know kindly that yes, it is being recorded, just like I did to you guys right here. Also, one other great benefit of signing up for VIP access is that not only do you get access to the conference resource, but we have many other free resources over on TraderLion University that you get automatic access to, such as model books, Price Cycle Mastery with Oliver Kell, where basically he teaches you his price cycle system, an amazing resource, a great framework that you can use to interpret price action on any time frame and identify strong buy points and sell points. If you're curious about that, this is an amazing resource. It's 100% free through TraderLion University. We've also got the 2023 Annual Trading Conference resource, the TraderLion podcast resource, which we're splitting up into seasons, where we'll include additional information, slides, show notes, that type of thing. You can check that out. And then also we've got the Ultimate Trading Guide, which is kind of an amazing free course that kind of builds your foundation as a trader, how to read price action, how to think about risk, entry points, edges, all of that's covered right there. And it's a great kind of refresher for people who are more experienced. But if you've got friends that are looking to just start their journeys, this is a great resource to point them to as well. And to sign up, as I mentioned, you can go through VIP and just go to available courses right there, that tab, and it's 100% free. You can just enroll, or you can enroll directly right here by scanning this QR code. It's very easy and just takes a few seconds. So I recommend all these resources. It's a great way to study the best winners, learn the blueprint for trading success through these free resources. And then once you're ready to kind of take the next step and move on to kind of some graduate level courses, we have fantastic masterclasses from fantastic top traders and educators. Stan Weinstein, market legend, Oliver Kell, the U.S. investing champion of 2020 and record holder, the amazing Lifecycle Trade crew who really teach their full trading methodologies in this IPO masterclass, as well as how to find and identify the next Tesla. That's a great thing to know how to do. Then we've got the unique trading psychology masterclass with Jared Tendler, a fantastic teacher that you'll see him in just a minute later on today. And this is an amazing resource that allows you to kind of master yourself and kind of enhance any trading style that you have, whether you're a day trader all the way up to an investor. And then finally, last but not least, we've got John Boyg's Historical Analysis Masterclass, an amazing guide through the ages, market cycles, what caused them, what they look like on the charts, how to avoid the bear markets, how to, get on the new uptrends. He goes through the market wizards, how they performed over the years, what stocks they bought, where they bought them. And then we go through the monster stocks, studying the top, winning stocks themselves, how you could have bought them, identified them early, jumped on their trends and rode them, and made massive gains. So an amazing resource. You don't want to miss the Historical Analysis Masterclass. If you're kind of looking for your first one here, I'd recommend either the Swing Trading Masterclass with Oliver or the Stage Analysis Masterclass with Stan. Those are kind of more foundational, but any of these is a great place to start. And if you're just thinking about one, you don't know which to choose, go with the Swing Trading Masterclass. I think that's a great place to build your foundation. So with that said, I also want to thank our sponsors who have basically helped us increase the reach of this event, both DeepView and StockTwits. Many of you guys are familiar with DeepView. This is the all-in-one trading tool that we're building. The same team that's behind TraderLion is behind DeepView, and we're working every single day to basically create our ideal trading tool. Screening, watch list management, risk management, alerts, everything all in one. That's our number one goal. So you're not going over here for fundamentals. You're not going over here for technicals. Everything, talks to each other, is under one house, and, at a great price as well. If you're interested at all in DeepView, especially if you're part of a kind of legacy platform that doesn't really invest in new features, this is the perfect place and time to go ahead and check out DeepView, see what we've got to offer, which is a ton. We've got a special 2 months for $39 deal. Just visit deepview.com and you can check that out. And if you're someone who's tried DeepView before, go ahead and re-sign up using that special deal. We've got a lot of new features, a lot of new kind of modules and apps in the dashboard module specifically that you don't want to miss and can really help your trading and identify those leading stocks that much faster. That's our goal. So definitely check out DeepView. And with that, one more thing is, it's amazing that we can, bring this resource and create this, and our presenters are fantastic. And in addition to, creating this conference, we also get to do it for a great cause, which is St. Jude's Children's Research Hospital. We raised over 2.5K yesterday, which is amazing. I hope we can blow that out of the water today. Even $1 is great. So you can donate using the button that's right below the chat. If you kind of just scroll down a little bit, just click that. It just takes a few seconds. And $1 is fantastic. If you find value in the conference, pay it forward, donate $1. That'd be great. And if you donate 5, 10, you are awesome. Tag me on Twitter. Let me know. I'll thank you personally. Retweet it as well. And if you do 20 and 50, that's even better. And thank you so much. So hopefully we can blow out yesterday's donations out of the water. And again, it's for a great cause. And if you're enjoying the conference, learning stuff, getting golden nuggets, pay it forward. This conference is completely free, and this is a great way to thank us and thank the presenters as well. Lastly, just one more call to go ahead and subscribe to the TraderLion channel. As I mentioned, we've got the TraderLion podcast, tutorials, free webinars, key clips. This is the go-to place on YouTube if you're serious about trading and want to learn from top traders and learn their methodologies and strategies. So go ahead and subscribe. It's 100% free, and help us go ahead and reach that 100K mark. That's what we're shooting for this weekend. And finally, with all that said, thank you guys for bearing with me. And I hope sincerely you guys get a lot out of today. We've got an amazing lineup that will give some fantastic presentations. So take good notes. Hopefully you guys really enjoy it. Let us know in the chat your favorite moments, your favorite speakers. And we look forward to watching today with you. So we'll be right back with the first presenter, Oliver Kell. Take care. Okay, welcome everybody to day two of the 2024 TraderLion Conference. Super excited to be kicking things off with Oliver Kell. You all know him as the U.S. Investing Champion of 2020, also the record holder, and he's someone who I've learned an immense amount about trading. I've really adopted his price cycle into how I interpret charts personally, and I hope you guys all find his presentation today extremely valuable. But we'll be talking about swing trading from entry to exit, kind of building from the essentials, the foundation, all the way up to the more advanced tactics. Oliver, thank you so much for being a part of this. Really looking forward to your presentation. And yeah, it's great to have you back at the conference.
Sure. Yeah, thanks for having me.
Of course. Let's dive right in. So, as I mentioned, swing trading from entry to exit. And just a quick disclaimer here. And then, Oliver, I'll kind of hand it over to you to discuss what we'll be touching on today.
Sure. So I mean today is I think it's like 45 minutes or something. So it's basically going to be, what I view as like from the high level, all you need to really swing trade, right? And then I'm a big believer that, as you go about learning how to trade, you're going to pull bits and pieces from different people, adopt what you like, throw out what you don't. But I think this can give you a good overview, kind of at least on what I try to accomplish. And if it helps you, great, and add to it and make it your own. But so the general agenda, so stock selection, I'm going to go through, pretty quickly, the types of stocks that I try to trade. Then I'm going to go through my, price cycle, and then the three different time frames that I really use. I do use some other time frames, but this is really all I need, the weekly, daily, and the 65-minute time frame. Then position sizing and just some key takeaways and reminders. All right, so we're going to jump right in. So stock selection. So, there's fundamental and technical characteristics as to the types of stocks that I like to trade. So I'm generally looking to trade liquid, high priced, and high beta stocks. So for a couple of different reasons, liquid, you just get less slippage, and as you grow your account and scale, hopefully you don't have to change anything you're doing. I don't think anybody listening to this is probably going to run so much money that they can't trade, the most liquid stocks that the US stock markets have to offer. And then high priced, because I think the risk reward is better on high priced stocks. So for example, if I'm trading a $500 stock with like a $10 stop, that's 2%. Whereas, if I'm trading a $20 stop, I know some people try to trade some of these $20 stocks with like 10-cent stops, but I find a lot of the times you need at least like a 50 or 60-cent stop anyway. Or sometimes even like a dollar. So you're risking like 5%. Now they can be much higher beta. They can make quicker moves. But I just kind of view it like the risk I have to take on a high price stock is lower, and the gains, kind of take care of themselves. And then high beta, I typically want to trade faster moving stocks. I don't hold a ton of stocks, typically 5 to 10 stocks. So I want to try to get, names that are moving when I buy them, rather than something that's trading at the same speed as, the index ETF. I want something that's hopefully moving, 2 times that. So those are kind of the three just, basic high level characteristics. I say I like to trade stocks over $20, ideally over 50. But a lot of the time I'm trading stocks that are over $100 a share. I mean, that's not like a hard rule or anything. If I find a stock I think is interesting, that's, a 25 or $30 stock, I'll trade it. But oftentimes, 3 to 5 names make up a lot of my gains on the year, with 1 to 2 names being the majority of that. And a lot of the times those are $500,000 stocks. So probably the last 3 or 4 years, those stocks have basically been Tesla, in like 2020, 2021, and then Nvidia in like 2023, 2024. And, they were both, triple digit quadruple digit stocks. Then strong institutional support and high dollar volume. So strong institutional support, high dollar volume, the next question that often comes is, how do you, what are you looking for? Like, which mutual funds do you want to see owning your stocks? And that's not really what I mean. Is what I really mean by this is that, the way that they trade, they're not like whipping all over the place. They don't just like downtick, like 5% on the open for no reason on no volume and then come back. This is another way of saying, they have liquidity. They have people involved in the stocks. They're stable. I find that kind of institutionally supported stocks kind of hold their patterns better. They hold, what I consider to be proper support better, which just makes them easier to kind of size up and, trade. Now, there's downsides to that as well. Sometimes they don't move as quick when you're right. So, there's trade-offs, but those are the types of stocks that I'm most comfortable trading and that I tend to gravitate towards. High dollar volume. Now, this is going to be different for everybody. Let's say you're trying to buy like a $100,000 position or something. Like I sort of feel like at a minimum, like an absolute minimum, you want to be trading like a $20 million a day dollar volume. Now for me, I would say the majority of the stocks that I'm trading, if I have to look up the dollar volume, like I'm probably not trading it. A lot of the stocks that I trade are trading like billions of dollars a day, and I can clip off, at least for me, what I consider to be a pretty significant position, and no one even really knows I'm there. I start getting down into the names that trade like $50 million a day. I sort of find there's just a lot of slippage, no matter what I'm executing. And then next, and probably maybe most importantly, is that you want them to have a big weekly base. So if a stock is extended on the weekly time frame, it may like break out on a daily chart pattern or something, but it's probably not going to have an extended move. Whereas if it has a weekly base and it's kind of turning on the daily and it's starting its move on the daily time frame, you've got a chance for it to be, maybe like a 4 to 10 week, sometimes even multi-month, move. And that's really kind of my sweet spot. Is I'm typically looking for multi-week, 4 to 10 week kind of earnings cycle type moves. And then the name might reset, and I'll probably, a lot of the time I trade the same name over and over again. But I might get in it, when it sets up again. But typically I'm looking for that, kind of 4 to 10, 12 week type trade. And then I kind of hop off and just let it set up again, even if I buy it back sometimes even at a higher price, I don't really care. That's just kind of my personality. So I'm looking for that window, and to get a move of that length, you need a weekly base, minimum 5 to 8 weeks. And the old saying is the bigger in base, the higher in space. So the bigger the base, the better.
Yeah, and just to touch on something that you've mentioned a few times, but Oliver, I know you like to kind of go back to that same core group of names as long as they're working, as long as the theme is in vogue. So, an
Sure.
SQ when that's in vogue, you might go to that. But you kind of go back to that same list of not too many stocks and really focus on those. You know how they trade. You've learned
Yeah.
their patterns, and that kind of is an edge for you that you're so focused on that group of stocks.
Yeah, so like, look, I do, I run quote unquote, scans. Like I scan for volume every night. I look for huge volume. And that's kind of part of my process. It really takes me like 3 to 5 minutes each day. And for all the names I uncover doing that, if I can catch maybe 1 or 2 names a year out of the hundreds that I might write down, that's sort of how it plays out. For example, uh,
SMCI.
this year, SMCI, I found SMCI like $68. I took one trade in it then on a bull snort, it ran, and then I kind of just didn't think anything of it. And then I was looking, and throughout all of 2022, it kept going up. And then I kind of really caught a big trade in it, earlier this year. Or I guess in, must have been like April to July of 2023, and then this year. But really a lot of the other names that I scanned for in there and wrote down, I didn't trade. I tend, kind of like I said, I tend to make, most of my money in like 3 to 5 stocks. So this year that's been like Nvidia, SMCI, Kava, AMD, more at the beginning of the year. What else is in there? Um,
Crowd.
Coin. Coin's been good. Crowd's been good for me. Those have
Yeah.
kind of been my kind of go-to names the last, really kind of since this move really started in October. Those 6 names have kind of been my key names. And then I've traded other names outside of that, but I would be willing to bet that they've all kind of evened out and I've made all my money in those key names, and a lot of it in Nvidia in particular.
Yeah.
Um, all right, so fundamental characteristics. So like, I recommend reading How to Make Money in Stocks. You know, there's no secret sauce that I can provide to you. I'm not trying to reinvent the wheel here. That book is a study of the biggest winners in history. Like, he's done the work for you and put it out there. So go read that book. But typically, Juan's whole thing was 25% minimum quarterly earnings and sales growth, for 3 quarters. He had other things like 17% ROE and things like that. I personally prefer 40%, triple digits, and the bigger the better. If you can get triple digits, or sorry, 40% earnings and sales, triple digits is best. And I really care about revenue growth. So another book that I'd recommend reading is Trade Like an O'Neill Disciple, Chris Catcher and Gil Morales. They wrote that book. They talk a lot about revenue growth in that book. And I think with a lot of these kind of internet type companies, or more modern tech, or whatever you want to
Growth at
call
all costs.
it, yeah, revenue growth is very important. It's even more important when rates are not rising. But so revenue growth is especially important. And then the key is that it's accelerating. So if you have a lot of stocks that I do very well in actually tend to have high PEs, but they also have massive growth, accelerating growth. Once you kind of have high PE and that growth starts to decelerate, that's kind of when you want to watch your back. So that's just something to kind of keep in mind there. And then a theme, what's in play. So, when Tesla was in play, that was like the EV theme. And like, Tesla was my go-to name, but there were plenty of other names that did well. A lot of the Chinese EVs, I personally did reasonably well in NIO. But Tesla was the leader. And so I like to trade the leader. With this whole AI theme, there's been a couple different names, but Nvidia has been the leading name of that theme. In crypto, I know there's these names like Mara and Riot that are high flyers. They crush it. But for me, coin is kind of that like liquid name that I can take a really big position in. And, therefore for me, that's kind of like the leader. Cyber, I feel like is like an obvious theme. And for me, crowd's kind of been the name there, but there's been other names that, Palo Alto Networks has been a really good name, and it's best when multiple names are running. It's not that common when you just have one name go. However, I will say that kind of the biggest and baddest names are often like, Tesla, yeah, there's an EV theme, but Tesla was its own beast. And really, even with the whole AI thing, there were plenty of semiconductors and things that were going absolutely nowhere. Well, NVIDIA had moved, 200%, and then, kind of other stocks started to participate. But so I'm looking for big themes like, the utility sector. Really, I actually never really made that much money in it, but That was obviously a great theme, maybe the last 6 to 9 months with the whole power thing for AI. So there's like the core theme, AI, and then there's these kind of tertiary themes, that work into it. But you want to try to identify what's in play, and try to focus there. So like right now, we're seeing this huge rotation, you know, you could say it's small caps because the Russell's moving, but to me, it's really interest rate sensitive, right? You got your home builders, your financials, those are the areas that are moving. And if you can identify that before they move, that's really where you want to try to allocate your money, when they're set up.
And to identify that theme as it's building, you're looking for the setups, right? You're seeing what's setting up, what's breaking out on big volume, bull snorts, all that coming together, right?
So yeah, I mean, you're looking to identify volume. I mean, really is what I'm doing is I'm typically trading like growth names. Um, But you want to have your head on a swivel as well. If there's some underlying force that's, at play in the market, you want to pay attention to that. I think with this kind of small cap situation or interest rate sense, that's kind of what's at play there. I don't think Bank of America all of a sudden became some breaking bank. Like there's some underlying force at work, in the market. So it's a combination of both.
Yep. Yep.
Um, and I personally think that, some of these growth names that are very, they have a bright future and they've got the growth numbers and stuff that they've been doing well. And maybe they've, really for some of them, I haven't seen massive rotation necessarily out of them. They've just kind of paused. I think the market will probably come back and buy up the best names, you know, in those spaces that have that growth. So, I think you want to find the good sectors with the big earnings and sales. And at the same time, kind of pay attention to what's, happening under the hood.
Yep.
So, like I said, I break things down into the weekly, the daily, and the 65 minute. But at the root of all of it, and this works on every time frame. I mean, at the end of the day, this is like the 10-20 EMA. I kind of built this nomenclature for myself that helps me kind of identify where we are, as far as whether we're near the beginning of the move or if we're getting a little more extended in the move. But basically, when a stock tops out, it's typically, extended from the 10-week and the 10-day, and it's got what I call an exhaustion extension. It's had a big move and it's just kind of stretches into the stratosphere. There's typically big volume at turning points. So there's typically like a lot of volume here, a lot of chasing. Everybody's obsessed with the name. There's usually somebody very loudly talking about how it's going to the moon or something like that. And then it's like the air's let out of the balloon and it just comes back in quickly. And it's like an exhaustion. It's like everybody who's going to buy that stock, they bought it and there's nobody left. Stocks top when there's nobody left to buy, and they bottom when there's nobody left to sell. So there's an exhaustion. Typically, the stock will come back into the 20-period moving average. It could just be the 10-period moving average. And then it will kind of wedge up. It could happen over the course of a couple of weeks, or in some cases, maybe just a couple of days, if it really kind of popped. And then it'll have what I call a wedge drop. And a wedge drop is, in reality, is what it is if you took all the moving averages away. Because at the end of the day, even though I have the moving averages here, they're just kind of like a guide. We're really trading the price bars. So think of an exhaustion, wedge up, just kind of has no power, no volume. And really it's setting a lower high, and then it breaks down off that lower high and it starts a downtrend, because now you have a lower high and a lower low. When it takes out that retest of the moving averages, it drops the moving averages, and then it has what I call an EMA crossback. What's an EMA crossback? Stock moves down, it has its expansion to the downside. So that's really all I'm doing is playing expansions, and then it kind of contracts, it wedges back up into the moving average, and then the sellers come back after it and they sell it back down, and then, we have what I call a basin break, which same deal. It's just like a consolidation. And then the sellers come back in, they sell it down. But now the opposite of the exhaustion is just, you've got this fear, everybody's selling out of it. The guy who said it was going to the moon at the top and wouldn't admit he was wrong, now he's kind of walking on eggshells, and they capitulate. So I call it a reversal extension, but it's really just a capitulation extension to the downside. And why is it capitulation? Because everybody who was there who wanted to sell the stock, they hit out. And maybe you get some undisciplined shorts who say, oh, I should have shorted this up higher when I knew it was a short. I'm going to do it now. I used to trade for big hedge funds. That happens a lot of the time. And then is what ends up happening is the opposite of an exhaustion extension. It kind of reverts, a reversal, it reverses back, and it comes up into the moving averages. Typically the 20 EMA. There's a lot of volatility. It might get rejected from the 20 EMA and look like it's going to turn into a bear flag. A lot of the time, that's actually when I get bearish, is right around then when it's going to put in its higher low. But then it kind of contracts its vol and it tightens up a little bit, and it builds. What does it build? It builds a higher low. Right? So stocks top out when they have a lower high, and they bottom out when they have a higher low. That volatility contracts, and then you have what I call a wedge pop, which is just like a move back up through the moving averages. But again, it's just like we built a higher low, and now we're going to turn the trend back up. We expand higher, we contract via some tight sideways action. It supports at the moving averages, but really it's like supporting at the moving averages. Just know it's building its next higher low. And it just so happens a lot of the time, not all the time, but these moving averages, they do a pretty good job of tracking those higher lows. And then we expand higher, and hopefully we have an explosion higher, and then we build a new kind of maybe 2 to 3 week base or so, a base and break. We break higher, a real good trend, an intermediate term trend, something in the kind of 4 to 10 week range, will hopefully have like 2 base and breaks. And then you kind of do it all over again. The euphoria sets in, the stock goes parabolic, and it kind of bursts. And so typically you want to try to do your buying around the wedge pop, which is the ideal buy area, or around the EMA crossback, that kind of first higher low. The reason being for that is that the time period between the reversal extension and the wedge pop, there's typically a lot of volatility. And so there are times where I've picked the low in the stock, the reversal extension, I knew it was capitulation, and it ripped up, and I did really well, and I should have just taken my profit, because then it started to set up like a bear flag. And it looked like it wanted to break, and I would get scared and sell, and I'd make maybe 30% of what I should have made. But then all it does is kind of put in that higher low, contract. And then when it has a wedge pop is when you kind of get that more trending type move versus that huge reversion, tons of vol. So we want to try to trade the low volatile, kind of trending part of the move, and then kind of step aside at the major turning points. And so another key here is you want to try to identify stocks that are in their weekly upcycle, which can last years. You could have an 18-month upcycle. And then when you have a daily down cycle within a weekly upcycle, meaning you're below the 10-20 day moving averages, but you're still above the 10-20 week moving averages, a lot of the time that down cycle will be very compressed and choppy. It won't be like a massive move down. It'll just be a stock that got too extended and needed to kind of reset up, rebase, get back into the 10-20 week, or the 50-day. The 50-day about lines up with the 10-week. And then you want to try to get on to situations where both cycles are aligned. And is what I mean by that is we're in a weekly upcycle. We want to try to play the daily upcycle and then get out of the way for the daily down cycle, because it can just be choppy, not massive gains. Now, if you're really good, like I know some people are really good at shorting those exhaustions. It's not my number one thing. I'm pretty good at selling them, but I'm not the best at shorting them. That can be actually a really, really kind of quick trade, but then the actual move back down can kind of, it's just like you're better look, if you're good at it and you're good at, kind of fading the weekly move, then have at it. But I find it's best to align the weekly and the daily. I'll just kind of leave it at that. But that is what I'm, trying to do, at the core of it all. And the way I go about that is by combining the weekly, daily, and 65-minute chart.
And the down cycle part of this can be a lot more compressed, a lot shorter than the up cycle, even though in this diagram for educational purposes they kind of look the same length and in time and distance.
Exactly. So like, for example, like let's say we're in a weekly upcycle and we have a stock that it rips like 50, 60% in 3 months, and then it has a daily down cycle. It might pull back 20%, with the first 5 or 6% being the exhaustion and the last 5 or 6% being the capitulation, and the 10% being the 3 to 4 weeks in between, where it just kind of has a couple bad days, some big up days, just a lot of volatility, but it really doesn't come down that much in that time period. But it's basically, it's given back 20 to 30% of the expansion higher you just had in the previous upcycle. And then when it sets up again, it may have another huge expansion of, maybe 50, 60% if you're lucky, in really great situations, maybe 100%. So basically when you align timeframes, when you align the daily with the weekly, and the daily cycle that's aligned with the weekly is likely going to have a bit greater move than the counter cycle to the weekly. And then just typically in general, I think everybody knows this, it's harder to catch a huge move to the downside, because you can only make 100% if it goes to zero. Whereas, I try to trade stocks that aren't going to zero. Yeah. But yeah, you want to definitely try to align the weekly and the daily.
Yeah, and speaking of time frames, actually, we've got the price cycle example with Tesla, which is like a classic version of it. So I'll let you walk through it, Oliver.
Yeah, so like Tesla's, I mean, up, I would say, until Nvidia, at least for me, was like the greatest stock ever. And this is, this is 2019. So we had a massive move into a blow off top at point A. And so you can, if I went through the whole move, I could kind of point out the different setups in the cycle. But basically at point A is an exhaustion extension. If you look at the bottom, there's massive volume. It's just ridiculously extended from the 10-day. It's also extended from the 10-week. And, that's an exhaustion. So you want to sell into that. And sure enough, it just completely falls apart and it comes back into the 10-day in this instance. It's so extended that move down to the 10-day, was pretty significant. And then is what happens is it actually finds support at the 10-day. I mean, you could even argue that 6 or 7 days later, it actually set up again. I can tell you for a fact that I actually bought that. But then is what happened is it wedged up and it put in a lower high. And then at point B, it kind of fell apart. And to me, this is a very unique situation in that it got so extended that when you were losing the 10-day, that was actually like the wedge drop. Whereas oftentimes it's not quite this extended, and it'll wedge up and the 20-day will be there and you'll actually lose the 20-day. But it's the same concept. If you took away the moving averages are there, as I call them, filters, or you could view them as guardrails. They kind of let you know where you are. But at the end of the day, at point B, we confirm a lower high. And we fall apart, we come back down into the 50-day, where we then bounce up to point C, which this is the crossback to me. And if you could see the move in Tesla, it was a multi-month move. And really this whole move, obviously COVID was a significant sell-off or whatever, but it was actually pretty quick. It was like, 3 or 4 weeks. But point C is the crossback. We come back down, and then, those 3 little bars there, right there, Richard, that's actually like the base and break. We trade down through there. And then kind of one of the keys to the reversal extension is you're oversold into a higher time frame level. So in this instance at point D, this was actually a back test of a massive weekly base on Tesla, and the 200-day was there. And that was actually the reversal extension, where we snapped back up to the 20-day, which is the blue moving average. And it's a huge rip. But then notice how we kind of like stall there. We resist, probably on day 6 there, when we kind of break back down. If you're like me, like you probably were thinking, oh, this thing's going to roll back over and test the 200-day again. But then is what ends up happening. It kind of has the gap up. It doesn't fill that gap. It then, I guess that's not technically an inside bar, but it sort of is in concept at point E. And then we take out the 20-day, and that's the wedge pop, where we basically, what happens at point E, we put in a higher low. That's all it is. And then we expand higher. We have this pretty significant expansion. The prices on Tesla at this point, I can't even see them, but I think we went from like 100 to $130 in like 4 bars or something, if I'm seeing that right. That's a pretty good 4-day stretch right there. And then is what ended up happening in this instance at point F is that big gap up that led to the 2 red down bars was earnings. So we had earnings and we tested the 20-day, and we held the 20-day. Now I do position a little bit around earnings, where I might reduce a little around earnings and then look for an opportunity to buy back, which sometimes situations like this are great for me because I've reduced a little, and then you just kind of see if the 20-day supports it, and if it does, you add back. But then at point G, this is what I would consider to be the base and break. So we had our wedge pop at E. Our crossback was kind of like where F was and sort of to the left of F. It's kind of like that whole level there. And then point G is the first basin break. And really, this is your traditional William O'Neill cup and handle buy point at point G. And anyone who traded Tesla in 2020, kind of knows what happens next. We moved higher, we based again, and what happened all through point H, we held the 20-day, and then we expanded higher again. At I, we had what I call the first extension. So, if I were to go a little more in depth in what I do quantify the extensions as first extensions and second extensions. But these extensions often lead to kind of new kind of consolidation periods. So you don't know if something is an extension until after the fact. Ideally you sell into the extension, but I certainly don't always, even though I would like to. I try to. But at J1, kind of that reversal bar back down, that could be viewed as the wedge drop, if you're playing things a little tighter. Or for me, definitely at J2, when we lose the 20-day, I would have been exiting, one of those 2 points. And then sure enough, because nobody's strategy is flawless, we gap back through the 20 EMA, which is actually one of my favorite buy areas when we shake out the 20 EMA and recapture it. I view that as a big time signal to get back long. So at point K, we have actually kind of what I consider to be a wedge pop. And we just accelerate higher. And at point L, this is what I call a second extension. So, we really accelerate. We have the widest range bar of the entire move. Well, we're very extended from the 10-period moving average. I am pretty good at selling second extensions in particular, versus first extensions can be a little tougher. But the key difference between the first extension and the second extension is once you have a second extension higher, the stock will typically sell off either harder or it will take a much longer basing period to reset again. So in this previous instance, it had about a month-long base after the first extension. After this second extension, it was kind of like a multi-month basing period to set up again, which is typically what you'll see in most stocks. And the reason being is because the weekly gets so extended by the time you have a second extension on the daily that it just takes a lot more time for that 10-week or that 20-week moving average to catch up to where it can kind of reset itself to have that kind of next move up. So kind of like I said, all we're really doing with these, wedge drops, crossbacks, basin breaks, et cetera, it's a nomenclature that I created for myself. But if you took all the moving averages away and you just traded like the price bars, all we're doing is looking to find capitulations, when things are overdone to the downside, let it come back up. I'm not trying to pick the low here, and let volatility contract. And then when we expand, so what I do is all about expansion and contraction. If you're trading an uptrend, the moves up should be greater than the sideways or pullback moves that are counter trend. So the higher lows here in the bottom left, let's just say for the very bottom left, that's your reversal extension, and it comes up and we tighten up the volatility and then we expand higher. That's like our wedge pop, right? And then we kind of pull back, and that's our cross back right in there. And then we expand again higher, and then we have a shallower pullback. And then at some point you move up, and a little pullback isn't going to do it. You're going to need to pull back, move back up, pull back, maybe undercut that, kind of first low, which is kind of how I drew it here. Just because now even the 10-day moving average kind of needs to catch up. And I call this a higher low shelf versus just like a higher low. It's like it comes in again. It just needs a little more time. And this is like your basin break. And then we expand higher again. And then we pull back. And then at some point, after we pull back, we try to move up, and we cannot make a higher high again. Our expansion is no longer to the upside, right? We expanded up, we contracted, and then we tried to go up, and there was no juice. That's what I said. There's no juice, and then the expansion's to the downside, and the trend changes, and now we have lower highs and lower lows, and that's really all we're doing. So my whole price cycle thing is just something that I created for myself. It resonated with me. It worked for me. I highly recommend that you create something for your own self, or use it if you like it. But all we're trying to do is identify the trend. And then the moving averages kind of provide an objectivity to the whole process, where it's like, hey, if we're above the 10-day, we're likely in an uptrend. Things are likely okay, and if we're below it, we're unlikely to be in an uptrend if we're below the 10-day moving average. I try to kind of simplify things to myself like that. But that's really what we're doing, is we're trying to identify the trend, and that's how trends work. Okay, so how do I kind of marry up the 3 time frames that I use in my process? So the weekly time frame, I don't really pay attention to stocks when they lose the 20-week. I'm certainly not trading them when they're under the 20-week. So the 20-week EMA is, about the 100-day moving average. Now the 200-day moving average is, obviously an important moving average. A lot of institutions look at it. But typically, I look at both, but when I'm looking at the weekly time frame, more often than not, the best stocks will not lose their 20-week. And when they're kind of in their trends, they'll hold the 10-week. And then I'm looking for like a base that is building around the 10-20-week moving average. I write 5 to 8 week base ideally, but that's really sort of like the shortest, good size base you want. If you can find like a 3 to 5 month base, that's even better. And I think is what you'll find is if you go study some of the biggest winners ever, go back the last couple of years and study Tesla and Nvidia, or study Shopify from before that, you'll find that when these stocks have these huge moves, if maybe like they'll have like a 50, 60, 80%, maybe 100% move, they'll actually often consolidate for like 3 to 5 months. And then maybe they have another huge move and they're up like 200% on the year, or something like that. But I feel like sometimes people think these stocks are just like always like ripping all the time, the whole year. And actually for probably, about half of the year or maybe more, they're often just kind of chopping around, doing nothing. They don't really have any juice to them. That's kind of what I call it. So, we're looking for stocks with a 5 to 8 week minimum base, but ideally a multi-month base to really kind of set things up, get that 10-20 week right there caught up. And then I typically like to try to buy more like flat bases that are kind of pushing the highs or near the highs, versus something that is like more vertically down, like a weekly bull flag. I find has a higher failure rate if it's like a 3 to 4 week bull flag on the weekly. Sometimes if they're coming down into the weekly, but it's like 5 to 8 weeks in length, the stock was just so strong, it took that long for it to kind of correct down there. I think you have more success with those situations, but they typically want to like square up, come into the moving average, the 10-20 week, come up, and then maybe come down again and really show that kind of horizontal level of support, versus just like come down and like bounce back. That can happen, but I often find more when they have kind of like what I call it like a squared up base. I don't really know if that'll make sense to anybody, but that's kind of the wordage that I use. And then from a selling perspective, you do want to monitor extensions from the 10-week EMA. So, I do have some stats on this. The stats I have are sort of like small cap stocks, large cap stocks extensions from like the 50-day and the 200-day. And I do look at those in extreme situations, but a lot of the time I'm looking at the 10-week. In the same way someone will look at the 10-day and say, hey, there's air to the 10-day. I'm doing that on the 10-week. And when there's air to the 10-week, then I say, okay, if we're a little extended from the 10-week, now when we get extended from the 10-day and we're extended from both, I kind of want to have my head on a swivel, maybe be willing to kind of, watch my back, look for some opportunities to take some off into strength. If we're extended and we have earnings coming up, that might be an opportunity to kind of sell the news, regardless of the number. But so that's kind of how I use the weekly. You want to really size up your base, make sure that it's well defined and it's not just some 2 to 3 week little kind of chop around. And then on the selling side of things, when we're extended from the 10-week, just kind of be aware of that. When you can get extended from the 10-week and go sideways for a week, which would just be like a basin break being defined. But if you kind of keep accelerating on the daily and you get extended there, that's kind of when you want to look for those extension scenarios. Okay, so then the daily time frame is kind of where we manage the trade. So that's where I use the price cycle, where I'm actually executing it, and I'm trading it around the 10-20 EMA. I'm looking for tight spots. People call them like technical buy areas or whatnot. But typically, what I call like a mini base, if I can find something that kind of comes up and it sets up 3 to 4 tight days under the 20-day, or within that range, or maybe it pops through the moving average and then it comes sideways like a bull flag, or I just call them mini bases. 3 to 6 day mini base, has an inside bar or something of that nature, to show that the vol is really contracting. You want to try to find those areas and execute there, because when you identify the right stocks with a nice weekly, and you see the daily kind of turning on the moving averages, and then you can find those tight areas to execute. You're certainly going to take your losses. I take more losses than wins for sure. But the winners relative to the losses you're going to take if you take a tight spot, you can have situations where you're making 50 R or sometimes more. Typically I'm risking like 2%, 2 to 3%, 1 to 3%, somewhere in that range. And you can have winners that are many multiples of that. And then ideally you want to be buying like the wedge pop, kind of when the stock is first turning, or the EMA crossback. So the wedge pop is often, it's not on the highs, obviously, just because of how it happens. Typically it's, ideally it's close to the highs, and the pullback isn't too deep. But it's, it comes up, and then sometimes that crossback can actually be pretty close up to the highs. But both buy areas, in context of my price cycle methodology, are near the first third of the move, and so they're the best buy areas because the risk reward's the best, right? Whether you're buying a basin break later in the cycle or you're buying the crossback, you're likely risking the same, but you have the opportunity to catch a more extended move with one of these earlier buy points, which therefore skews the risk reward more in your favor. And then basically, once you kind of get a trade working, you want to ride the 10-20 period moving average. And the goal is to try to assess which moving average the stock respects. And I like to see 3 touches of a moving average. So for example, if a stock goes up, pulls back to the 10-day, pulls back to the 10-day, pulls back to the 10-day, and it never touches the 20-day, I will then kind of view that as the moving average of note of it, that matters. And then some stocks are slower and they might want to touch the 20-day. Now I will say that buying pullbacks to the 20-day is typically going to be a better strategy than buying pullbacks to the 10-day, in the sense that your price will be tested and shaken out less often, which I think is true across all technical analysis. The shorter the time frame, the more signals and the more shakeouts. So, I don't know why I just said that, but I believe it to be true. Um, and sometimes a stock can like ride the 10-day, the whole move, and then maybe shake it out and start holding the 20-day. Or there's situations where based on the price structure, you kind of built a higher low shelf and we've been holding the 10-day, but then it pushes off. And now the 20-day is right below that shelf, like a major technical price level. So you decide, hey, I'm going to pivot to the 20-day for a little. But then it moves up and it starts holding the 10-day again. So you move back to the 10-day. So there's a little bit of an art to it. And you're obviously going to make mistakes and look stupid. And then, as the weekly stretches from the 10-week EMA, kind of as I said before, look for extensions from the 10-day EMA to start selling, into the move. Now, the one thing I will say here is people will often say to me, like in week 2 of the move, when a stock explodes, like, hey, should I sell it here? And typically when a stock gets extended, like right on its breakout, it's actually a sign of power. So like I'm kind of talking more into the move when I, make these comments. I've certainly had scenarios where things ripped up and I was feeling really good about it and I should have just sold it. But, typically if you see power like that at the beginning of the move, it's actually a sign like, hey, I want to hold on to this thing. I want to give it a chance to rest. And then as the move matures more, when you get those extensions, is when you want to start selling into strength for my time frame.
And do you look more for the extensions on the weekly charts or the daily charts?
Combo. When you're extended from the 10 week, if we kind of start to just chop around on the daily and go sideways, you might chop around for 2 or 3 days and the weekly hasn't changed, it's still extended, but then you get to Friday and you start a new week and it's like, oh, the weekly's a little less extended now, daily's still chopping, and maybe the daily chops for 10 or 12 days and it doesn't give too much back. And like now all of a sudden it's like, boom, the weekly looks, solid again. The daily looks real good. Actually, it might even have a new buy area. But then when the weekly's extended and that daily kind of keeps going up and accelerating, then it's like, all right, this just isn't sustainable. And at some point, it comes down to the fact of, the move isn't sustainable. And I would say one of the biggest mistakes that I make is when I say, hey, this thing's super strong. I know this isn't sustainable, but man, I just like this stock so much. Like, I think it's going to go sideways. I think it's going to go sideways and it's going to consolidate. In my experience, I'm better off just selling that. And then if it does go sideways, buying it back at the same price or even slightly higher. Because there's nothing worse than when you catch a sweet trade and you do everything right, and then you kind of misjudge that, and boom, the thing just all of a sudden craters like 6-7% in a day, or 10-15% in 3 days, because it can happen quick, obviously. So I find when the weekly and daily, get extended like that, and there is you get better at this with experience. It's hard to go from riding a stock for 6 to 8 weeks to then just all of a sudden on a dime selling your position. So the one thing to keep in mind is you don't have to sell your whole position at once. But then, I think as you get I think I'm pretty good at selling. I think I'm pretty good at selling. You only get so many opportunities to practice it, because you kind of have to be in a stock for like 6 to 8 weeks to even get the opportunity to practice that. And there's no other way to practice that than to earn that. So that yeah, it's something you got to get better at through time. And I will say I find when the daily and the weekly get extended together, the risk reward now gets the further it moves up on the daily, the more the risk reward is skewed towards selling, if that makes any sense. So yeah.
Yep.
Okay, and then the 65-minute time frame. So I use the 65-minute to enter and manage risk. So the same way you're looking for like tight areas on the daily, it's literally, you're doing the same thing on the 65-minute. It's just rather than, 1 bar a day, 5 a week, you're getting 6 bars a day, 30 a week, and you get a little bit more price action to, try and identify areas to kind of get in. And so the way that I set up my 65-minute chart is I actually put the 65-minute 20 EMA, which is about the 3 EMA. And for me, it's just kind of like a very tight guardrail. And then I have the 5-day, which I use as like the, hey, this is the trend, where the 5 days going. I picked that up from Brian Shannon, highly recommend checking out his stuff, especially for the price structure stuff. I love his book. And then I put the daily 10-day and the daily 20-day on my 65-minute chart. So like I'm never looking, I do have the 65-minute 20 EMA on the chart, but I'm really looking at the daily moving averages all the time, even when I'm trading on the 65-minute. I'm trying to operate I'm trading the daily with a little bit more information, I guess might be a good way to put it. And then, so like I'm looking for tight areas to get in here, and I'll kind of give some examples on, kind of how I try to buy, where maybe I'm trying to buy in like 2 pieces, where I can identify a spot on the 65-minute, it moves up a little, tightens a little. And then maybe it triggers the actual daily trigger where I'm adding, but I'm raising my stop. So I can kind of get a bigger position with the same initial risk, which I'll go through that more in a second. But then I'm looking to manage the trade via the price structure and the pattern of higher highs and higher lows. So, I'll give you an example of this. Like I find it's easier to identify the higher highs and higher lows on the 65-minute. Maybe it's too much information for someone else and they should just look at the daily. But I like the 65. I'm not looking for like reversal bars and stuff like that. Not that they aren't relevant, but I'm just looking at the core trend more than anything else. When I'm looking at the 65. I think most people don't need 10 or 15-minute charts. They can mess you up, make you overtrade. I do look at the 10-minute chart, but I try to operate the core of what I'm doing at the 65-minute and daily level, after identifying good weekly situations. And then use the 10-20 EMA from the daily time frame as what I call a filter. And is what I mean by that is as I'm trying to identify the higher highs and higher lows, like you can get too excited and call something a higher low, but it's like extended from the 5-day and it gets shaken out and you get shaken out of your position. So, typically in a really strong trend, something will kind of trend with higher highs and higher lows above like the 5-day actually. But then at some point it will kind of run a little too much. And rather than just having like pure higher high, higher low, higher high, higher low, it'll have like a higher high and what I call a higher low shelf where it'll just kind of pause in place for a little bit. And that'll let the 10-day kind of catch up. And so, if it undercuts that previous higher low a little bit, it's not necessarily breaking the trend because it's above what I call my filter. It's just trying to shake out the real weak hands. And when I say real weak, like it's never really like changing the trend, it might just kind of test it a little. But it's holding its trend. And then we're looking for upside expansions followed by tight contractions. So in an uptrend, price should expand and accelerate up with power, and then it should have little give back, or just kind of more tight trading. And then it should expand in the direction of the trend again. And that goes for uptrends and downtrends. Basically, the direction of the trend should see expansion, and then you should have contraction in between those, expansions. And actually, part of the reason why I like swing trading, well, one, I'm not very good at day trading, but two is that sometimes these major expansions will happen like right on the open, and then the rest of the day, the stock will kind of chop around. But if you're in the stock and you're aligned with the trend, you have the opportunity to take advantage of, what's happening, what the trend is. So yeah.
And one thing, just going back to this point here, one thing you said, I don't know if it was in the master class or a swing report, is you're not looking at the lower time frames unless the stock is at a key point on the higher time frames, and you're just watching to see how it reacts versus those levels and give you that extra information at that key point. If it's not set up on the daily and weekly, there's no point to at really looking at the lower time frames.
Yeah, exactly. I mean, you can find trades all the time on whatever time frame you're looking at. So, you know, technical analysis, the lower the time frame, the more signals, the more shakeouts, the shorter the move. Um, so, I'm trying to identify multi-week moves. You typically don't get multi-week moves on 10-minute charts. Maybe you get multi-hour moves. So I'm definitely trying to focus on the time frames that are going to get me, my intended upside, I guess.
Yep.
Yeah. Okay, so then breakouts and back tests. So like I'm looking, so like this is kind of more in the 65-minute chart. So like I'm looking to buy breakouts. But I would say like I had a major change in my trading when you're not going to catch every breakout. And the nice thing about the 65 minutes, you're going to have breakouts and then you're going to have pullbacks, and you're going to have plenty of breakouts. But where I kind of took a big jump in my trading was look to trade back tests. So like if you miss the breakout, don't chase the breakout, just wait for the back test. So very often a stock will break out in like a very powerful breakout where you've got like the weekly and the daily and everything is aligned. It may not back test. It may just rip for like, 2 weeks, and then it'll kind of consolidate a little. But often leading up into those big weekly breakouts, it kind of actually breaks out on the 65-minute and pulls back and sets up again, and then it breaks out on the weekly. So I guess my point is that, kind of one of the keys is, if you don't catch the breakout at the right spot, wait for that back test, that kind of higher low spot, after that initial expansion higher. And what did I write here? If you can rewire your brain to say, I missed the move, the goal is to wait for the, so yeah, so a lot of the time is you'll get a rip up, and then, I think most people who traded for a while would agree, sometimes you get that move down in the market from like 9:30 to 9:45, maybe 10ish. And then, the strong stocks that are ready to go that day might consolidate, and then they rip to like 11 or 11:30. And then everybody goes to lunch, they might go quiet, and, they shake out the day trader that was trying to hold his runner or whatever, at like 2 o'clock, 2:30ish, and then they have a strong close. So sometimes, around that hour when things have kind of been hovering down all day for like, 3 hours or something, that could actually be an opportunity to kind of look for that back test and a name that had expansion, and then kind of catch that higher low for a strong close. And, sometimes it moves up during the day and it chops all afternoon. And then, it has what, depending on your time frame, is viewed as like a shakeout in the morning the next day, but it's actually just a pullback to a higher low, and then it closes strong in the afternoon. And, so mess with this, try to kind of, go review some of the best stocks or names that you're trading and try to identify these, areas.
Got
Okay,
examples for you.
so this was coin. So this is the trade I had in coin. Um, so really, actually, this is an example where it broke out at like $90 and I missed the breakout. Like it had a big gap up and I kind of missed it. And then it pulled back into, around that $90 area, a little bit above it. And I didn't actually like buy that pullback. It actually like held up right there on the gap fill. But I did buy that next expansion higher, at around like $95 or so. Um, and so notice how it expands up and then it basically goes sideways for like a day and a half. And then it expands up again and it goes sideways. So that's expansion, then contraction. And then it expands, and the next round of expansion is fairly extreme. It has some gap downs that get bought up right away. Um, and then it pulls back again and it has a higher low and it kind of like holds the 5 day this whole time. But in reality, my filter, really the fastest moving average for me is the 10 day. And notice how this entire trend higher, basically held the 10-day moving average. So we expand up. And then I would say right in here, Richard, this is an example of what I was talking about, where like the name has now moved from, let's say $90 to 140. And the whole move there, it's just kind of like made a higher high, higher low. And it's never really taken the time to kind of regroup. And so right in here in this area, from Friday to Wednesday, which is only like 4 days, but the stock was able to pull back to the 10-day, move up, come back down, and build kind of more what I call a shelf, where it had like, 3 or 4 days rather than just like, a 5 or 6 hour pullback. And then it expands higher again. And it pulls back, it expands, it pulls back, it expands. And so if you really actually coin was an amazing example. Because actually I sold this stock on that gap up at 140-ish, way to the left, to the left. 140, way to the left, way to the left, way to the left, way to
Oh,
the
up
left.
here. Yeah.
And then I was actually able to buy the back test into 130. And if you really go through this stock, you'll notice that these pullbacks, just about all are back tests of the previous higher high. This is a pretty amazing move from like a trend perspective, is that a lot of the pullback lows, all they do is touch the previous high. And this was the ultimate example of breakouts and back tests, breakouts and back tests, breakouts and back tests. And then, I mean, it's, a little harder to see here. But on the weekly, we were getting pretty extended. And in this specific instance, coin was also working against the left side, and there was kind of a level in this kind of 200-ish area. We were getting a little extended on the weekly, and then is what ended up happening is, we made a lower low through 180. And I exited half of my position. But we were kind of like above our filter, and this wasn't really an extension for me. Like, I don't know how to describe that looking at the 65-minute, but it wasn't like so euphoric. But then when we made a lower low and we broke the 10-day at about 170 or maybe a little under, for me, that was the complete exit of the trade, because the trend had reversed. And is what ended up happening is this thing kind of needed to regroup. And I want to say it came back down into like, 120 or something like that. But this was an example where, this was basically 95 to 170-ish, so that's about a, 80% move, give or take. And, let's see, 1, 2, 3, 4, maybe like 5 weeks or so, that's really good. That's ideal. But this is a just example of seeing the higher highs, the higher lows, the breakouts, the back tests, the breakouts, the back tests. And I think, buying back tests, kind of once the move has started, is better in the sense that your price is less likely to get tested. Whereas if you're always kind of buying the breakout, a lot of the time, when it pulls back to the back test level, let's say your price is like $50 and it comes back into 49. Let's say you buy 50 and it goes to 55 and then it pulls back to 49. Most people want to get their stop to cost, right? And you get shaken out. Whereas if you're kind of buying the back tests, maybe it comes to 49, you buy it at like 50, you bought the same price, right? But it's going to now go up to maybe 60 and then pull back to 55, and your price is never going to get tested. So kind of after that initial kind of breakout, I find it better to kind of buy back tests, especially, if you can kind of get those pullbacks into the 10-day specifically, or the 20-day.
Yeah, it's building new Darvish boxes on the way up.
Yeah, exactly. Okay, so position sizing. So one, size based on the risk you're comfortable taking. So for example, if you like taking really big positions and maybe you want to risk 50 bips a trade, that's personal to you. It works for you, kind of have at it. If you like taking like 10% positions and you want to risk like 10 bips a trade or whatever, do what works for you. But I think either or, I sort of think like the real edge in what I do and really when I stay kind of loyal to this, is it helps me prevent drawdowns when I stay loyal to this, but buying pieces and then average up and raise your stop. So is what I mean by that is, if you buy like a pullback to the 10-day or something, and you buy a 10% position with like a 2% stop, you're risking 20 bips. So let's say you buy at $100 and your stop's at 98 or something like that. And it kind of works up a little bit, and then it follows through, and you add another 10% at, let's say 104. And your stop on that is going to be 102, or maybe it goes up and it pulls back again and you buy the back test at like 104 and your stop's 102. However you end up playing it, the idea is that you're buying a little bit higher, and you add another 10% with a 2% stop, but then you raise the stop on your first piece to cost, meaning you take that initial 20 bips of risk off the table, and now you have a 20% position with the 2% stop on the second piece, and then your stop at cost, or sometimes maybe even it's a little bit above cost, depending on the price structure. And you've got 20 bips of risk with a full position or double the position size. So if you're wrong, you lose 20 bips on a 10% position. So if you take an initial position, you buy 10% with a 2% stop, and you're wrong, you lose 20 basis points, right? On that first 10%. If you add a second position and you kind of raise your stop on the first piece and you get stopped, you lose 20 bips. You lose 20 bips on a full position. And at the first piece, you didn't lose any money, but on the second piece, you lost that 20 bips. But then if you're right, your gain is on a full position. So let's say you lose 10% or 2% on a 10% position, and you lose 20 bips. But then let's say, you started at 100, your next buy was 104, your average is 102, and the stock runs to 150 or whatever, or let's just say like 120. Now you made, let's say 18% on a 20% position. You made 360 basis points, which, I think is doable. I think people, if they're sizing the right opportunities, can find 20% wins. I mean, that's a nice trade, but it's doable. And basically you're making 360 basis points and you're risking 20 basis points. And that is kind of like the edge, that's 18R. And you're going to have plenty of names that are like 6 or 7% winners, don't quite work out for you. But then, you're going to have those occasional, like really big winners too. And then, a lot of people say you should size all your trades the same. Nobody knows which trades are going to work. That's definitely not how I trade. I like to take more risk on my highest conviction trades, and a lot more. And I think kind of the difference between having a really big year is like how big of a position you can get on your best ideas. If you have a huge winner, but like a 5% position, it's like you're not going to have as good a year. Obviously, I don't want to state the obvious, but it is like the case is if you have like a 20% position on that same play, or maybe bigger, depending on what you're comfortable with. And the way I go about that is, here's an example of a trade I did. I did really, really well in this. I think it's the next slide, Richard.
Yep.
Yeah. All right. So NVIDIA, when it kind of had its move from 500 to 1,000, I did real well in this. And the reason being is because of how I was able to buy it. So to just like go to the left, so because this is reality, like, when it kind of broke out on the left at like 475, I got involved, it had the back test and I added more. And it went up and it looked good. And then it kind of pulled back, and I think I reduced, but then later on I ended up getting stopped out, and it was further to the right is when I fully got stopped. Yeah, like over in there to the right a little. And basically I sat in this thing for like 2 weeks, and at the end of the day, like if I'm in a name for 2 weeks and I make like 1%, like it doesn't feel like a winner. Okay. It feels like a loser. But then on the right hand side here, that initial kind of breakout when we busted back through the 1020 EMA, I got long there, and then I actually like added on the back test into the close, and I brought my position up, and I raised my stop kind of to where that breakout was. Like I wanted to give it a little room to under the moving averages. But basically I had, my first piece and my second piece on, and my first piece was just about risk-free. In my second piece, obviously I still had risk, like I had overnight risk. I didn't really know what was going to happen the next morning. But this had a huge weekly base too. So like everything was set up here. And this is what I was saying, like when you have those big weekly bases, you're able to kind of position size on the 65-minute before. And then the next morning when we kind of gapped, like I was ready, and I doubled my position, and I kind of raised my stop to, basically a little below the gap fill. Like I didn't have like an exact number, but I knew what I call my max pain point. Basically it was my first two entries were risk-free, and I was willing to take a shot, and add on that breakout, and that was basically my risk. And then the volume was so heavy that I actually added a little more through 500, and then even above 510 when we kind of based out a little bit there. I think my average price was in the 495 area, and I was willing to bring my average price up to 500. So I just added like a touch more. The volume was so heavy, I just didn't think it was going to fail. I had a lot of conviction in it. And this ended up being like a really, really big trade. But like, obviously you're looking at the chart and you're like, oh, like it played out perfectly, and it did. But the reason it was a big trade, wasn't necessary. I mean, it was because it worked, but it was a big trade because I was able to buy in kind of 3 or 4 pieces without ever really like significantly increasing my initial risk. I will say on that breakout, I kind of really, really went for it. The bigger breakout, the second one. So I had some risk. Like this is a situation where I was risking, 50, 60 bips instead of like 20, just because, there's a huge, huge weekly. But, I've had plenty of trades. So like I had a trade in SMCI where it ripped like 200% this year. And unfortunately, I actually I was positioned just like this. And like the day before it ripped, I actually got shaken out of my position. And so then, it ripped on a pre-announcement. Then when they pre-announced, I was starting over with my buying process. And so I actually, in this instance, I had like a huge position. In that SMCI instance, I basically had, I had a 12% position. Whereas if I wasn't shaken out of my position the day before, I probably would have had somewhere in the 20% range for my position size, which for that type of name would be
It's a lot.
a big position for me in that type of name. Um, so like, that is like the big kind of edge I have on top, for me at least on top of all the strategy and all that is like trying to buy to where you can get your size up and balancing, risking your cost basis. Because obviously, like if you average up like a moron, you risk like getting shaken out on a normal, reaction and you feel really stupid. Um, but if you can do it the right way, you can put yourself in a situation where you can, really, really, do well. Um, and then I would say, I'm trading real companies. I'm typically not trading, uh, you know, I don't know, stocks I've never heard of.
And just to add, just to emphasize the point, you mentioned this is the very right side of a big weekly base.
Yeah.
I think you've also pointed out in the past that it was showing relative strength versus the rest of the market in this period, and then had
Yeah.
this wedge pop on the 65-minute time frame, and that's why you went for it right here.
Yeah, so like in this instance, even though Nvidia looks weak here and like it had some selling coming into it, it was actually holding up better than the underlying market. Um, so it was kind of being held back and then it really led the market, once kind of the pressure on the market came off, Nvidia exploded.
And we've got a breaking recapture example as well.
Yeah, and then so this is just like an example, like when I'm trying to like buy support, off the 1020 EMA. Um, like a nice way to do it is to look for I set alerts on the moving averages, but I also set alerts at like relevant swing highs and lows. And, if you can find an area that undercuts a swing low and recaptures, you know, that's often a good area to execute. Why? Because they're running that swing low for liquidity so that they can buy shares. Um, so, I'm not going to go kind of too into this. I actually think the skill in the break and recapture is setting the alerts at the right areas on the chart. Um, but I mean, a name like Nvidia, they run the highs and the lows all the time. Like if you set your alerts at like these swing lows and you're able to kind of identify what I call scums where they kind of run the stops and then it recaptures. I mean, those can be the best areas to get long. Okay, so some key points. Always use the entry tactics in context of your overall strategy. If a stock's in a downtrend and you're looking to buy a break and recapture, it's not going to go too far, even if it works. You want to be trading, a pullback to a moving average where you're in a weekly and daily uptrend. So, you're in a strong stock and setup. Then the higher time frames always supersede lower ones. So, oftentimes the daily time frame will top out when it looks like a bull flag, but the weekly's extended and everybody thinks it's a bull flag. Me 10 years ago said, oh, this is the best setup ever. And then the next morning it like tanks down the bottom of the bull flag. Why? Because the weekly was extended. Um, so higher time frames always supersede lower ones. And then entry tactics allow you to manage risk and size into positions. I pretty much just went through that. And then the index price cycle will affect individual stocks. So for example, if the market has been running for like 8 weeks, 10 weeks, and now you identify a stock that's about to have a wedge pop, like you got to ask yourself, like, what's it been doing the last 8 weeks? Like, why is it only now just breaking out? And is it going to break out and then slam right on my face when the index kind of reverses itself or the index just chops around? So pay attention to where the index is. I'm not saying like analyze every little tick price bar and but know where the index, what the trend is, and just kind of how long we've been moving. And if if the trend's been going for like 10 weeks and you're just finding a breakout, you might be better off like buying a base and break in a stock that's already moved a little bit, and just treating it as more of a shorter term swing trade, because at least that stock has told you like, hey, I'm healthy. I've been moving this whole time as the market's been moving. So pay attention to that. And then the other thing is, manage your overall account risk in addition to individual stock risk. Um, so, if you have, 10 good setups and, you're risking 20 bips on all of them, like, no, you're risking like 2%. And really you're probably risking like 2.5, because at least for me, it's harder for me to execute like 10 trades at once. And it's what I found that helped me is like I trade more concentrated, like I trade less positions. And then, when I come into the day, if I have a bunch of good ideas, you use your best judgment to say, hey, I'm going to focus on these two or three. Because one, I can just fully focus on them and be ready and execute them right. And then two, I can better manage kind of my overall account risk. And then the other thing is, let's say you bought 2 or 3 stocks a day before, if you haven't gotten your stop, above cost on those, and then you're looking to add a few more positions, just take into account, you're kind of exposing yourself, um, to having more risk. And, there's certain times where, you just really think you're seeing a turn in the market where maybe you're willing to take a little bit more risk. But, you just don't want to get your head too far over your skis, and, kind of screw yourself. So, just take into account the overall account in addition to the risk you're taking on each individual position.
Excellent. Yeah, Oliver, this has been really, really great. I think especially the NVIDIA example, walking through where you size, where you raise your stops, and where I think that'll hopefully help out a lot of people watching. One question I have for you is if you were to give a homework assignment or exercise for people watching to do, related to the price cycle or related to figuring out their own price cycle, what would you kind of tell them to do? And maybe it's related to the Swing Report webinar yesterday where we walked through studying previous winners, marking up those charts, all that. But yeah, what would you kind of assign everybody
Well,
today
yeah, I
to
mean,
help them through the
I
trading
would say
season?
go look at the stocks that have done really well the last 20 years, or if you have the data to look back further, is what I would start with are, for me, the names that have been key for me the last couple of years have been NVIDIA and Tesla. I would start there. Prior to that, Shopify was a really big name for me. And then when I first started trading, uh, in like 11, 12 or so, kind of the hot names were like Google, Amazon, Apple. So, go back and go through those like bar by bar. The nice thing about Thinkorswim is you can kind of just press right and you can literally kind of trade those just by seeing one bar at a time. And then is what I would say is like, once there's a big move, kind of go look at the weeklies on these things and realize like how long they consolidate for in between these moves. And Sometimes, it's a stock that moves for like 6 to 8 months throughout the year, and then it's quiet, or maybe it's like 2 to 3 month moves in the year, and then it's got like, 2 3 month kind of basing periods in between. But stocks are not always just like going parabolic all the time. Like they do need to kind of catch their breath. So I would go through and kind of study those big winners, and then look at the weekly as well as the daily, to try to size those up and learn for future stocks.
Excellent. Well, Oliver, thank you so much for your time for bringing this together. I think it will help a lot of people. To everybody watching, I hope you enjoyed it as well. Make sure to thank Oliver in the chat right now. And if you'd like a copy of these slides, there'll be a link posted right there where you can sign up and register to get the slides of not just Oliver's presentation, but all the presentations as well. So make sure you click that, sign up. It's completely free. And with that, we'll be right back with the next presenter. So stay tuned. Cheers.
All right, thank you.
All right, welcome back, everybody. I'm excited to introduce our next speaker, Jared Tendler, who's an extremely experienced mental game coach who has worked with thousands of professionals in poker, golf, and trading. He is the author of multiple books, including The Mental Game of Trading and also the mastermind behind the Trading Psychology Masterclass, which I was fortunate enough to work with him on, creating that valuable resource, walking through his full system and an application of the system. Great experience, highly recommended. Today, we're going to dive into some more valuable insights from him. And Jared, thank you so much, as always, for being here. As I mentioned before we started recording, I think you add a really valuable voice to this conference. So thank you for your time and really excited for this.
Yeah, thanks, Richard. Happy to be here as always. My third year, which I, again, kind of enjoyed every time. And, Yeah, this time we're going to do something a little bit different. Before I kind of jump into my presentation, I do want to just reemphasize to everybody watching this the importance of donating to St. Jude, and it's awesome that you guys are kind of organizing this conference around that. I had a good family friend who had, their son had Hodgkin's over the past year. Fortunately, he's doing awesome. Was not part of the St. Jude system, was kind of in a local hospital, but childhood cancer affects a lot of families. So I've donated and really recommend that everybody watching this who finds value donates. And if you don't find value, donate.
Pay it
But
forward.
we're going to try to do both here.
Yeah.
So you can see the headline here, right? Correcting the damage from high expectations and perfectionism is the topic we're going to talk about today, or I'm going to talk about today. And just to provide some context for those that are not familiar with me or my system, right? In years past, I've talked about my system, in great detail in the first presentation. And then last year, I kind of went into the first step of my system, which is mapping your pattern. But today I wanted to kind of dive deep into a problem that I see regularly with clients, but is oftentimes hidden, especially the damage that gets inflicted from high expectations and perfectionism. And I do want to make very, very clear out of the gate. High expectations and perfectionism are not an inherent problem, okay? Many of the elite athletes, the elite traders, the elite poker players that I work with, they all have elements of high expectations and perfectionism. The ones that don't come to me with problems associated with this are the ones that are able to find like the delicate balance between the hard driving aspiration towards perfection with a pragmatic view of it and understanding and a ruthlessness around correcting their weaknesses and removing the imperfections that exist in their trading, in their approach, in their process, right? They're aspirationally driving towards perfection, but they understand that it's not really realistic over large samples, right? And so that's really important. That we're primarily using perfectionism and high expectations as a motivator, right? It's a driver. But for a lot of people, and not just traders, for a lot of people, one of the big problems, and there are many, I'm going to get to them shortly, but one of the big problems is the damage that it causes to your confidence. And this can show up in very, very subtle ways. And I've worked with many people, especially traders, who have come from other industries, right? They've been successful elsewhere. And now, either as a new career, as a way of making money on the side, or in trading their own, retirement accounts, right? They kind of come in with a level of expectation about themselves as traders. And that really slows up their progression, damages confidence, and really increases a lot of emotional volatility. In fact, any one of the primary emotional issues I see, greed, FOMO, fear, right, anger issues, obviously confidence issues, can be caused by high expectations and perfectionism. So today we're going to kind of cover a wide variety of approaches to actually correcting this. First, kind of giving you a good sense of the hidden ways it might show up, so you can kind of find yourself here and see if it affects you. Because in my research, roughly around 60% of traders are struggling with problems associated with high expectations and perfectionism. So it's a wide, kind of big problem. I think more so than in poker and in other industries I've faced. And I think a lot of it comes from the success that many traders have had elsewhere. We're going to cover some very practical ways that you can begin to correct this problem. And by the end of the day, you should have a clear understanding of how to actually do that, right? So I'm not going to just kind of throw out the problem and leave you empty-handed, but I'm going to give you a very pragmatic roadmap. And for those that are unfamiliar with my system and my approach to trading psychology, that is what I'm all about, right? Providing a little bit of context, theory, larger kind of concept, but matching that with practical strategies that you can use immediately to get the job done. So, but again, just to give you a quick little overview of me, if Richard kind of alluded to a few of this, but I've been coaching in the trading industry for over a decade. I've worked with over 400 institutional traders, retail traders from around the world. Author of Mental Good Trading. I'm also a licensed therapist. I never intended to get in this field, but my own aspirations as a professional golfer were derailed. And, mostly because of my own head. So kind of solved my own issues, got educated, got trained, and now I've been coaching for nearly 2 decades. Yeah, so let's get after it. This is a picture of Alex Honnold. Those that are not familiar with the movie, oh man, I'm blanking on the movie. Basically, Free Solo. So basically, Alex is known for climbing without rope. Okay, most climbers use rope. They anchor themselves to the mountain because they don't want to die. And Alex doesn't want to die either, but he's an incredibly sophisticated athlete who has been able to not only train his mind, but train his body to be able to produce unthinkable feats. And this is him free soloing, right? Climbing without rope, El Capitan, which is this sort of feature of that movie. And unfortunately, from a confidence standpoint, this is what many of you feel like, right? Where your aspirations, your successes, your progressions as a trader has measurably improved you, right? You've got real skill. But if your confidence doesn't go along for the ride, then it can kind of feel like you're kind of hanging out on a mountain and at any point can crash. And especially for those of you who maybe going to go through the trading combines, right? You get funded and then blow it up. You get funded and blow it up. Or you're trading your own account and you know, are able to scale up, but then, you know, do well for 3 or 4 weeks, a month, 2 months, but then you have those big blow up days. I'm not saying it's the only reason, but there's certainly many of you who are dealing with those kind of boom and bust cycles, big ups and downs, a lot of paralysis, you know, succumbing to FOMO, because this is how you feel. You feel subconsciously as if you're kind of hanging out on a mountain untethered, right? And at any point, the bottom can drop out. And what we want is for you to feel like this, okay? Anchor to the mountain, you fall, right? You fall 10 feet, it hurts, not fun, but you're not dead, okay? That's what we want to go aim for, okay? And that's certainly going to be the goal of for me today, is to be able to provide that for you. But again, let's just make sure that we're all on the same page here about what these issues can look like, because it can oftentimes be hidden, okay? So here you are putting a lot of intense pressure on yourself to achieve, but there's parts of you that can't really handle the pressure. So maybe there's a lot of hesitation and fear, even around getting to trading. Maybe there's a lot of itchiness and antsiness where market opens and you're immediately taking trades and violating your strategy or system. Maybe there are times where you're going through a drawdown and you just need to take like days or weeks off because you just kind of can't handle the continual losing. In other words, you can't handle the pressure because of how much intensity you're putting on yourself. You hesitate to enter proper setups. I mean, this is a problem for a lot of reasons, but it certainly can come from perfectionism. And what'll end up happening for a lot of you is there'll be so much intensity around entering like that ideal setup, you'll miss a few of them, and then revenge will kind of creep up, or FOMO will creep up, right? You'll realize that you factually missed out on a few profitable trades. Let's say both happen to work out, right? And then that triggers anger. That triggers some desire to make up for what you should have had. And then you enter, you know, invalid setups. They end up losing. And now here you are down at a day where you should have been up money. And then the spiral can actually get pretty severe, right? All because the beginning problem, the first domino to fall here, is this hesitation caused by your perfectionism. Hyper analyzing a stock, but like missing the bigger picture. So there's sort of this kind of myopic, like zooming in because you want to make sure that you are like checking every little box on this particular stock, and you're not willing to pull the trigger on jumping in without without that. But then at the same time, maybe you end up doing that, but kind of missing some bigger picture in terms of how the market's moving as a whole, and the trade gets invalidated because of that. Okay. You have a hard time moving on and letting go or getting over mistakes, right? Because if you don't have that ideal balance of that kind of high driving perfectionism with an understanding of imperfection, any imperfection to you is like needles in your brain, right? And so you're going to get incredibly like the word's perseverating, where your brain just kind of snowballs and spirals around these mistakes. You can't really let go. And as a result of not really letting go, you're going to miss other opportunities. You're not really going to be able to perceive the market price action quite as clearly. You're going to have some biased views on some of your sort of standard indicators, you know, because you're either looking to get back for what those mistakes were, or you're kind of just like kind of paralyzed in your mind, unable to see, you know, kind of valuable or viable opportunities and then only kind of see it after the fact, in the kind of the daily review. You become lazy or procrastinate for reasons you can't determine. I know this might sound a little strange, but there are many of you who procrastinate because of perfectionism. And it should make a little bit of sense, right? Because what will end up happening is the procrastination creates this sort of internal tension that, either is delaying, let's say you're researching, or, you're kind of half-assing your pre-market routine, your process, and kind of middling a little bit. There's not a lot of success happening. And it will feel like you're just kind of delaying and delaying and delaying, and the tension that builds up until finally you sort of snap, and the tension's too big, and now you go guns blazing, you do everything perfectly, and you actually crush it for a month too, right? Until that energy starts to fade again, right? And what's causing that is that buildup of tension produces an extreme level of performance, which you now deem your version of perfection. But to do that, you become dependent on being lazy, right? The laziness precedes that top end performance. So yeah, now you need to become lazy again in order to create that internal tension, to create that high again. In other words, that high is kind of artificial, right? It's not like a more normal A game. It's this sort of more extreme version of it that's not reliable or something that you can produce, again, without laziness or procrastination. You never applaud good results, or not for very long, right? The goalposts kind of continue to move, right? You kind of do the yeah buts to yourself, like, oh, had a good week, right? Not a great week, not a blowout week, but a good week. Saw some progress, didn't enter some trades that, months ago I would have, right? There's real tangible progress, but you're like, no, well, that's kind of what I'm supposed to do. So, whatever. And you kind of move on. You have diligent research, and that kind of raises your expectations, both about like the viability of a particular trade. So now you're kind of expecting it to pay off because of how well researched it was, and, how diligent you were, maybe, and even backtesting your strategy, right? Expectations raise. And even though intellectually, that the probability of this trade being viable is, let's say, let's just say you had a 70% chance, pragmatically. In your mind, it feels like it's 100, right? And so when it stops you out, you become incredibly frustrated, confused. You might lose confidence as a result, right? The expectation kind of is an implied guarantee. And again, kind of like the zooming out to other market information, right? There may just be other information that you have or have access to, but again, that diligent research kind of closes you off to it. You become self-critical over the slightest missteps. So again, kind of like the mistakes thing here, but like sometimes they're not even really mistakes, right? Sometimes you might become self-critical over losses that are just variance. They're short-term, unpredictability of the market that you don't have any control of. And yet you become critical over it, right? Sometimes traders hate losing simply because they expect themselves not to, especially when they've, entered an A+ setup. You're constantly comparing yourself to others. Again, comparisons objectively are not bad. I think it's helpful sometimes to have some basis of comparison, right? And if you're falling behind, it's good to know, but to fall behind and then kind of look to others with a critical eye of yourself is not really helpful, right? It's not actually a comparison that's helping you to figure out what you need to do better or what you need to do differently, or maybe even ask questions of what they're doing that you could be, right? It's more of kind of an empty, self-critical, judging, jealous kind of comparison. Adding pressure when you're posting trades, like, look, many of you don't utilize resources that are available to you. Now, I have a community of traders that I'm working with, and the majority of them are not sharing the work that they're putting in on their mental game. So even in a close community of people who are like-minded and supportive, it's a fantastic community. They still have trouble getting over the hump to be able to expose themselves. And it feels there. So here you are, right? You're seeing lots of traders on social media posting all their wins and all these big trades. And here you are struggling, could actually get some viable feedback and, within the TraderLion community, within, the Twitter community that you feel or that you're surrounded with, or Discord that you're in, and you're withholding, or you're not able to reach out and allow yourself to look weak, to look like you're not understanding something, to be confused. Again, because you have expectations yourself. There's no judgment coming from other people. If there is factual judgment coming from other people, then they're not the people you should be hanging around with. Most of the time, the judgment comes far more intensively from yourself, and it prevents you from learning, and it prevents you from reaching out and getting help from other people who actually generally kind of like to help. I mean, certainly know the TraderLion community is very much within that ethos, right? They actually love it, right? The education that's being provided here. Feel like nothing is ever good enough, even after winning. So again, this kind of like the goalpost is always moving. It's like, yeah, exactly that. You kind of feel empty even when you're doing well. Free soloing effectively. Have trouble relaxing due to the internal pressure. So, on a weekend day or on a weekday night, can you actually just let yourself chill out, after having a losing day? Can on the weekend you not spend 6 to 8 hours doing back testing week after week, month after month, diligently trying to do everything you can? And again, I'm not opposed to the aspirational nature, okay, of trying to be perfect. But when you can't relax, because the elite athletes, elite traders, they understand the necessity to rest. They understand that without it, they actually break down mentally. You don't want to show up on Monday, weaker than you were on Friday, right? You want to have the restoration to occur over the weekend so you can come back sharper and ideally stronger than you were the week before. That's what rest is all about. You go to the gym, you work out, you rip muscle fibers, right? You're telling your body, hey, I want to be able to produce this kind of force, this kind of strength on a reliable basis. Rip your muscle fibers. It's in the resting that the healing and the strengthening actually occurs. So here you are on a technical basis, on a mental basis, trying to improve as a trader. And if you're not resting because you can't, then that perfectionism and high expectation, right, is like now kind of out of control. It's not just about this high motivation. It's an unquenchable thirst that just can't let you rest. If it was balanced, you could be incredibly hard driving and get plenty of rest, right? Michael Phelps, for 18 months before the Olympics, would train 7 days a week. And I didn't think that was possible, but he sleeps like 10, 11 hours a day, or he did sleep 10, 11 hours, during the day. He'd train for 6 or 7, go take a 3-hour nap, go train for another 3 or 4, and then eat and go to bed, right? And it was like that. He did that for 18 months. So, but he and his coaches understood the value of rest. All right. Hopefully you found some things that feel familiar to you, okay, that you can kind of understand. And again, objectively speaking, you may not necessarily have weaknesses and confidence on a personal level, but trading oftentimes brings them out, right? And if you have anything that I've shown you, then the next 4 kind of puzzle pieces are going to be the thing that we're going to really key in on to help take this problem, or to help to begin to kind of mediate and correct this problem. So first off, we're going to be looking at the difference between expectations and goals. And we're going to talk about how expectations create this faulty self-evaluation and the damage that ultimately gets created from that. We're going to provide a new definition of perfection for you. And then for some of you, not everybody, for some of you, you've had such big, painful losses, some mistakes from years ago that you can't let go. Okay, one client who I talk about in the trading book, he lost, actually didn't factually lose money, but closed the trade prematurely, air quotes, and missed out on, $250,000, like a very large sum of money for him at that time. And for us to move anywhere in getting him to be more consistent, and he actually was profitable by the time he and I started working together. But to really be able to scale up and move forward, we had to do more of this sort of removing the scar tissue, right? We call it kind of the trauma, the deeper pain points of the past that are really holding you back. For some of you, that is a vital part of the process and being able to move forward. All right, so let's look at the differences between expectations and goals. And my hope is that at the end of this slide, they should feel incomparable to you, because right now it may seem like the same, like, oh, well, expectations are my goals. Okay, but there's some implications between an expectation and a goal that's not just a linguistic choice. I'm not just choosing words. there's intent that matters much more. So if you want to say your expectations match the intent of your goals, then fine. Okay, I'm not going to get into a linguistic argument with you. Where it's more about the intent that matters. Okay, so your intent of expectations cannot be the following. It cannot be an implied guarantee. Okay, I expect myself to be making X amount of money per year. I expect my account to grow by X percent, week over week, month over month. I expect to make money every day, right? A hidden one that oftentimes many traders wouldn't say they think, but deep down, their emotional reactions to losing trades or losing days tells us that they are expecting themselves, right? They're basically guaranteeing that they should make money every day. A goal implies a lot of learning and implies a lot of self-reflection to produce the results that you're ultimately after. Okay. If you're guaranteeing your results, that means that you already have the skills, knowledge, experience in order to produce those results. And to me, the people that I work with, those expectations are not, those implied guarantees are not actually real yet, right? They're goals, they're aspiring, they understand how much learning and progression needs to happen, but they keep getting tripped up because they're expecting themselves maybe to move faster, right? To do it within a certain time period. I can't tell you the number of traders who are expecting themselves to have already been successful by now. Okay. They're 2.5 years in, they're 3 years in, they're 7 years in, and they're expecting themselves to have been successful by now, by the amount of time and effort they put in. But we all know that time and effort are not the most reliable factors for being able to produce results in trading, right? To me, they're just minimums. Time and effort, minimum, right? What's actually going to produce results? You got to have an edge, right? And you got to have the mental and emotional wherewithal to be able to execute that edge on a reliable basis, right? You also have to have really good research skills. You got to adapt. There's a lot of things that go into trading. It's not a simple enterprise. But many people say, oh, well, I should be able to be successful here within 6 months, 10 months, 18 months. Like, where is that even coming from? It's basically just an implied guarantee that maybe is very wishful or hopeful. Okay, and it's time to delete it. Okay, kind of already alluded to this, but again, expectations assume that you already have the skills. Goals assume that you have to acquire them over time, right? And that implies a learning process, and learning processes go through ups and downs, right? The implied, sort of linear progression. No stock actually does that, and yet here you are expecting yourself to be that, kind of mythical value stock that goes up, 5% month over month. Cares only about the outcome, right? Expectations do not care about process. They do not care about learning. They only care about the end goal. And goals care about the end goal, right? Yeah, I want to make X amount. I want to be able to be this successful or reliable of a trader. But there's a very deep connection to the process and the how and the what you're doing and the problems that you have to solve and the learning that has to go in, right, in order to produce those outcomes. And then lastly, expectations overreact to setbacks, right? Because they're not expected, right? The expectation is the outcome, right? The positive outcome. Goals, I mean, when I have clients go through my standard goals worksheet, the last section includes the problems that you are most likely to face, right? And so all the clients that I worked with in, through the new year, right, we're going through this process. We spent a month really diligently thinking about what problems are expected to come in 2024, right? And they prepare for them. Now, are they going to occur? We don't know. But going through that exercise keeps you open-minded, keeps you on the lookout for the mistakes, the setbacks, the unpredictable learning that, is ultimately going to have to be solved for. Because when you set out to become successful as a trader, to reach your next level of your goals, you don't always know all of the things that you need to learn, all of the things you have to solve for in order to get to that next level. If you think you do, you have blind expectations. And if you have appropriate goals, then you're more open-minded to the setbacks, to the unpredictable things that can happen, and you're just aggressive at solving them quickly. All right. So the next piece here, this faulty self-evaluation. Very kind of distinct pivot from what I was just talking about, but they all kind of links together. So here's the deal. When we're talking about confidence, okay, confidence requires really good feedback. Okay, we think about kids developing a sense of competency, right? Imagine if they got zero feedback, right? You get zero feedback as a kid learning language, you will not be able to develop language. Okay, think about learning baseball, basketball. Like imagine, shooting baskets and never actually getting to know if what you just did made the ball go in, right? You don't know if you made it, missed it, hit the backboard, hit the rim. You never get that feedback, right? Your perception would get very warped. Okay, so when we're talking about trading and we're talking about developing an accurate way of measuring your skills and competencies, which ultimately is what defines the basis of your confidence. Okay, confidence is an emotion, right? It reflects your perception of your skills, your perception of your experience, the value of your experience, right? And that perception can get easily warped when you have an inaccurate way of measuring yourself. Okay, so if you have high expectations of yourself, which again are implied guarantees, then the feedback that you're getting when you fall short of that standard is going to be negative, right? In other words, you're going to produce negative feedback. And only when you exceed your expectations will you get positive feedback, but it's so hard to do that. It really is going to happen. If you reach that standard, you get zero kind of confidence from that. So here's what happens. Thousands of transactions, right? Individual moments, right? Where you're trading, and certainly this can be an issue in your personal life as well, right? Where you're getting negative feedback. What happens is you get an accumulated debt, right? Think about this as if it was actual money, right? Here you are like falling short of your expectations. You're losing out confidence, right? You're running into debt in a sense. And what that does is it produces a hole in your confidence. And as that hole gets bigger and bigger from years of measuring yourself inaccurately, you become more and more compelled to seek external results, to seek money, to seek certain levels of trading, levels of success as a way of filling that hole. So you become more and more desperate for success. You become more and more urgent. Again, kind of driving that intensity so high you can't rest and relax. That sometimes can come from this hole in your confidence, right? And it's solely due to the inaccurate way that you've been measuring yourself. Because if you had set goals for yourself, not expectations, right? You didn't have the standard here, you had it here. And I want to be very, very clear. We're not lowering your expectations. We are eviscerating your expectations, turning them into goals. So actually, let me just kind of rephrase this. Your expectations were here, okay? Your goals can be here too, right? But realistically speaking, there's a range of outcomes that are going to occur. And if your true expectation is down here right now, like the level of proficiency, level of performance that you can guarantee on a reliable basis from a trading standpoint is here, then everything from this point up until your goals, you get some measure of positive feedback from, because it's showing that all of the work, all of the effort that you're putting in is actually producing some results, right? In terms of your skill set, in terms of your overall process, your ability to execute, your ability to research and get feedback and to be resourceful, right? All of those skills that you're acquiring, right? They deserve feedback. Like they deserve accurate feedback. You deserve to get credit for it. And if you're not, it creates this debt. So the reality is many of you are sitting on gold reserves, right? You're sitting on like actual distinct assets when they feel like a liability. And that's solely due to your perception. So here's how you correct it. Okay, this is a worksheet. I call this the perfectionism worksheet. Effectively, you're going through 4 steps. Okay, you can see them listed here. It's not overly complicated, okay, but it does require a regular diet because you're trying to reshape perception, reshape your perspective on your skills, on the value of your accomplishments, to begin to kind of fill that hole, reconcile that hole internally. There's no amount of money that you can have. I've worked with 7-figure, 8-figure traders who have had this problem. Okay. There's no amount of money you can have that can solve this problem. You have to solve it internally. Okay. So here's what you do. Okay. Before even looking at this worksheet, I want you to spend some time listing out your past accomplishments in trading. This is a personal issue. You can do it on a personal level too. Okay. Or it can be both. List out your past accomplishments. Okay. Spend 5-10 minutes one day, just like bullet point on it. And what you're looking for specifically are the ones that have kind of gone under recognized. Okay. And then you're going to start plucking them out and going through this process. Describe the accomplishment in detail. List and describe the key steps you took to achieve it. What difficulties did you encounter along the way? And how did you get through them? And if you made mistakes, what lessons did you learn? Okay. You can see there's some overlap in these questions. Okay. I'm not looking for perfection in your answers. I'm looking for a robust understanding of like what produced those results, what produced that accomplishment. Because if it's just kind of headliney, handing out and kind of hanging out there, you end up kind of looking like Alex hanging on the mountain with nothing really supporting him. Okay, we want you to actually be able to understand the mountain of knowledge and experience and skills that you've acquired that are really kind of going under or even unrecognized. And here's the key, and you'll see this in the instructions at the top. You are not allowed to do this for very long every day. Okay. You will get far more out of it by spending 5-10 minutes once a day than you would from doing it for like 1 hour once a week. Okay. Because you can't eat food for a week. And when you're starving yourself of the feedback that you have earned, then you need to kind of have a regular diet to reconcile that. Okay. And begin to kind of steadily, identify it. Because what can happen, and this has happened, you do this for an hour on a Sunday, you're going to come in on a euphoric high on Monday, and the expectations are in there. And because you feel so great and the expectations are still there, I mean, you are very at risk of overconfidence and making big mistakes for different reasons than you would normally. Okay. So the idea here is we want to have some recognition, just pats in the back here. We're not looking to like go out and throw parties here. It's just give yourself the pat on the back, the recognition, a little bit of pride, a little bit of satisfaction for the things that you've accomplished that have not been noticed before. 5-10 minutes a day. You want to do it a couple times a day, cool, but not like back to back. Like think of it like kind of eating meals. So maybe in the morning, maybe in the afternoon, the evening. You want to do a little bit more on the weekend, fine. But again, like really kind of up to like 15 minutes. You do it too long, you really risk producing too much, kind of elation, and that can be problematic. Okay, and if you want to download this, you can get it freely available on my website, jaredtendler.com/worksheets. I got a couple examples here that I'll go through briefly. One's a trading example, one's a personal example. Okay, so this is from a kind of a newer trader. Passed the combine evaluation to earn funding and was able to take payouts from these funded accounts. Okay, how'd you do it? Well, steps I took to pass accounts, get funded, and make money. Took lots of studying. I learned how to read price action, technical analysis, liquidity, balance, etc. I learned how to journal effectively to be able to learn from my previous trades and understand my trades and market better. I'm able to better identify targets versus just taking profit because I'm green or hit a certain percentage. From studying and journaling, I was able to develop a strategy that is a step-by-step. If X happens, then look for the next step. And if X happens, then enter. I learned to adjust my trading. When I'm off for summer, I can look at, higher frequency timeframes. But during the school year, when I can only trade the first hour of the open, I adjust the time frame I focus on and adjust the targets accordingly. Lots of time, classes, reading, studying, reflecting has gone from my day one to today, and I'm still continuing to learn. I mean, you can imagine, right? Like intellectually, all of you who are struggling with this problem could very easily do this. But when you don't, in the heat of the moment, right? Like trading is intense. If you have not taken time to at least acknowledge what is listed here, in the heat of the moment, that debt in your confidence is what's going to produce outside levels of emotional intensity. Start to go through this process, and all of a sudden, that debt gets a little smaller. There's internal stability. There's strength and integrity in your confidence. And you just kind of naturally feel more at ease because you know how you did it. Not just in your mind, but there's proof. You can see it. There's a little bit more strength and integrity to that knowledge. Okay. And we look at the next few parts here. The difficulties I encountered were learning from different people or groups and not understanding their strategies, or the strategies had low hit rates. From there, I would try to reverse engineer and learn and understand why. I like to know the why behind things so I can try to develop a more efficient way of doing something. I took a lot of losses, blew up lots of accounts, lost lots of money, dedicated a lot of time. I had to accept that I could only trade the first hour of the open during school year, and had to accept the way that I traded had to be different than when I was able to sit and watch the whole morning session. I kept pushing forward because I continued to learn and understand more and more. I was able to get through the roadblocks because I enjoyed learning from my mistakes. Every mistake I made along the way was a teachable moment. The other thing here is that there are things that you don't know, right? You start kind of like writing this out and you will create some insight that you didn't have before. And I know that this was true for this client. Okay, lastly, if you made some mistakes, what lessons you learn? In the beginning, I believed mistakes meant I was not learning or improving. But with time and reflection, I realized that trading is a long game, not a get-rich-quick scheme. Losses also forced me to look at my strategy and figure out where and why things were not working, getting stopped or not hitting my target. The losses and blown accounts forced me to be honest with myself and look inward, which led me to the psychology of trading part. Okay, so again, good validation for the process too, because like if you're doing something that's working, well then keep doing it. But sometimes you stop doing it because you're not giving yourself proper feedback. I can't tell you the number of traders who I've worked with who stop journaling. It works. Like they all know what they should do it. They do it for 3 months and they're killing it, right? Not just from a P&L standpoint, but there's just like clarity. They really feel like they're in sync with the market. They're just in a good mode. And then they get sick, they go on a break, whatever. They come back and they're like, probably don't need to do it anymore. And it's like kind of slowly fades away. They get into a slump. They come to me and they're like, all right, what's going on? And, you know, we start talking about journaling. Oh, yeah, no, I did that for a while. It worked great. Well, why'd you stop? Sometimes you stop doing things that are working because you haven't taken time to validate the fact that it was part of what led to your success. A plus B does equal C. But if you forget B, it's just like it happens so often. So again, this process can be really valuable, even if you don't have this problem. Really valuable as a way of providing some good reflection for yourself. All right, just for the sake of time, I'm just going to kind of go through this one quickly. But this is a more personal example from a very successful rugby player playing the national team in rugby. I was taken out of the Swedish national team in rugby for under 18 players. I played rugby for about 5 years and one of the best players in Sweden in my position. I played wing. You had to be quick. You had to be good at catching balls, throwing it to you at full speed since you were the last guy in line. In the beginning, when we were young, they put all the sucky players at that position since you could do the least damage in that position. And that was the reason I started to play there as well. But with time, I grew into the position and started to love playing there. You got to score a lot, and it was not as messy as other positions. Played for many years, played with many people older and more experienced than me. I think a lot came naturally since I was always athletic and a rough kid. But one important thing was that I really liked playing and had fun doing it. And the other thing was that playing with older men in the US when I was 16, I played the shit out of them and really bloomed out. Got better. Okay. Difficulties. Overcoming my fear of getting hurt, not being able to catch the ball, right? Fear disappeared with growth. And then lastly, did not put the time in effort in my rehab. If you want something, you have to work for it. I busted my ACL the first spring practice in the field, was young and indestructible, didn't go to the doctor, right? And so things got worse and worse. And so when I started working with this trader, right, there was an element of their confidence that just didn't really match, right? Very, we weren't successful. We weren't as successful as they knew they could be yet, but there was certainly like an edge in the market they knew they had. But there was like an inconsistency in their execution of it that was just odd. And it really came down to like not understanding that the dude was like really capable, right? I mean, to be able to become that good at rugby tells you that there's a lot of capacity. And does that guarantee success in trading? No, but it does give you a lot of conviction that you can do and be more in other places. And that was kind of what was undercutting their consistency. It's like they'd have a little bit of success and just didn't really feel a little bit of that kind of imposter syndrome, right? Really kind of feeling like kind of unstable, insecure, again, in a weird way. It's like, objectively speaking, I know what I've got here, but couldn't do it reliably. Okay. So last part here. So what I've just talked about is kind of reconciling the debt historically, but you can also get ahead of it and take care of what's happening in present day. So here are 3 questions that I would suggest that you are looking at on a daily basis. Okay, it's part of your journaling, part of your daily cool down. If you want to do it weekly, fine, but like it needs to be done regularly. How'd you perform? What'd you do well? What'd you learn? Right? Just very, very simple questions to ask on a regular basis. You spend 2 to 3 minutes looking at it. You will create those little pats in the back. More importantly, you're going to find the little parts that need to be fixed faster and the parts that don't need to be fixed. Because so often, we kind of forget, like, oh, wow, I've been making progress on this thing I've been working on, and I lose sight of it for a little while. All right, come back to it a few weeks later when it kind of reemerges as a problem, right? But when you have a more clear plan, right? What are you doing well? What are you learning? What are you working on? And how are you performing on that? It kind of keeps it top of mind for a lot longer. Okay? You're not going to just like randomly play whack-a-mole every day and like be measuring yourself on a variety of different things every single day. That doesn't make sense. Learning can't be that kind of random. So when you have, a bit more consistency in how you're measuring yourself, you're going to have more consistency on what you're actually working on and be able to get it to the point where it actually makes distinct progress rather than playing that game of whack-a-mole, which is certainly not fun. And the other side of this is you got to reduce your self-criticism, right? And I know this is hard. I have a client right now who has been working incredibly hard over the last 3 weeks trying to reduce their self-criticism. And it's brutal because you can be self-critical about the fact that you're still being critical, right? Just reflexively, you get pissed at yourself, but then you shouldn't. And no, it's a battle, okay? But the idea here is to try, and you can make progress as he certainly is, okay? Key thing here is like criticism needs to be productive, not destructive. That's how you. Like, I'm not saying don't be critical of yourself. I'm very critical of my clients, but in the right way, right? It's all about producing growth, all about fixing problems. It's not just this empty, negative, destructive cacophony, noise in your head that is basically just like an a-hole coach, a-hole manager that's not really actually helping. Right? So turn the harshness into learning and motivation, right? And do that consistently. And at the end of the day, I want you to be more of a detective, not a dick, right? Be introspective, be curious, be more of a researcher, not just having these empty expectations of yourself. All right. 2 more pieces of the puzzle here. New definition of perfection, okay? And the definition is that perfection is a target you can hit. Many of you don't even know what that definition is, right? And actually, throw out one more piece here. You could take time right now to define what perfection is or define what your expectations are of yourself, okay? And if you did that, you would understand the emptiness of them, okay? But let's just assume that we're going to go more conceptual here. The idea is that you can reach levels of perfection, but not for very long. As soon as you do, they're going to move, okay? Perfection is a standard that's going to continue to rise over time versus this mythical, illusory kind of perfection that just kind of continues to hang out and move without you really realizing it, okay? For those that are familiar with my work, know this guy, right? The inchworm. The inchworm defines what progress looks like because the inchworm is a bell curve, okay? Your current A game is the front end of this inchworm. Your current C game is the back end, okay? Your A game, the very front end of your capacity defines what perfection currently looks like for you. Very different from a 30-year veteran trader, right? Some of the presenters here at this conference from a trader 2 years in, right? Your current best, your current standards are very, very different, okay? So it's your individual bell curve. You cannot overnight become that 30-year veteran. Like it's not possible. You can't even acquire, years of experience in a day, okay? So your capacity, your definition of perfection right now is capped. I don't care what level you're at, right? Myself included. Can it get better? Hell yeah. But how's it going to get better? Right? Many of you only see the A game progression. You only see your best getting better. When what the inchworm shows us, okay, is that it's really more about your C game getting better first, right? So we look at this, right? C game moves forward, and that actually helps to shrink our range. So we're basically kind of less bad when we're bad, and that makes it a lot easier for us to perform well, right? When you're under the heat of and the pressure of trading, right? It is intense. You're in the most competitive marketplace in the world, right? Many of you have paid access to compete in the NFL, the Premier League, the PGA Tour. Do you have the 5, 10, 20 years of experience like playing this game before you even became a professional? No. I mean, you might have 2 years in. Like, if I was 2 years into golf playing in the PGA Tour, I would be puking on the first tee with nerves. I mean, it's like incredibly intense. Okay. So under that intensity, your C game becomes much more likely to be exposed. When your C game is a lot stronger, it is so much easier to produce your A game because you know that you can't be that bad. And when you can't be that bad, I'm not saying you can't be bad, but you can't be that bad. It's a lot easier for you to be good. Okay. And again, this is all relative to each other. Okay. So primarily, you want to look to reduce your C game before you look to eventually improve your A game. And that oftentimes just happens naturally. Okay. The like, how am I going to take my trading to the next level really gets produced when you're experiencing intuition and you're in the zone. And, you can get in the zone more consistently when your C game is stronger. And then your A game naturally gets to advance and you can reach new levels of perfection without actually really even realizing it. All right. So the last piece of the puzzle, as I talked about at the outside, is this removal of the scar tissue. So a lot of this has been, kind of identifying the aspects of your skills and experience that have kind of gone under-recognized, a little bit of change in perspective on expectations and perfection. But what happens when you actually have these old memories, these big losses, these big outsized blown accounts? Client of mine who's been, slowly drawing down his IRA for 7 years. And it's like, oh my God, I cannot believe the hole that I am in. And you feel like it's like this mountain that you have to climb out of. But like that puts too much pressure on yourself day in and day out, because you're trying to today, maybe today I can, escape it, right? Maybe today's the day. And this could be a big driver of FOMO. Right? Why you're constantly looking for home runs, because you're trying to kind of get out not just of the factual debt or the losses, but of the confidence ones as well. But to remove the scar tissue, we're going to adapt a tool. If you're not familiar with my work, I use a tool called the mental hand history. This is how we're kind of breaking down more normal mental game issues. But when you've got trauma, you got scar tissue, we have to adapt this worksheet slightly. Okay. And so here we go. Step 1, describe the painful memory in detail, including vivid sights, sounds, sensations, as well as identifying the most painful part of it. Okay, so big blown account. Most painful part was having to tell my wife, right? Big blown account, or some big missed opportunities. The most painful part was just going on Twitter and seeing everybody celebrating, and here I was, kind of holding nothing. Explain why it makes logical sense that you're still holding on to this memory. Why? These experiences are to be learned from, right? Failures are not paralyzing they're not paralyzing when you have learned from them. Mistakes, losses, right? When you learn from them, but okay, but why are you still holding on to it? I can't forgive myself, right? I should not have been so stupid. I knew this was going to happen, but I didn't trust my intuition. I cannot forgive myself because I knew I should have closed. I knew COVID was going to have a huge run. I just was too chicken shit to get in quickly, right? When the Fed steps in, right? From your answers in step 2, define what is flawed about your perspective in that time or now upon reflection, right? So right? There's reasons and rationale and logic for why this memory is still sticking around, why you haven't learned from it. But there's something flawed there about your perspective, right? Maybe you have hindsight bias. Maybe it actually is due to the perfectionism, right? And the expectations you have of yourself. Maybe you hate losing. Maybe you feel like a failure and it's more of a personal issue. Okay. Now you're going to come up with a correction of that flawed logic, right? And what you can learn from this memory and use productively going forward. Okay. And in a way, this begins to kind of morph into kind of what happens in that perfectionism worksheet where we're uncovering the value and the knowledge and skills beyond the headline. So here you got the headline, big loss. You know, in the perfectionism worksheet, we've got headline, big accomplishment. In both cases, we're trying to unearth the value, the skills, the knowledge, experience that it can actually help you, right? Whether it's from a positive experience or a negative experience. Okay? And the last question is a bit of a bonus, right? How is that correction correct? And how can that lesson help you? Okay. So again, this worksheet's freely available on my website. And here's one example. Okay. I first attempted day trading in the mid-2000s, about a year after bouncing from mechanical strategy on equities to discretionary pattern-based equity trading, then ultimately to futures. I entered a natural gas trade on Friday afternoon. These were pit-traded contracts, and the trade went in my favor quickly, and I decided to hold the trade over the weekend. I used up all my margin to hold this trade, which was already a terrible decision. This particular weekend was the weekend Hurricane Katrina hit New Orleans, which was what was expected to be about a 4K winner, ended up turning into a 40K loss when the electronic markets opened Sunday evening. Ultimately, I had a bit of luck when the price had a rather large pullback coinciding with the pit opening. When I was able to close the trade, I attempted to continue trading for several months, but never effectively processed the loss or margin call mentality. It would be well over a decade later before I even contemplated trading as being something I could possibly try to do again. And while I don't think of this event consciously, and this is a key point here, sometimes these things are just in the back of our minds, like consuming resources and adding to emotional volatility. You don't even realize it. That at least I can notice. I feel like it's feeding confidence and fear issues, at least on the subconscious level, as I'm acutely aware that a single bad decision could derail everything. So that's kind of what's happening in present day. Like there's this like underlying fear that at any moment the shoe could drop. At any moment, Alex Honnold is going to drop to his death. At any moment, you are going to fall. Right. And yeah, it can be due to that accumulated debt. It can also be due to some painful memories. Okay, why does it make logical sense? You're still holding on to this memory. It was traumatic, right? Including the study time and backtesting plus live trading. I invested about 2 years of my life into something and failed, completely altering the trajectory of my life. Okay, what's the flaw here? While I invested time and effort and failed, that time was haphazard, and I never stuck to a strategy or a system. I was not actually prepared for the risks I was taking. I was in over my head and I was gambling. It's hard realizations, but when you come to them, when you can actually really be honest with yourself at that level, well, then you can start to break apart the scar tissue, because I can promise you this trader never gambled again, never felt like they were in over their head again, and never realized, and now was able to see that a single bad decision today was not gambling. So then there was no risk of the mistakes of the past happening again. I've learned a lot over the years since this happened, while only very recently have gotten close to a more clearly defined strategy. I've been following a singular strategy path and trading a single instrument since restarting this journey. I've never held a trade overnight and have zero plans to ever do so, and don't see any reasons I would ever attempt it, deviating from that. While I've had issues with moving stops and putting on trades with unclear risk, those mistakes are increasingly infrequent, and I believe were more related to prior lack or more clearly defined strategy. I now have years of experience that I did not have in the original trauma. My strategy, while only recently becoming clearly defined, accounts for the issues that led to the blow up. By following my rules as they are today, no single decision can remove me from the game. Right? So again, this is not necessarily applicable to all of you, but if you find it, man, it can really start to free some things up and maybe help to explain why you have some asymmetrical emotion, right? Sometimes you'll just react to a loss, or you'll react to a missed opportunity in a way that just feels so out of proportion. And sometimes it's because of an accumulation of past losses or missed opportunities or, failures that just, not just produce a lot of emotion, but you're just kind of holding on to this emotion, almost like a pressure cooker, that when it explodes in ways that are asymmetrical. All right. So what was your biggest takeaway? Throw your answers in the chat. Was it the accumulated debt? I think sometimes a cause of a weakness in confidence that isn't really talked about or known. Is it ways of kind of reevaluating your accomplishments? Is it this new definition of perfection, or maybe the insight that you have some trauma, some scar tissue that needs to be addressed? All right. As I mentioned before, you can download free worksheets. I've got many of them, not just the ones that were mentioned today. jaredtendler.com/worksheets. Other resources, if you're interested in more of my work, Richard already mentioned the Trading Psychology Masterclass, which is on TraderLion. It's a very, very robust course. If you want to kind of walked through my step-by-step system for trading psychology, this is a very robust course for you to do that. We're going to go through all the different steps of my system in very, very great detail, give lots of experiences of how to go through each of the tools, so there are kind of really no uncertainties around kind of how to actually do it. And I would say Mental Game of Trading as a book, if you haven't read it, certainly pick it up. You can kind of, if you don't want to, if you're more kind of the hands-on learner, you don't have to read the book cover to cover. You can just kind of jump right into the masterclass, because it does cover a lot of the material that's there. And we did produce it in a way that was very different from what's in the book, and kind of walks you through that. I mentioned it to you earlier. I do have a community of traders that I'm working with. It's called the Mental Game of Trading Live, right? I host these strategy sessions, kind of 1 hour opportunity to discuss a particular topic, go in detail, get feedback, effectively getting coaching from me. There's 3 of those 1 hour per month. You can post worksheets, you can post questions on the community, in the community. You can connect with like-minded traders and form your own accountability groups. And there's also a knowledge base where there's pre-recorded content on a wide variety of topics that you can access on an on-demand basis. All right. Thanks to TraderLion and Richard for hosting me today, and certainly wish all of you well in your trading journey. And if you want to connect with me in any way, you've got the access to do that here.
Wonderful. So first of all, Jared, thank you very much for putting that together. I think my personal takeaway was to add to kind of my post-market routine, listing those accomplishments a little bit, what I did well, to just kind of build that confidence, consistently. I think that's a really good one. Now for the Q&A, I've got some questions planned. If you guys have any questions, list them in the chat, please. But first things first, kind of taking a step back, way back to the beginning of your presentation, Jared. Sorry to go all the way back there. But I wondered if, in your experience working with traders, you talked about traders who are, they're grinding every weekend, they're trying to back test for 8 hours, what have you, and they just kind of really need to take a step back and focus on recovery. What are some signs that traders should look out for that maybe aren't as obvious as that situation, but are signs that, hey, take a week off, take a break, take a step back, focus on other hobbies for a little bit, and then you can come back refocused with a clearer head to work on your process?
I say the easiest one is like if you've kind of plateaued, right? If you're progressing, right? If the work that you're doing every weekend is producing some tangible improvement, maybe not week over week, because sometimes that can be hard to occur with the inconsistency in the way things play out with trading. But if weeks over weeks, month over month, like if you can see the trend line is like clearly progressing, then it's a judgment call, I think, whether or not it's like kind of true burnout. But generally speaking, if you've plateaued, that means you're just making the same mistakes. You're kind of stuck in a rut. Maybe things are actually factually worse. Your performance could factually be really kind of in your C game, and you can't really get out of it, right? You need energy to produce your A game, right? Again, if we're kind of recontextualizing this definition of perfection and what expectations and goals are, you cannot expect your A game. Your A game is earned. It's earned primarily through having the right energy, having the right preparation. And if you don't have enough energy to produce your A game, and you're really kind of stuck in this like B game cycle, C game cycle, then yeah, you actually can really benefit from taking that step back and having a weekend off. I'd say the other one is if you've gone like months without time off. When we're talking about, just to provide a bit of an analogy here, right? Elite athletes, elite, let's say power lifters, right? They are generally, the Michael Phelps example, I think is an atypical one. Like, he was freak athlete, Olympian. But for most elite, most very successful athletes, powerlifters, like there's periods of expansion and consolidation, kind of like a stock. So if you haven't given yourself a chance to kind of consolidate a little bit with time off, with a little bit of rest, with a little bit of kind of deeper reflection on what you've done over the last 3 to 6 months, then I would suggest taking time off just for that reason. I mean, I think that every trader should take 4 weeks off per year. And ideally, like once a quarter, you're taking a week off. Now, most traders, especially institutional traders, will never do that. And I understand that, right? Because the pressures are so high. But when you think about the value of being at like a peak level of energy, peak levels of clarity, focus, intensity, and the value you get from those steps back where you have some insights and are able to kind of have better sensation of the market, right? I didn't mention it, but I have a free intuition ebook on my website. It's also part of the TraderLion masterclass. But like if you're accessing intuition reliably, like what's the value of that compared to kind of middling and being stuck in this B and C game cycle? Like you could be making money there, but you might be missing out on some really, much higher level of returns consistently. So I'd say generally speaking, if you're stuck, take a break. If you haven't taken a break in a long time, take a break and just see if it actually produces some value.
Yeah, and I was actually kind of thinking about this a few weeks ago. I like went over my trades and this kind of started the thought. But on Mondays there's often a lot more emotion. Everybody's hyped up for the week. There's gap ups, gap downs. And I noticed in my trades, I would get stopped out more often on Mondays than other days. And that coupled with maybe building in more recovery into it, I've flirted with the idea of just taking Mondays off and saying, hey, my trading week is a 4-day week that starts on Tuesday, and kind of dedicating that Monday to just monitoring current positions and not really looking to enter anything else. Um, for kind of those two reasons. One, noticing getting more stopped out, but also just building in more recovery time and seeing how that could benefit me. So I haven't decided to do it, but maybe I'll experiment with that in the coming weeks.
Just to finish up, sorry, I
Yeah,
think
go
the
ahead,
key word you
please.
said there was experiment.
Yeah,
I think if you as traders can kind of look, and you specifically can kind of look at the whole of like, you are researching and experimenting, like not just in terms of your style and edge, but also your process and
yeah,
routines. And yeah, when you get to a point where you can, experiment with like your week and what the week looks like, what like factually speaking, Richard, like what is the downside for you taking 1 month, like 4 weeks, and experimenting with taking that Monday off? I think you're guaranteed to learn something.
right,
And it might be that it's not worth it. In which case you can check that box off and you can move on confidently knowing that you have a 5-day work week and maybe there's some adaptations you make to Mondays. Cool.
right.
Okay. I can confidently do that now. But maybe you find something of distinct interest, of distinct value that you could not have predicted beforehand. Again, I think the experimentation, if you just kind of define the period, sometimes we just like flirt with it and maybe like try it like 1 week. It's like, that's not a big enough sample size. Like do it for a month. I think there's no downside other than maybe some short-term P&L that you might miss out on.
Yeah, I think you've convinced me to try it, so I'll
All
give it a
right.
shot. Let you know what happened. Um,
Cool.
Also coming back to kind of the very beginning when you're talking about people come into trading thinking they can be in the arena right away, have success, especially if they're high performance in other fields. We did excuse me, we did a class where with John Boyk, where we looked at some of the top 7 market wizards from the past 100 years and kind of their journeys, and every single one of them, despite ending up being top traders who can make millions of dollars, they all needed around 7 years or so to learn their system and just break even. And that 7 years, that's not like a hard and fast figure. It's not like you hit the 7-year mark, you're going to become a market wizard. But what that means is even the top traders who are giving it their all need to work on this, work on their C game, and gradually improve until they get to that level. So having the expectation that in your first year you can do as well as these, um, just again, that's a little bit unrealistic, and just focus on the process, focus on the goals versus the expectations. I like your point there. Um,
Yeah, just to
yeah,
provide
please.
maybe a little bit of analogy here, like a rocket ship uses, I think, I mean, it probably depends, but like at least the space shuttle use like 50% of its fuel in the first like 50 meters, 50 yards. It's like an
Yeah,
insane amount of fuel was used to just create that momentum. But again, like that momentum doesn't mean that they've created escape velocity, right? To be a market wizard, to be like truly exceptional, you have to have enough sustained momentum. So I would say that it was like 7 years of like kind of building the energy, that momentum to be more internal, right? Like
yeah,
so many traders go through big peaks and valleys. I think because they kind of lose sight of things when things are going well. And then when they're struggling, they kind of are overreacting to the struggle and not kind of keeping that like more consistent process. I don't know what those market wizards process were, in great detail. I don't study it, but I do know that the like the continual learning should be there regardless of short-term results,
yeah.
right? It's like whether you're struggling or succeeding, if you have consistent process, right, that is going to generally produce more reliable results and outcomes long term.
Yeah, at TraderLion, we kind of say it, approach trading as a student, and like always have that student mindset where you're always learning. If a trade works, great. What can you learn from it? If it goes poorly, great. What can you learn from it? You know, a mistake is only a mistake if you keep making it over and over again. If you don't learn from it.
100%.
Um,
Yep.
um, One more thing I want to mention. Excuse me. I think this kind of adds to a lot of the high expectations, especially to traders starting out, is the social media component, which you touched on. On social media, you're seeing traders who have been doing it 20, 20 years, multiple decades, whatever. They're posting 100 plus returns on a monthly basis or yearly basis, whatever it is. But they're just at a different point in their journey than you. But new traders still are comparing themselves to that. Why can't I get that? It was possible. Why can't I do that? It's just kind of those expectations, um, and just being honest. Hey, I can learn from their process. Take a look at their feed. Take a look at resources that they have to learn towards that. But it's going to take time. It's going to take effort moving that interim along for years, decades, even to get to that point. So I think social media it's very noisy, and I think it's a tremendous resource, but also you have to be aware that it can skew your expectations, and it can be a negative as well.
Yeah, there's a lot of overconfidence that people bring into the markets, and there's a lot of, I think, misaligned expectations, which is that it should be a place where I can make easy money.
Yeah,
And when you have that expectation coming in, then yeah, you're gonna kind of compare yourself to people that are really kind of incomparable to you right now, other than the fact that you both enter trades. That's not really the comparison that you ultimately want to be making. So yeah, I would say 100% right. But I always kind of look at like if you're somebody who is swept up in social media in a negative way, then you really have to examine like your motivations and your expectations of yourself first and foremost, and look at the problem with social media as being more of a symptom of that rather than
hmm,
it being the problem in of itself. Because at the end of the day, like they're just a bunch of people who are coming in and utilizing this tool in the wrong way. And the question is why? And the answer to that question is really helpful. And maybe some of it's been answered in this presentation today.
yeah, for sure. And also you went through those two worksheets, which were great. You mentioned the goals worksheet. I don't know if you could bring that up quickly and maybe walk through that quickly, or you could also just describe it. Because I think that'd be a good resource as well, and that can also be found on your website. I know, as a free download.
Yep, and it's also part of the TraderLion Masterclass.
Hmm.
Yeah, so here it is here. Um, Again, in a way, this actually does kind of fit with the presentation because we're firmly setting goals, not expectations. A, B, we're looking at the process goals, like the how you're actually going to attain them. So results goals can be, right? I want to eliminate tilt this year, or it could be I want to make 100K a month. It doesn't matter what the I mean. Again, aspirationally, I encourage my clients to aim as high as they want. I don't get to decide what that is, but I do want the right perspective about what they're aiming at, and then to have the right, general sense of time frame for when to achieve it. But the why behind your goals is really important, because why you want these things is going to help. Sorry, identifying why you want these things is going to help in those moments where you're tested. If you come into these goals blindly expecting them, then you're not really going to be prepared for those setbacks or those more difficult days. And the why is going to kind of keep you motivated, keep you kind of working. The process goals, right? Kind of like, okay, if you want to eliminate tilt, how are you going to do it? You want to achieve, 100K a month or 100K a year. Like, how are you going to do it? Like, what are you doing in an improvement sort of way, right? Your C game, right, is what's expected, right? The aspects of your trading that you've already kind of mastered from a technical standpoint, from a research standpoint, from a process standpoint, like, they don't need to be part of your goals. The goals are for the things that you're learning and trying to improve on. So how are you going to scale up? How are you going to increase your profitability this year, right? It might be around, just executing your strategy, as mechanically as perfectly as you can, right? Not taking any discretionary trades for the first 6 months of the year. Okay, that could be a goal. And then lastly, you're looking at the problems you'll likely face and beginning to establish a plan on how to do that. And sometimes going through that process actually helps to change some of your process goals, because as you start to realize, like, oh, well, I am at risk of burnout, right? So the problem you were talking about earlier. Well, then maybe one of the goals is to take more regular rest, and or the goal is like to research for the first 3 months of the year, like how much rest is optimal, right? And sometimes that means overdoing it, and it's an okay mistake, quote unquote, to make, because of what you're going to learn from it. So again, I think the process of kind of going through all of these different steps really helps to create a robust approach to trading, and then ultimately it helps to reinforce a robust approach to your own kind of goals versus expectations.
Perfect. Well, Jared, thank you again for your time, for putting all this together. We'll have the links to those resources in the chat. We'll drop them in right now. Is there any kind of final message that you want to leave everybody with today, either regarding the presentation or just trading or trading psychology in general?
Yeah, I guess I would just aspirationally say that there isn't a problem out there that can't be solved. You just have to be willing to look, and sometimes look in ways that you're not used to. So, whether or not you have this problem or others, if you're struggling and not able to kind of get out of it, I just encourage you to look, and to look without judgment, because I think, especially in the mental and emotional side of trading, mental and emotional side of performance, it still can have a negative connotation to it. Okay. And it's just one of those things that you put the time and effort in, there is distinct value here. But I think sometimes people are gun shy to do it because, there's this perspective that, like, trading is all about psychology, and trading is 90% psychology. And the reality is that that's not true. Trading is first and foremost about the X's and O's, right? Your execution, your strategy, your system. That matters most. Trading psychology comes in primarily, at least the way that I approach it, in helping you to make the most of your strategy and system. Yes, there are trading psychology perspectives around, kind of really molding your personal psychology to your system. And I respect and appreciate that. But from a problem-oriented perspective, right? You can solve any problem. You just have to spend a little bit of time looking, and it can be difficult and confusing, but there's lots of resources out there, including mine, that can help. You just got to be willing to do it.
Excellent. Well, Jared, thank you again. I always learn something new talking with you, so appreciate it. I'm sure everybody watching did as well. And if you did, make sure to check out Jared's resources for additional information, as well as leave a like down below, and donate to St. Jude's if you found this valuable. Or as Jared said, if you don't find it valuable, it's still a great cause. So go ahead and do that. So Jared, thanks again to everybody watching. Thank you for tuning in, and we'll be right back. Take care. All right, welcome back, everybody. Welcome to our next presentation. Really excited for this one. Himanshu Sharma is a full-time trader, CMT level 3, and he'll be giving a great presentation on RRG charts. Definitely a very fascinating concept and a nice way to identify relative strength in the market. So Himanshu, thank you so much for being a part of this, and looking forward to diving right in.
Yeah, thanks for the opportunity. So RRG charts is basically relative rotational graphs. It's a unique way to visualize relative strength. And as you have introduced about me, I have done my engineering from Delhi Technological University. Thereafter, I was working for a brief period with Government of India here. I resigned and then I completed my CFT, MST, and CMT. And I'm active on Twitter with this profile. So everyone basically knows about relative strength now. It's a very popular topic. Relative strength is just a outperformance of a security compared to a benchmark. Now, benchmark can be, if you are sitting in US market, it can be NASDAQ or Dow Jones or SPX. Here in India, we compare it with our own benchmarks, Nifty 50, Nifty 500. So the period over which you compare the outperformance, it can be 1 month, it can be 3 months, it can be 6 months. Usually it is said that 6 month to 12-month comparison period is a bit late because you miss out the move of a stock when it starts forming a base and then it breaks out. So in fact, there are a lot of research papers written on it that why 1 to 3 month period is a pretty fair time, because anything less than 1 month can catch a lot of noise as well in your analysis. So there are various ways to measure relative strength. It can be visual analysis, like you compare maybe Nvidia with Apple or Alphabet or Google manually, or you take ratio analysis, like you take a ratio chart of gold to silver or silver to any other commodity, and then you see for where the strength is right now in the market. Now, you can also use RS rating. Now, most popular platforms are providing you with relative strength rating, where they rank stocks in the descending order of their strength. And using that, like Sir William O'Neill, for instance, mentioned in his book that every average winner of the American market was having relative strength of 87 or higher. So that is another way to visualize relative strength in terms of RS rating. So it's a time-tested methodology to pick the winners. Now, why is it time-tested? Sir Jesse Livermore used it. Sir Nicholas Darvas used it when he's mentioning about I'm trying to find the stocks that resisted the decline. So in a way, he's also talking about stocks that were standing strong during the baby bear market of his period, right? So for instance, this is a basic chart of our real estate index compared to our benchmark Nifty. Now, that's a ratio chart. So what it tells me is that real estate as a sector was underperforming for a very long period of time, since 2007, as this ratio chart shows. And then it formed a base, and now in recently mid 23 or early 23, it started outperforming our benchmark index. So we gonna get to know that money is now flowing to the real estate index. Now, that's one very easy way to visualize relative strength. You just go in with, maybe you want to compare Apple compared to NASDAQ. So you just take a ratio chart of Apple to NASDAQ. But there are certain bit of issues with relative strength as a tool as well. Now, it is an easy process if you have, let's say, 2 or 3 securities to compare. But it becomes very cumbersome when you have 10 securities to compare. You can't take ratios of each and every security in a pair, because 10 means 45 times you have to run your ratio scan. Also, secondly, the problem with RS number is that, for instance, a biotech name or a platform business can go in RS rating of 97, 98, 95 level. But for an infra name, it is almost, sometimes it becomes impossible to reach up to that level of 98 or 99. So when you run RS rating scan on any platform, you have to see that sometimes certain sectors have their inherent strength, and stocks are very attractive in particular sectors. So investors flock in and the relative strength rating reaches 95, 97 level very easily. But for an infrastructure kind of stock, or maybe a mining company, reaching to that level of 97, 98 becomes very difficult. So what happens that if you are comparing infra with a biotech name or a platform business, it is like comparing apple to orange because you do not have a standard benchmark for both of them. So this is one problem with RS rating as a tool. And also, for instance, if I compare RS rating of, let's say, two stocks, one is 82, another one again is 82. But for the first one, the RS rating declined from 93. For the other one, it increased from 70 to 82. So in one case, the line is moving up. In the another case, the line is moving down. So merely by looking at the RS rating, and if you are just running the scan, so you have to manually go through that process of like, okay, for both the scenarios, you might be having a view that RS rating is same, but for one it is declining. For another one, it is now just started to move up. So this is one point. These are certain areas where RS rate strength as a tool has some limitations, but it is in fact a good tool in a way that it helps you in your bottom up approach. It takes you to the strong sectors. Once you have a list of stocks, let's say 150 or 200 names passes through your screen, and suppose 25, 28 names are from one particular sector, you get to know, okay, this sector is strong. So it helps in a way to have a bottoms up approach. But as an investor, if you can combine it with some sort of tool that gives you a top overview of stronger sectors as well, then you uh, complete your study as per what Sir Stan Weinstein also mentioned, that when you have strong sector from a strong group, the probability is very high that your stock will be a big winner. So here we are now trying to merge our bottoms up approach with the top down approach by using RRG charts as a tool. So RRG is a brainchild of Sir Julius D. Campaner. So he has been given a lot of lectures on this topic. So his basic thesis was that he was giving sell side calls to his clients or buy side calls, and he was saying that in advisory market, what happens is that you have huge pile of papers coming on your desk every day, a lot of mail. So it becomes very cumbersome for an investor to look for what is actually actionable. Right. So this happens that we have a lot of subscriptions and we are receiving like 100 plus emails every day. It becomes very difficult for us to go through that entire sheet. So if there is some way that you can uniquely visualize the relative strength on a chart, and within 2 minutes you get to know, okay, this sector is strong, this sector is weak, and then you combine it with your RS rating study and pick up the stronger stocks from that particular sector. So it is in a way advanced version of relative strength. It takes into account now not only the RS values, we are now here taking into account at what pace the RS value also changes, right? So if RS was for a stock moved from 60 to 80 in a month, and for another stock it moved from 60 to 80 in 5 months, then the former is stronger than the latter one, because here we are also taking into account the speed at which the RS value changes, right? So it is a very quick visual tool. So we are now comparing all the RS value compared to a standard benchmark. So here the benchmark can be Dow Jones, or it can be Nifty 50, or it can be a Korean index, or it can be CAC or DAX or whatever. So here we are comparing all the sectors to a standard benchmark, and we are also taking into account the pace at which that RS value changes. So how is it how it becomes very simple is that we have 4 quadrants here, but this is how RRG chart looks like. So we have on our horizontal axis the RS ratio, and on the vertical axis we have momentum line. In the center point, we give it the value as 100, 100, which means that RS ratio and momentum coincides here somewhere in the middle point, 100, 100. Now we have 4 quadrants: leading, weakening, lagging, and improving. So let's say something is in a leading quadrant, which means that RS relative strength is very high, and also the momentum is very high. So this stock or particular index is in an uptrend. Now, what happens when something is in an uptrend? It either goes through a correction or it reverses the trend. So we don't know whether it is a trend reversal or is it just a minor correction. So what happens in both the cases? First, momentum declines. So when the momentum declines, RS ratio initially is not impacted. Maybe the stock will stall somewhere, or maybe it will start its correction price wise. So in both the cases, momentum declines. which then brings this security or index from leading quadrant to weakening quadrant. Now, once it moves from leading to weakening quadrant, now, if it is a trend reversal and the stock further loses steam, then this declining momentum value now will start impacting relative strength as well. So RS will also start decreasing, and this stock or index will move from weakening quadrant to lagging quadrant. Now, officially, it is now confirmed that the stock or an index is in a downtrend. So now, there was another possibility that if anything moved from leading quadrant to weakening quadrant, where in the scenario momentum declined, but RS was not impacted, in case the momentum comes back again in this particular sector, it will move back from weakening to leading, which signifies that it just had a correction in a running uptrend. So this was not the start of a downtrend. So once something moves from weakening quadrant to lagging quadrant, we are now sure that it is now in a downtrend, and it might then form your what you call as stage analysis. Like it can go in a very long base formation process, just like every bad thing comes to an end. So again, you'll see when accumulation starts in the security, the momentum again increases and RS value still stays the same. Now, if momentum further picks up pace, then RS value will also increase, and this sector will move from improving quadrant to back again to leading quadrant. Now, if it was just a bounce in a downtrend, then momentum will increase, but for a brief period of time because it's just a bounce. And once the security loses steam, it will fall back again in the lagging quadrant, which means that it was just a bounce in a downtrend. So this is how any stock or index completes its cycle. It moves from leading to weakening to lagging to improving. But there can never be diagonal movement because momentum has to decrease first or momentum has to increase first. So security can move from leading to weakening, back from weakening to leading, or improving to lagging and back to from lagging to improving. So that's how. So what I have narrated is this, that in leading quadrant, we are in a relative uptrend. Now, once momentum levels off first and it declines, the sector moves from leading to weakening quadrant. Now, this is still in an uptrend, but momentum is declining. So we are not sure whether this is just a running correction or the start of a downtrend. Now, if it is the start of a downtrend, the momentum, the declining momentum, further pushes the RS ratio down, and the sector moves from weakening quadrant to lagging quadrant. And now from here, lagging quadrant, just like everything, as I mentioned, that every bad thing comes to an end. If the momentum again picks up pace, the sector moves from lagging quadrant to improving quadrant, and that's how the cycle completes. So if I take an example of this is our real estate now index, and that's what I was showing you a few slides before, real estate as compared to our benchmark Nifty 50. Now, let's visualize on RRG chart how it helps us in picking up this index much earlier than even the RS rating. So if you will see here on the right-hand side top corner, this is the line chart of the real estate index, right? So as of now, on last year, 2nd January 23, the index is in a lagging quadrant, which means that momentum and RS both are pathetic as of now. And if you look at the chart, it has now started to come down because it is in a very, very long base formation so far. So once I move few weeks ahead, 13th March, just 2 months later, it start moving up. So that means momentum increases and RS ratio is still the same. So relative strength is still the same. But if you look at the chart, still the level is going down. The benchmark index, the reading is still going down, while my chart shows that now momentum is leveling off. So momentum is declining. So it moves from leading quadrant to improving quadrant. But I'm not sure here, maybe aggressive investors will be start thinking to take some position or do their analysis. But conservative investors will usually wait for some more added bit of confirmation. So because we are not sure whether it is just a bounce in a downtrend or just a start of an uptrend. So as we move further a few weeks ahead, we move from January to May 20, the index has bottomed out. And now the index as a whole on RRG chart moves from improving quadrant to leading quadrant, which means the increasing momentum value has also pushed the relative strength higher. So now I can be sure that those stocks that are passing through my bottoms up approach RS scan filter rating from any platform, I can see here the real estate sector is getting stronger, and I can merge both the things together to come to improve my stock selection process. So now I'll be picking up some stronger stocks from real estate sector vis-a-vis other sectors that are in lagging quadrant. As I move further few weeks ahead, you'll see on May 29th, now it is a confirmed uptrend. Now, if you look at the chart here, we are having a very long base breakout. So it's some sort of a very long base, like roughly around, I think, more than 1.5 years. So we have a very long, in fact, the breakout has not yet been confirmed on the chart, but RRG chart shows that it moved all the way from lagging quadrant to improving quadrant. So in fact, many stocks, if I tell you, they moved up 4x, 5x till now, since this move came from lagging quadrant to improving to leading quadrant. So if I move further few weeks ahead now, here it was in an uptrend. Now what happens? In May 29th, it is an uptrend, leading quadrant. As I move further few weeks ahead, 28th August, the sector again lost some momentum, but RS ratio is still the same. So now the question arises is that, is it a downtrend or merely a correction in a running uptrend? Now, then we are usually bullish momentum continues for 18 to 20 months. That's what I have observed personally. If a sector stays in an uptrend, it usually stays for 15 to 18 months. Now, some stocks will pull back a bit, or they'll form, or they'll level off, or what do you call it, as drift to the right hand side to give you least risk entry points where your stop losses are less than 5-6% over there. You can build a bigger position size with lesser risk. Now, is it a downtrend or merely a correction? If we move further weeks ahead, so it again took a turn. So what happened actually? Momentum lost some steam, but RS was still very high, because if you can see, RS is still above 100, which means that relative strength value is still very high. So all these charts are from stockcharts.com. Now here, if you will see, it took a turn once again back to the upside, which means that we just had a correction in a running uptrend. Now, if I move further few weeks ahead, so that was confirmed that the sector is still in an uptrend. It was just a running correction, which in a way for an investor gives you an opportunity to add more of your position when you're holding a stock. For a trader, if you think like you have captured a bigger move on a bigger position size, maybe you can lock in some gains and move to another sector that is moving to leading quadrant or ending its correction. So there are multiple ways to play out using this RRG chart. Here we are very closer to the top-down approach and picking 3 or 4 top sectors of the market to refine your stock selection process. So as I move further ahead to 12th February 2024, you will see again we saw the momentum loosening its value. But if you look here, we have pretty much moved from 14,000 level to 20,000 level. So that's a big move. I mean, a 40-45% move at the index level only. And if you look at the individual stocks, they were up almost 200-300% by now. So it's just 1 year and 1 month. So we are 13th into the 13th month as of now. So again, we have a correction so far in the index at the index level. So now this is where we are standing last month, 21st May. It came all the way down, momentum lost value. And again, you will see here, the momentum again, but there was no impact on relative strength as a value, right? So that's where it helps you to identify whether the stock or the security enters the downtrend or it is just a running correction. So you can in fact add your own portfolio stocks in RRG chart as well. Let's say you are holding 8 or 9 stocks, so you can view your portfolio in a RRG format. It will show you all the 9 stocks. And you can, if you're an investor, you can just put a benchmark, whatever you prefer, and select weekly movement. So weekly, it will show you the movement of your portfolio. So it helps in a way that if you read a research paper in 1993 by Professor Narasimhan Jagdishan, he wrote Returns to Buying Winners and Selling Losers, in which he mentions that if you just do one exercise of cutting your losers short and adding on to your winners, your portfolio performance will drastically improve because you are cutting down your losses and you are not allowing losses to work geometrically against you because risk and reward is not proportional to each other. So here we are now still sticking to real estate stocks. So there are multiple ways for traders and investors to play out. Now, if I move now, this is the scenario of just this week. So as we discussed now, that it was merely a correction in a running uptrend. So if you will see, the index has again moved back up to the leading quadrant. And during this move of 14,000, from the 14,000 level to the upper level, we will see here that now we have just a running correction in an briefly in an uptrend. So that's how RRG chart looks like when you put 15-20 ETFs or 15-20 sectors and plot them against a benchmark. That's how the picture looks like to you. And if you don't have to spend a lot of time analyzing this, because that's what I was saying, you don't need a lot of emails or printed reams of paper. You just need your 2 minutes visualization exercise. Just open one RRG chart, add some 10-12 ETFs on it or 12-13 sectors on it, and you can easily gauge that which sector is leading or which sector is weakening. Now, coming back from to your RS rating scanning process going on simultaneously, now you can filter out the stocks that are in from a sector that is lagging in nature. So whatever, now that's a field here. Now we have different set of players playing out on RRG chart. So a contra player or a contrarian investor or someone looking for value, he will be picking something in lagging quadrant where he says that market is not seeing this stock or index as of now, but this may have some value. So let me do some intrinsic value calculation. Let's have some margin of safety. He will be picking some stocks maybe from this sector. Now comes the conservative investor. He'll say that, no, I need some added bit of confirmation. So let the sector move to at least improving quadrant, and then I can see for that, is it the right time, whether the stocks are entering stage 2 or they are still in stage 1. And now here comes the ultra conservative investor. He will be waiting for the stocks or the index to come to at least the leading quadrant, because here you have the maximum confirmation. So probability of failure is much diminished as of now. So now you can build your position around when the sector moves from improving to leading. So here from your RS rating screen, you will have, let's say, around 5-7 stocks from this sector. So you can either have a basket approach where you are holding 4-5 stocks, or you can just go with one good stock with a good position size. So multiple ways to play out. And some traders will be just looking for pullbacks in stronger sectors. Now there are many financial market participants. They might have missed a move in a sector and they think like, oh, I have missed the bus. But later on, you'll see the stocks and every sector goes through correction. So these corrections are good points where you can add to your positions, that, or maybe if you have missed out on to something, you can hover around these names and you can add to your positions in your portfolio. So here you'll see many sectors, they are ending the correction. So you can use RRG for commodities, you can use it for cryptocurrencies, or maybe you can use it for your portfolio level. Or if you can add 10-12 ETFs in it, and you can have a broader overview of the market and combine it with RS rating. So that's what I explained. End users can be so many. They can be traders, they can be investors. So everyone has their own style of using RRG charts. So that's a unique way to visualize relative strength. Now, again, I said there cannot be any diagonal movement, because either momentum has to decline first or momentum has to increase first. So how RRG is useful over and above RS rating is that it also takes into account the rate at which the RS rating changes. So that's how RRG rating helps us. So thank you very much for your time. I mean, this was about RRG charting. So if there is any question that I can address to, please feel free to ask.
Yeah, let us know your questions, and I definitely have some to start with. First of all, thank you very much for the presentation. I love unique visuals that help us interpret data in different ways and help us see things that we might not just see looking at the raw numbers like RS ratings. So this is excellent. To start with, in your own personal kind of trading routines, how often do you check these RRG charts? And what's kind of your process like? Do you like doing it at the industry level, or as you mentioned, looking at your portfolio and maybe different, watch lists of stocks that maybe you're focused on?
So firstly, I'm trading only stocks that are in stage 2 or what you call in an uptrend.
Yeah.
So what happens now, I'm looking for the top 3 or 4 sectors only, not beyond that. So if I'm looking for top 3 or 4 sectors here and my RS rating scan from MarketSmith India, I'm using as of now MarketSmith. So RS rating scan pops up like roughly around 150, 200 names, which pretty much stays the same. So I combine it with RRG approach. I pick up the stocks only from the top 3 or 4 sectors. And as I said that once a sector comes to a leading quadrant, I'm pretty much sure that for another 10, 12 months when it is coming from a long base formation, usually the sector stays very strong for another 12 to 15 months. So I tend to play around those stocks only. So if maybe I can lock half of my positions when I'm way above my average gain and then free hold the position with a lenient moving average of 21 days or 50 days. So that's how I free roll my position. So the routine is more like combining both the top down and bottoms up approaches, because earlier when I was using relative strength, I was making a lot of mistakes in previous years because sector is one thing that beginners are usually not aware of.
Right.
They are not aware of, okay, this is the sector. So they have confusion always. Okay, I have now 100 stock, which one to buy? So if you just filter down top 3 or 4 sectors, your stock selection process becomes much easier. You weed out half of the names. So at least 50% of the stocks are already out from your screening process, and then you can focus your attention to those selected names.
Yeah, and do you look at this on a daily basis, a weekly basis? How often do you check in about what industries and sectors are leading
So
versus
I
lagging?
check this almost around thrice or 4 times in a week. But to be honest, it doesn't changes frequently, because
Right.
if you are using weekly data here, weekly charts don't just do that sort of price action like ripples in the sea every single day. So
Right.
if I'll see just maybe the same chart after 4 days, won't show much movement here and there unless there is a mega event somewhere. So usually twice or thrice in a week. It just take 1 minute. So it's not cumbersome. You may
Yeah.
have seen that even by looking at the chart, you can spend just 1 minute and tell me, okay, these are the sectors, for example, reality or PSU banks or PSC or energy, they are ending their correction and this consumer durable is very strong. So it just takes 1 or 2 minutes.
Right.
Yeah.
And when you're looking at these charts, if a industry or sector makes a really drastic change on a week to week basis, so there's a big move, maybe it's just within the same quadrant, or it's transitioning from lagging to improving, but makes a big jump. Do you view that as more significant than a kind of gradual change, or it's kind of all the same to you?
Uh, I take that like so far I haven't seen that kind of drastic change, but if it pops up again, I will focus a lot of my attention over there, because definitely there is something going on. So maybe you'll have, as per my experience on charts, maybe you will find some power play setups over there or high
Right.
tide flags, because when you have a drastic move of 30, 40, 50% in a week or so, you will definitely get a lot of high tide flags in those areas. So that's a good way to play out power plays in that particular sector, because then I can't expect a long base formation because that sector has a drastic change already. So there is definitely something going on over there.
Yeah, no, makes sense. And
Yeah.
say there's an industry that just transitioned from improving to leading and it's becoming a focus of yours, like that industry is the top one. Do you then take a look within that industry and plot the individual symbols of that industry on an RRG chart and identify, which ones are leading the most, or where do you kind of focus your attention on those subgroup of stocks once you've identified a leading industry?
So what happens is that in every industry, if you wait for the sector to move to leading quadrant, by that time the leaders are already up 30, 40%.
Right.
So what happens here is that as the sector moves from lagging to improving quadrant, I start focusing on the names of that particular sector. because that is one area where the leader will take the lead and the sector will move to leading quadrant much later. So you can say maybe a 3 or 4 weeks delay. So I have seen many examples in the past where the index moved to leading quadrant, but the leader was already up 100%. So leaders always lead. So where actually this helps is that, yeah, leader will start leading once the sector is somewhere in the improving quadrant, not in the lagging quadrant. So in lagging quadrant, you will see like, okay, 1 or 2 names are popping up out of 50 names in the sector, but you can't be sure of taking a position. But once it moves to improving quadrant, you will see, okay, now 8 or 9 names are popping up on my screen and they can be the leaders. So I have seen that leaders always, the leading stocks always lead the indices, because index is a combination of all the stocks. So there are some laggards as well there. So those usually leaders and top competitors, they move 50-60% before the index moves to leading quadrant. So I'm focusing my attention when it just starts moving to improving quadrant. So that's where I'm interested, because that is where I can catch the leaders much earlier before the sector moves.
Yeah, and that's why it's important to combine this top-down approach with bottoms up. So you're
Correct.
noticing those leaders before the sector really moves. Right.
Correct. Correct.
Yeah, and how do you calculate the first the RS ratio as well as the RS momentum, just so people can kind of build this chart for themselves?
So basically, this is available, and this is the proprietary tool of Julius D. Campaner. So when I was doing CMT, so in our CMT association curriculum, this is a major topic that we have to pass also. So this is a proprietary rating of them. So they haven't disclosed it anywhere publicly. But yeah, the basic criteria is that they are basically normalizing the RS values to a standard benchmark. So like I was saying, the problem with the RS rating was that you can't compare infra name with a platform business or a biotech name. So here they are standardizing those values compared to a standard benchmark and then showing you the chart the way it is right now. Yeah.
Yep, perfect. Let's see here. Um, in your experience and maybe teaching this to other traders as you do on Twitter, what are some of the common mistakes that people often make when they first start using this tool? Are there any kind of commonalities that you've seen?
Usually this tool I haven't seen is so popular as of now.
Hmm.
But yeah, that's what I said you, that mostly people are using RS rating as a tool. So this you should treat as a complement to it. So it's not like you should discard RS rating completely. One is a bottoms up process and one is a top down process. So if you can merge both of them, then your stock selection will improve immensely, because now you are picking the stronger stock from a stronger sector. So the common mistakes usually is, if I'll recommend someone, don't use daily chart here, because again, the daily movements will move indices back and forth in all the 4 quadrants and you will be very confused.
Right.
Now here, this is the tail length, which is 10 weeks mentioned here, which means that it is showing me the uh, location of that index for the past 10 weeks as well. So if you look at the index, real estate index, or maybe just pick up this sector, media sector. So 10 weeks before it was here, 9 weeks before it was here. So if you are having your portfolio of, let's say, 20 stocks, then your tail length, if it is very high, then your chart will not be readable. So you have to adjust your tail length compared to the number of securities. So if your stocks are just 3 or 4 or 5, then probably you can have a bigger tail length. But if you're having a portfolio of much higher number, then I won't personally advise you to go for a higher tail length, because otherwise the chart becomes not readable. So another thing is that it is a complement to RS in a way that tail length is advantageous also. Here you can see now that the issue with RS rating was that I don't know whether the RS rating of 82 has declined or it moved from 70 to 82. Here, with the tail length, I can see the movement of the index as well.
Yeah, excellent. And was it in the CMT curriculum that you first came across this, and how long have you kind of been implementing this as a part of your process?
So CMT curriculum, now Chartered Market Technician is a global recognition of technical analysis. It's a your USA based charter. So everything that is mentioned over there is authentic and time tested and proven. So there are many myths on technical analysis running over in social media, like for instance, some people say right over that gaps are always filled in technical in trading. So on charts. So it's not true because some gaps cannot be filled. In fact, unfilled gaps in an uptrend are the strongest form of gaps there. Like you call it by episodic pivot, or you call it breakaway gap or runaway gap, whatever name you give it to it, but they are very strong. So CMT helps in a way that it brings you to the more standardized version of the concepts. Now, although the concepts are very simple, but it is very important not to fall for any myths running around the subject. So it helps me a lot in my process of stock selection, where I'm much more closer to the stocks only in an uptrend, because the base of everything is Sir Charles Dow, his theory. So you make money in uptrend. Now, same thing Sir Stan Weinstein mentioned in his book as stage two. So what is stage two? It is basically uptrend as mentioned by Sir Charles Dow. So you make money, you save on your time, and you compound faster when you are playing in stage two stocks. So that's how it helps. So all these concepts helps in your trading immensely. Yeah.
And do you think the RRGs are more helpful for a specific time frame, whether you're from day trading to investing, or do you think kind of all different times frames and styles can kind of benefit from this?
So, see, first of all, it is very beneficial for investor or a positional trader, because as I said, that trends do not change in 1 or 2 months.
Right.
Once a sector comes in an uptrend, it stays there for 1 year, 1.5 years. Now, coming to a very shorter time frame, if you are moving in and out of stocks on a swing trading basis, maybe your holding period is 1 week, 2 week, you can look for the sectors that are in leading quadrant. And where will you find the pullback? Now, there is a concept called when you have a stock already in an uptrend. Now it forms a base. So you are buying a continuation breakout. The stock was already in an uptrend. It is forming a base. And now it shows you some cup and handle or volatility contraction, whatever on the right hand side, and you intend to buy it. Those kind of setups you will usually find when the index is in leading quadrant or it is ending the correction. Now, you can give maximum more weightage to something that is ending the correction because it has proven itself.
Right.
So it has already moved 20-40% and now taking a pause. So here your probability of winning is very high. As what Sir Jesse Livermore also mentioned, that he usually misses out the first move because he needs some extra bit of confirmation. Now, if you tell me to take a fresh position, being a swing trader, I'll be looking for the indices that are ending the correction, because these are the stocks that have already proven themselves and my probability of winning is very high in these particular areas. So that is why I'll focus more energy in these particular sectors where I know that if I take a position, then probability of hitting the stop loss is very less, because now you can have some bit of exposure to these sectors that enter the leading, because there you might now find stage 1 to stage 2 transition type of stocks. Here you will find something that was already there. Now you're buying continuation breakouts. But here, from improving or to leading, here you will find more chart patterns like reversal, what Sir Stan Weinstein mentioned, that stage 1 to 2 transition. That will be more common here. Yeah.
Yeah, it's cool to hear how you're integrating both, the CMT tools and methodologies with Stan Weinstein, Jesse Livermore, William O'Neill, who, of course, that's kind of my foundation as well. So it's cool to hear that. Would you mind kind of talking a little bit about your trading background and how you first got into this, and some of the resources that have kind of helped you along the way?
So I joined Government of India, as I said, in 2016 after my engineering. And here in India, in order to save your taxes, you are given some benefits by the government. You are allowed to invest in some schemes. So my friend recommended me a mutual fund. And I was just looking at the NAV and moving stock prices. I was infatuated by it. So I went deeper and deeper. Earlier, I went into fundamental analysis for 2-3 years. And just like other fundamental investors, I was also looking for value stocks. But the problem was that sometimes the value will stay value for 2-3 years. So the stock will not perform.
Right.
Or if the stock was falling down, I was not aware of the charts and all, and I was averaging down. So these were the common mistakes that I was also doing. And then I came across Sir Nicholas Darvas. I read his work, How I Made $2 Million mark in the stock market. You can still make it in the market. There is another book in 1970s that he has written. So I read a lot about many traders, and then I subscribed to Sir Dan Zanger's newsletters. So I was reading a lot of newsletters starting from 1997 till 2020-21. I read all the newsletters that time, and books by Sir Mark Minervini helped me a lot. Sir William O'Neill, Stan Weinstein, Jesse Livermore. Richard Wyckoff's work was very important because what he explained to me with the spring formation when a stock goes below a key support area and bounces back up. So that was a game-changing study by Sir Richard DeMille Wyckoff, and coupled it with Sir Mark Minervini's methodologies and what other traders have thought. So basically, all were having a bit of nuances in their entries and exits. Otherwise, the concepts were usually the same. No one was buying the stocks that are in downtrend. That was earlier my mistake. I was averaging down. All of them were pyramiding up, or they were having their control on position size. So risk management was the core principle. So I read a lot of books. So a lot of hundreds of books. And then I worked for a brief period of time in Indonesia with a firm over there. And that shaped up, and I was having my mentor from India. So he was teaching me, a very old age guy. So that's how I came across this subject, and did all these certifications also helped me, this charter. So everything culminated together to make me what I am right now.
Yeah, very cool. Yeah, and now you're trading full time. What has that kind of transition been like? From the learning process to trading full time. I'm sure that's been difficult, but with of course extreme benefits as well.
Yeah, it has been beneficial because once you do something you are passionate about, there is no third alternative. Either you succeed or you die trying hard. So
Yeah.
there is no third alternative here. So it was my passion. So that's why I came full time here. So it was not a matter of earning money. It was that you love the process, so you do it every day. So there is no Sunday, there is no holiday like that. So yeah, full-time trading, it it in a way is a distracting also if you are not having a control on your emotions.
Yep.
So you are constantly in front of the screen, you see just market falling down 2-3%, you come in panic and you sell your holdings. This was also one common area for me. Then I started maintaining my trading journal and reviewing my trades every week, every month. That helped a lot because once you read, and I always say that your trading journal is the best book that you will ever read, because those are your mistakes. So you know how to clear them off. And in a way, you will be coming across your own methodology as well, because next time you take a wrong entry, it will remind of you like those past 20 trades I have messed up around. My entry was very poor. So your trading journal, if you maintain, this will help you shorten your learning curve. So if anyone wants to be a full-time trader, that's the top-notch priority everyone should follow.
Yeah, I mean, that reminds me, of course, Darvis mentioned in his book the table that he kept track of where he talked about the trades, the mistake he made, and yeah, it's a constant iteration process and trying to identify the mistakes that you're making and just improve over time. That's the key. Um, I wanted to ask, obviously, I'm also got an engineering background, mechanical engineering, you in automobile engineering. I wonder if you have any thoughts about how that background and kind of perspective has influenced your trading and kind of how you approach the whole process.
So we had basically not engineering. Before engineering, we had to qualify exams here in India.
Mm-hmm.
For that, you have to study a lot of physics, chemistry, and mathematics. And when you enter the engineering background, you read about IC engines. In my field, it was like internal combustion engines or thermodynamics, fluid mechanics. So what happens when I was a fundamental investor, I could grab things quickly. So if a company is doing something in the field of optics, I can maybe understand the process pretty quickly. So if I'm analyzing a company from auto sector, I know what is going on in behind the process. So how does it matter? So the transition towards EV, so that sort of helped a lot. But over and above, like when I see here now, it's a matter of your entry, exit, and position sizing and stock selection. So these are 4 areas that are under your control. So rest, nothing is under your control. So this helped in a way that if you follow the CAN-SLIM approach and you want to look for N portion of CAN-SLIM where you look for new product or new management or new something launched by the any company, launched by any business, then that background helps you a lot because you're already aware of the concept. So in a way, that anything that you have read previously, I believe it never goes in vain. It comes in a way back to you in at some stage of your life.
Yeah, and I kind of view it as well. For me personally, I think the engineering training helps me think about trading as a system and, setting up feedback loops like you mentioned with post analysis. So you've got a system, you've got a method, but you always have to kind of keep evolving, keep adapting to, improve it over time. And I think my engineering background has helped me kind of understand that and internalize that. I don't know if it's kind of the same for you personally.
Yeah, true.
Yep.
So,
Yeah, no, excellent. Getting into your methodology a little bit, you mentioned, I think that you're more of the swing trading end of things. Is that correct? Or do you also kind of do position trading and try to hold for a bigger move?
so earlier when I used to sell a stock and it moved up 100, 200%, I was very upset. So then later on, when I was doing positional trading, sometimes the stock will sleep for 2, 3 months in the middle. I was again very upset. So I
Yep.
devised a way that I will probably sell 30 to 50% of my position into strength, which is like 20, 25% of move. And then remaining position, I will hold on trailing my stop loss. So it can be 21 days moving average, or it can be a pattern based stop loss, or it can be a trend line based stop, or it can be like 50 days moving average, but I'll hold on to that position till as long as it moves up. So now it's a combination of swing and positional trading. And this particularly I have learned from Sir Dan Zanger, Sir Mark Minervini a lot, his work. So free rolling the trade, that's what I do for remaining position.
Mm-hmm. Yeah, excellent. And do you have any advice for traders? Because obviously you mentioned several mentors and sources of learning for you. Minervini, Dan Zanger, like you said, they share common principles, but their entries and exits are a little bit different depending on their style. Do you have any advice for traders about how to integrate different sources of information like that to, eventually develop your own style? Because obviously we're not going to trade like any single one trader. We're going to find kind of what works for you. As you mentioned, you kind of found a mixture between swing and position trading. So any advice for traders out there in that kind of search for their own style, their own rules that they want to develop?
So what happens basically is that there are 4 decisions that you control. First, you have to understand that trading is simply a decision made in one of those baskets. So stocks selection, what will you buy? Entry point, where will you buy? Position sizing, how much will you buy? And exit mechanism, where will you exit? So these are the only 4 decisions that are under your control. Now, you pick up any trader, they will be just differing from each other in one of these nuances, like entry point, exit point. For instance, Dan Zanger will cut his position when it comes back. Now, maybe Mark Minervini sir will be waiting for the base low stop to be hit. So that's why he has a chapter on squat and reversal recovery. But Dan Zanger doesn't have that. He says winning horses don't come back to the gate. So there is a stylistic nuance in both the traders in term of exit, and both are highly successful. So now how does it helps you is that first you need to understand your trading personality, whether you are comfortable holding on to a position for a long period of time, or you are just inclined towards more of a swing trade where you can churn your capital for a higher turnover. Now, second thing you must do is that you have to deep dive into the past database. So you have to collect a lot of charts matching your style. Once you have identified the slide, okay, I am comfortable here. Now you have to develop a lot of chart database. You have to have go back in time and look for the charts. You have to read them and you have to see. And now once you are into the real time, start with you don't do paper trading, because paper trading, you don't have any emotions involved. So it's basically, you can even bet $1 million over there with no emotion. So start with some bit of capital at stake and fine tune your entry point first, stock selection, and then your entry point. Then it will automatically tell you whether you are comfortable entering the position by end of the day, or you want to buy when the price crosses a level, or maybe you are comfortable adding half when price crosses on half near the end of the day.
Right.
Or maybe you are now expert in taking an anticipation entry, so you buy before the breakout, or you are maybe uh, very much adept in now buying at the shakeouts. So these all nuances will automatically come to you when you will start trading. So you have to start small and make as many mistakes as you want to in your initial 1 year, 2 year time period, but with a lesser capital at stake. Understand risk management first, and then your trading journal will be your third step. Review those trades and they will tell you about what suits you. So entry here and there, 1% here, 2% there, here and there, doesn't make a difference in your initial years because you are still a learner. But once you are heading towards professional trading, you will gain better control of your emotions when you read your journal. And fourth step is now your exit process. Now that's where your first step, the trading style, understanding your style helps you. Because if you're a positional trader, why will you sell a stock merely for a 5 or 6% gain? So your exit point will be different than someone following swing trading. So you have to focus on these baskets, deep diving, and trading journal. So these are the areas where every beginner has to focus maximum attention towards.
Yeah, and I really liked your point about, and I agree on this on paper trading because it's just not quite the same. And kind of what I always say is it's good. Obviously, you want to start with a relatively small amount of your capital. You don't want to trade your whole account to start with, but you want to actually feel the losses a little bit because it is feedback that will it impacts all your decisions, the four steps that you mentioned. And have you found any techniques outside of journaling or maybe including journaling that help you kind of read your emotions and understand how it might influence you and the decisions that you make throughout the day?
So what I did was that when I was reading, I said to you that when I was reading the letters written by Sir Dan Zanger, so I was going through his process. So some stocks he was himself trading, and some stocks in his letter he was recommending in those letters, like these are the stocks that you can look for. So when I went back to those charts, and some of the companies are not listed anymore,
Mm-hmm.
their charts are available on barchart.com. So when I visited the website, I went to the old database. So I was looking for what is it he is actually trying to look for in that particular chart.
Right.
So what is that one thing? So as I was making mistake initially by trading any random chart pattern, and I was not looking for earnings on the table. When I read about his work, so I like, okay, now this is some sort of thing that I have to incorporate. Now, once I incorporated earnings, then the number of stocks filtering through the screen reduced a lot. So I have now probably very less number of names than I used to have before. So apart from journaling, what I'm doing is that I'm also reviewing the trades that other traders have not taken or have missed over there. So, but they are recommending in the letters that these are the charts that you can look for. So I'm trying to gauge basically that what are they trying to look for in that particular chart that I might be missing. Or trading is an evolving process. It's an art. So no matter how better you do, there is someone else always ahead of you in the game. So you just start learning from each one of them. So as you have also interviewed a lot of traders over there. So I have gone through those interviews personally. So I have seen there is no one fixed way of entering a stock. So I also look for their charts. What are they basically trying to do? If it suits my personality, I just add to my trading arsenal of tools. But if it doesn't, then I still simply learn from those points. So that if something similar can be incorporated. So apart from journaling, reading a lot of books, they have shaped and interviews of you or other traders or their trading journal as well. Yeah.
Yeah, and not to be corny, but bring it back to RRGs. Hopefully, you just kind of compare yourself to your own previous versions over the past 10 weeks or so, and hopefully you're going from, lagging to improving to trending. So sorry to be corny, everybody. But just had to do it. Do you have any kind of favorite quotes that you've come back to? Obviously, you've read a lot of excellent books from top traders. Are there any quotes that really stand out to you and that really kind of changed how you think about trading and think about developing a system?
So there is a one quote by Mark Weinstein, who is a market wizard interviewed by Sir Jack Schwager. He says, although cheetah is the fastest animal on the planet, but he won't just attack any random animal unless he sees that there is a highest possibility that this I can catch. So prey. So to him, he says that to me, this is the epitome of professional trading. So when everything is right, so it's a big bit of paragraph written by Mark Weinstein. The other quote that helped me is that by Sir Dan Zanger, winning horses don't come back to the gates.
Right.
So if a stock has taken out or lifted off from the base, it shouldn't come back. So I usually cut down my losses short if the stock does that, because there is always an option of re-entry. But those smaller losses, maybe your winning percentage will go down, but the average gain to average loss ratio will be very high if
Right.
you are trading by this method. So this quote changed my exit style forever. So these are some of the quotes. And then one by Sir Nicholas Darvas, he mentioned is how in his book, How I Made $2 Million Market. So, I mean, I'm not saying this, he mentioned this. So if a normal decent lady comes to the bar and starts jumping on the table, everyone will notice her, right? Because that's not expected from her to do so. So that's the way you should look at a stock that was calm and suddenly it has volume spikes. So once you have liquidity in the chart, you should focus your attention there while it was sleeping before. Why is that? I mean, it has woken up all of a sudden with all those huge volume spikes. So these are the areas that I have incorporated in my scans, like volume spike is one scan and exit has become ruthless. So these are the quotes that have influenced a lot.
Yeah, so the Darvas quote is kind of talking about stocks completely changing character, and for you, volume, big price moves, that's what you're looking for, right?
Correct. So as liquidity drives the market basically. So
Yep.
if high volume bars, price moving, there is definitely someone buying there. So as William O'Neill sir mentioned that that's not your neighbor aunt buying stocks. So these are institutions. So that's what attracts me over there.
Yeah. And do you have a sense of, I don't know if you take a look at your stats recently of your average gain, your average loss, your win rate? Because what I found, talking to traders, everybody thinks you need a 90% win rate to be successful in the market. But in reality, like you mentioned, it's all about the risk reward ratio. Focusing on that is much, much more important than, just having a winning trade most of the time. And some of the traders I've interviewed, it's even a 20, 30%. And they're traders who have, been a top performer in the USIC and had tremendous performance. So do you have a sense of your metrics?
So I use a platform for my trading journal. My winning percentage as of now is 35% approximately. Because as I said to you that when a stock falls back, I'm cutting down that stock brutally because I don't want bigger loss. So losses should be very small. So winning percentage as of now is 34 point something percent as I checked today. And R value that I basically look for R multiple in a trade is roughly around 5.2, 5.3 over there in trading journal. So basically, I have observed that it works on Pareto principle. So 20% of your stocks makes 80% of the gains.
Right.
So I follow that strategy because I don't want bigger losses. So I am just holding on to the stock that has been a winner with a good position size. So winning percentage as of now, it's 34 point something percent. Yeah.
Yeah, excellent. And what's kind of your typical position size that you start with? And obviously, it's probably market dependent. If it's a good market and you've been performing well, you might increase that. But on a standard level, what do you kind of look to shoot for? What's a full position size for you in terms of your portfolio size?
So full position size, it has been between 20 to 30%.
Mhm.
Although, yeah, you are right, it's market dependent also, because once the market is coming off from a correction, I'll start a bit slow.
Mhm.
So maybe I'll start with 0.3, 0.4% risk, but the stop losses are rarely above 5%, 4 or 5%. So stop losses are always less than 4 or 5%. If the setup is not offering me 5 or maybe max to max 6% stop loss, it's a pass. So if I am taking a 0.5% risk on a 5% stop loss, then my position size can be 10%.
Right.
Because then I'll be losing 0.5% of my capital if 5% is my stop loss. So next time, if the market gives me some bit of a kick and trades are working fine, then in the next trade onwards, I can immediately jump to 1% risk as well, because it is very important to get in early when the market starts moving, because once you are late in pressing the accelerator, then it might be possible that half of the move is over. So by that time, 1% risk, if the stop loss is 4% deep, I usually go with 25% position size as well. But in that scenario, I will be trimming my position size instead of pyramiding up, because already the position size is very heavy. So once the stock moves up, it becomes more heavier. So if the stop loss is 4%, yeah, 25% position size. But if it is just a ETF, maybe I don't want to play in a stock, I want to play in an ETF, then the position size usually goes up to 40, 45% as well, because ETFs are usually not that volatile compared to an individual stock. Yeah.
And how much of that, if you kind of oversize a little bit, like you mentioned, how much are you looking to hold for that bigger move? Did you say you kind of look to sell 20 to 30% into strength? Is that right? Or yeah, kind of how do you manage that? How much do you like to hold for that longer move versus sell into strength?
So usually after I buy a stock, I wait for the first retracement.
Hmm.
And my stop loss is still the same. So at this point, when the stock is retracing, it can take my stop loss as well. Now, I don't care if it can take my stop loss, because I'm focused on those stocks that recover the fastest.
Hmm.
So as to what Sir Minervini mentioned, tennis ball action.
Right.
So once the stock bounces back up strongly, that means this stock is strong compared to the one that is now taking a longer time in retracing back. So now once the stock moves up strongly, I'm up over 15, 16% that I have observed. So once a stock is up to the tune of 15 to 18%, I love to sell 30 to 50% of my position into strength. It also depends on now two kinds of scenarios. One stock can move up peacefully up. It retraces a bit, it moves up, it retraces, it moves up. Another stock is like a very strong stock. It retraces and then shoots up quickly 20, 30%.
Right.
And it becomes extended from even 10 days moving average. It's vertically up. So in these scenarios, I love to nail down some position into strength. So I sell 30 to 50% into strength. Now, for the remaining position, I have my stop losses, which is either previous swing low or 21 days moving average, whichever is higher, or a trend line based stop, as I mentioned, or it may be a bearish chart pattern information later on. Maybe the chart has a head and shoulder pattern, so I can be alert at the neckline.
Right.
So that's how I basically sell into strength and free hold my position.
Yeah, excellent. And are you mostly trading Indian companies or also US stocks? And if you kind of trade both, have you kind of noticed a difference between, how they kind of act?
No, I didn't trade in the US market. So it was just for a brief period of time before. So that really hit my sleep cycle, because US
Yeah, I
has
bet.
morning here, it's evening time. So I was in Jakarta. So was trading three markets all together was very difficult. So I tried a bit, honestly, 2, 3 months, then I just completely avoided US market. So only trading in Indian market now.
Yeah, how's kind of the liquidity with the Indian markets? Because some of the companies are pretty small there. So have you kind of run into any issues with that, or and if so, kind of how do you manage that?
Yes, liquidity is a issue in India because here we have circuit limits as well. So in a way, you can say its advantage is also because we don't wake up overnight like US market, a stock tumble down 80%. So this doesn't happen here. So we have a circuit limit as well, 20%. For some stocks, it is 10%. For some, it is 5%. So here we have a problem of circuit limits. So if a stock has a circuit limit of 5%, that means it can't move more than 5% in a day. So in those cases, if there is a negative news, stock can tumble down 5 each day and you won't find any buyer. So in those particular cases, if everything is right, the story is also good, then position size has to be adjusted. So what we usually do is we have less than 5% position size for those names. But again, because being a trader, you might also know that if a 4 or 5% position size doubles up, it pains a lot because you don't have enough position size.
Right.
So it's basically usually we try to avoid those names. So we focus on 20% circuit limit stocks. So yeah, liquidity is an issue for many stocks. Volume is very less. So avoid those stocks completely. Yeah.
Yeah. And I've seen, I follow a few traders who trade the Indian markets on Twitter, yourself included, and some of the charts just look beautiful. They're like beautiful VCP patterns. Like it's cool. It's very cool seeing, the patterns stay the same no matter what market it is. And I want to ask you, are you more of a breakout trader or a pullback trader? You mentioned kind of finding your style, but is there one that you kind of gravitate towards more, buy on strength versus buy on weakness?
So I'm more of a breakout trader. So if I'll say you like 80-90% of the trades are breakout trades. So because I believe in the concept of pivotal point by Jesse Livermore. So you
Right.
were asking me about quotes. He mentioned that far more money has been lost in anticipation of the pivotal point than by actually buying at the pivotal point. So I believe that once the supply has been absorbed on the chart and stock makes a lift, I can enter at that time. So mostly trades are breakout trades, and pullbacks are like maybe if I am holding already onto a position and I haven't sized enough, and the stock then pulls back to a level of, maybe 10 days moving average or 21 days later on, and then it is pulling back, I can add to that position. So in the second scenario, when I'm pyramiding up, I'm usually not focused on breakout. Then for me, breakout will be late because I'm already tracking that stock. I'm already holding to it. So
Right.
all those pullback trades that I am taking, they are addition to what I am already holding. So 90% of my buys, 80-90% are based on breakout trading concepts.
Yeah, excellent. I kind of gravitate the same way, so that's interesting. Um, this has been fantastic. Definitely appreciate your time and for you to be a part of this. Do you have any other kind of bits of advice for traders watching this who are earlier in their journeys, trying to develop their style? How can they incorporate RRG into their tools? What should they kind of be focused on? What books, having read many books yourself, what would you kind of recommend them read? Any kind of words of wisdom that you have for those type of people watching?
So some of the books are pretty much mandatory. So for any beginner, you should start with the work of Nicholas Darvas because that is very easy to understand. How I made $2 million in the market, and he wrote one more book in 1970s. You can still make it in the market. Then there is one book by Sir William O'Neill, How to Make Money in Stocks, that orange cover. You have to read that book. Stan Weinstein, Secrets for Profiting in Bull and Bear Markets, and two books by Mark Minervini, Think and Trade Like a Champion and Trade Like a Stock Market Wizard. So these books you have to study. And then as I mentioned before, this will pretty much sum up your stock selection, entry, exit, everything over there. And then you have to focus on your stock selection process, entry, exit. For that, you need to maintain a journal and start with a very small capital account. So when you are a trader, usually beginners want to just focus on doubling up, tripling up their capital in options or futures, and then they lose their money and then they go back and then they curse the market. So that's not the right approach. So risk management has to be the supreme priority because you don't have to lose your money. So risk management, you need to understand, especially there are two chapters in the book, Trade Like a Stock Market Wizard by Mark Minervini, dedicated to risk management. So read them first, and then you can probably read the other part of the book. So books, your trading journal, your small capital account, that sums up the complete scenario, how you go about it. And this will pretty much help you in 90 to 95% of what you are looking for.
Yeah, I like that because kind of the books provide the foundation, but the trade journal is real life, real application of the concepts, which is a whole nother layer that you need to add on. And I would just kind of add, it takes time. You're not going to get this right off the bat. You're not going to become Mark Minervini, and kind of go back and forth. I recommend, reading the books, then picking them back up a few months later, because you'll be amazed with more experience actually trading, how much more you can get out of each book, and how different passages will stand out to you. So I think that's excellent advice. Himanshu, thank you again for being a part of this. Where can people connect with you if they'd like to get in touch or learn more about your style?
Yeah, I'm available on Twitter, so I'm very active on Twitter. So we can connect over Twitter as well as WhatsApp also. So I'll be sharing my number with Amit and you. So we can connect over there. So if you want to connect with me, I'm available on Twitter. My DM is open. So it will be glad to connect with all of you.
Yeah, fantastic. Well, thank you again for your time. I really enjoyed this. I think RRGs, it's a very, very cool concept. I love the visuals as well. So thank you again for your presentation. Hopefully everybody watching, you're enjoying this as well. If you are, please go ahead and leave a like down below, and we'll be right back with our next guest. So stay tuned. Take care. Okay, welcome to day 2 lunch. We've got time now to kind of relax a little bit, digest everything that you guys just learned. We've had some fantastic presentations from Oliver, Jared, and Himanshu. And during the break, take a load off, go for a quick walk, get some food, refreshments. During the break, I'll be playing kind of a webinar that I did recently on identifying tight areas, trading VCPs, that hopefully you guys will enjoy. And we'll be back at 2 p.m. with Deepak Uppal, and that's 2 p.m. Eastern. That's when we'll go ahead and restart. So feel free to recharge your batteries a little bit and come back strong at 2 p.m. Just a few quick reminders before I let you go. Again, if you're wondering how do I download the slides, sign up for the VIP. It's completely free through the QR code right there. This gives you access to special giveaways, the conference resource where all the slides are kept, as well as other free bonus resources such as model books, classes, as well as the ultimate trading guide. So you don't want to miss that. Sign up. It's super easy, and you can access all the free resources right away. So go ahead and do that by scanning this QR code right there. Also, if you found immense value in the previous 3 conference presentations this morning, please go ahead and consider a donation to St. Jude's. That's the best way to thank us, thank the speakers, pay it forward for a great cause. $1 is great to donate. All you have to do is scroll down a little bit below the chat. There's a donate button. It just takes a few seconds. I have donated personally as well, and it's a great way, as I mentioned, to pay it forward. If you can do $1, that's fantastic. But if you have found value in this conference, if you've watched at least one presentation, please go ahead and donate, and basically as a thank you to us, as well as a thank you to this great cause. $1 is great. If you can do $5, $10, that's even better. Fantastic. Let us know on Twitter. We'll thank you personally. But thank you guys so much in advance for the donations. Let's try to beat, yesterday's mark of over 2.5K, nearly $3,000 yesterday. Let's try to blow that out of the water, later on today. And with that, we'll kind of leave you there for lunch, and I'll be playing that webinar in just a minute. So we'll be right back at 2 p.m. Eastern. See you there. Bye. RMV is relative measured volatility. It's an indicator that we've developed to help you identify these tight areas. Learning to trade from tight areas, VCPs, can benefit you regardless of your time frame. Every top trader, especially momentum trend followers, they're often looking for this VCP type setup. So you're in good hands if you're looking to adopt this into your style. If you didn't have RMV, you just kind of have to look through a lot of charts manually, stocks and uptrends, and try to find tight areas on the right hand side. And it can be, you can look through hundreds of charts and not find one. we've got multiple presets in DeepView that build in RMV right into the screen and look for stocks that are forming these tight areas right here in the moment. So we make it really easy with a few clicks. RMV, as it gets closer to zero, that basically means we're forming a tight range. As it expands, it means we're expanding relative to the recent price actions. Alco is a really good example of a tight area happening right below that base pivot that then leads to that breakout. Welcome everybody to another DeepView webinar. This is going to be a really great one. This is one that I'm personally very excited about, and we'll be discussing finding and trading VCP setups with DeepView and RMV. Discussing first of all, why are tight areas and VCP patterns so effective and important to recognize, and then how you can find them easily and just trade them a little bit more effectively using an indicator that we developed over in DeepView that I personally worked on and brought to life. And it's very cool to see other people using it, and we'll be walking through a lot of examples, a lot of chart examples today to kind of bring everything to life and hopefully help you guys out in identifying those VCPs. So here's the key goal of the webinar, pretty much what I just said. Hopefully by the end of this webinar, you guys have improved a little bit on your identification of strong entry points from tight areas and kind of build that sense of knowing when a stock is ready to go. I had a discussion with a few people on Twitter the other day. We were talking about daily focus lists. I personally find that the less stocks I'm focused on a daily basis, so how many stocks I'm actually looking to enter that day, the better I execute, and also the calmer I feel in the moment. And a few people mentioned, they can't watch only 3 stocks because often, they don't feel like they can pick the right ones. A lot of stocks move without them. So hopefully today in this webinar, we'll help you build that feel and kind of better identify the stocks that are really ready to go and their patterns are really mature and ready to develop and ideally break out. So that's the goal in today's webinar. So here's a little bit of the agenda. First, we'll talk about what is a VCP, volatility contraction pattern. We'll discuss tight areas, and historical traders and how they look for them. Then we'll discuss how to visualize tight areas using the RMV indicator, which is really handy and really helps you kind of analyze a chart just like some of the top traders in the world, USIC champs, and in finding those tight areas really easily. We'll dive deeper into the RMV indicator and then talk about screening for VCPs in DeepView, 3 steps to trade execution, and then run through a lot of charts live in DeepView, and then hopefully answer a lot of you guys' questions as we go out through this webinar. So really, really excited for this one. Thank you guys so much for tuning in. And hopefully you find this valuable. And let's go ahead and dive right in. So first things first, actually, let me go back. We have a special offer currently, a really great deal, 2 months for $39. If you haven't yet tried DeepView, highly recommend checking it out. It's my daily driver for everything. And we've heard from so many different traders who have switched from other platforms that's basically helped speed up their routines and, the breadth of data points, the fundamentals, the growth numbers paired with the technical screening really helps you narrow your focus that much faster and hopefully trade more effectively. So definitely check this out. Visit deepview.com to access this offer. All right, so let's start from the very basics, kind of the foundation of today's webinar. What is a volatility contraction pattern? Essentially, it's kind of an element of market structure where stocks move from expansion, then they compress, and then they expand again. And this expansion can be upwards or downwards, but this is just kind of how stocks tend to move as a function of supply and demand. So getting into the bullets here a little bit, a VCP is basically a constructive base pattern within the context of a longer term uptrend. And this is really key here. It's a continuation setup, meaning that we've got an existing trend going. We compress, form a base consolidation, and then we're looking for an entry point that completes the overall pattern and leads to that next leg up, that next expansion. And this VCP is characterized by tightening in price action from left to right within the base. And oftentimes, if you've got volume plotted, you'll see that same type of contraction go on during this base. Volume is higher at this turning point here, then slowly throughout the base, it declines, even though at some points as such as move ups here. We might see the volume increase for a few days as this leg moves up, but then, it declines again. And ideally, as you go through and complete this pattern, the legs down see less and less volume, and these contractions actually get tighter and tighter as the spring kind of gets coiled, and then we're ready to explode and start that next expansion leg up once we complete that VCP pattern. And this is kind of, it's a function of supply and demand, because as this base is forming, we're seeing people who are taking profits after maybe they bought down here, they're selling into this base, and we're seeing kind of longer term holders either accumulate more shares, or new participants are coming in, absorbing that supply. And as the stock matures within this VCP base, less and less supply is coming to market. There's more demand coming in. And then finally, when demand overcomes supply, that's when we see this next continuation, that next breakout and move upward. And VCP, I'm sure many of you guys know that it's a term coined by Mark Minervini. And this kind of element of market structure and this VCP pattern, it's been called a lot of. RMV is relative measured volatility. It's an indicator that we've developed to help you identify of market being this base pivot and the floor being, the bottom of the space. And then he looked to buy as we broke out and started that new expansion upwards before the stock would form its next base. So the VCP, a historically significant pattern, and it's an element, as I mentioned, of supply and demand. And it's not going to go away, because it's a function of human psychology, greed, fear, all of that kind of, coming together and forming this price pattern that then we can take advantage of as retail traders. So as I mentioned, all legendary traders looked for a similar pattern, from cup and handles to Darvas boxes, Wyckoff springs, pivotal points. All of them are kind of rooted in the same type of pattern, and that's what we're really talking about today. So let's see if there's any key questions. And Rai, feel free to shout out if there's a question that you'd like me to answer live as we go. But let's see. How's the VCP similar or different to a squeeze in a longer term uptrend? That's another way of putting it, David. We're basically squeezing, and if you had Bollinger Bands plotted here, you'd see them kind of contract throughout this base. So it's just another way of saying VCP. So here we go. All right, so cause or effect. As I mentioned, a lot of people, when they first learn trading and first pick things up, they're trying to kind of memorize the patterns. They're trying to memorize exactly what a pattern looks like, down to a candlestick pattern. And then they kind of trade that in isolation, not really thinking about the bigger picture, what that pattern signifies and what's actually creating that pattern. So a lot of people wonder, is this VCP, is it self-fulfilling prophecy? Is it because everybody's looking for it that it works, and, people are watching the breakout, it breaks out, it fails, that's because too many eyes were on it? That's not really true. Definitely, there's been more reversals in recent years, but this pattern is really formed by the bigger picture players, the institutions, the people who manage large funds and pension funds, where they're accumulating hundreds and thousands of shares, and they're absorbing the supply that comes in throughout this base. And this kind of puts in a floor into the stock, and as they accumulate, as I mentioned, they kind of bring up and contain and absorb all the supplies coming to market, and that leads to the contraction that we see. And then finally, once they're done accumulating, or enough individuals and institutions start accumulating, then we get that breakout, and we see that continued push upward. But it's not really a pattern to memorize. It's a framework to think of as you're looking at charts and looking for buy points, looking for overall setups. So don't get too focused on, a VCP has to have 3 contractions. It has to contract, this much on this contraction, this much on this contraction. Look at the bigger picture, see if there's accumulation signs within the base, both in terms of price and volume action, and then look for a very tight area on the right-hand side that then you can look at to use as an entry point as the stock pushes above that pivot. And we'll talk a lot about that later on in this webinar. So as I mentioned, let's see here. Basing and contractions are caused by sellers getting absorbed. Buying pressure supports the stock on any pullback on these legs down, and then selling pressure gets weaker throughout the base, and that's what often leads to the higher lows as the stock approaches these all-time highs, and then the eventual formation of the VCP pattern, and then the breakout through that pivot. A good question from Lisa. What's the typical time frame? just want to answer this real quickly. I typically look for VCP patterns on a daily chart. The length of this base, can be as short as a few weeks to, as long as many months. But typically the ones that I'm looking for are in a longer term uptrend and, typically are about 7 to 3 weeks long. I would say the best ones are a little bit longer on the longer side. And have a stronger uptrend preceding them. That's kind of the key that I think a lot of people forget, especially when looking at the O'Neill patterns. A lot of people, are looking to buy cup and handles off the bottom or in a longer term downtrend. We're always kind of looking for an existing longer term uptrend in a stage 2 stock, and then looking for continuation buy points that resumes that longer term uptrend. And this pause, as I mentioned, I look for a few weeks, and it can kind of be up to you. But for me, the sweet spot, 3 weeks, 2 weeks at the very earliest for a really powerful momentum move type name, and then a longer base can be several months long. Good question. All right, I see a lot of people providing extra commentary in the chat, so excellent. Keep that coming. Very cool. No, Lisa's just a participant, I believe. So here we go. So the William O'Neill cup and handle. So I want to discuss a little bit more about, how this relates to the VCP, because really a cup and handle is just an example, a subset of the VCP. And here I've got some screenshots from documents that William O'Neill created. And you can see, that overall pattern, the contractions, the tightening from left to right within this base, the very tight area on the right-hand side, and then the breakout through that pivot on a pickup in volume. That's exactly what we're looking for when it comes to the pivot point breakout of the VCP. We've got more highlighting, tight closes, 3 weeks tight. That's another example of a VCP. So O'Neill looked for the exact same thing that we'll be talking about today, which is, tight weekly closes, volume dry ups within the handle as the stock pulls back and forms tight ranges. And then larger volume on up weeks, lower volume on down weeks, and then finally that volume explosion on breakouts through the key pivots. And often as we see here, there are kind of patterns within patterns. And this is kind of a higher level concept. But here, for instance, we've got this base here with a base pivot up here, but up the right side, this handle right here is its own little base. You've got a prior uptrend, then this base that contracts from left to right gets really tight right here, and this base pivot is right here. So this range, and I'm going to call it range because I'm going to use that word quite a bit in today's webinar. This range is within this longer term range, but we're seeing a pattern of ranges getting tighter and tighter from left to right, and this pattern is even within this smaller base. So you're always looking kind of from these contractions within contractions, and that's where you can really find ideal entry points where you can manage risk really effectively, buy through that pivot, set your stop at these lows, and keep your risk really tight, put on a decent sized position, and ideally, ride that next leg higher. So the William O'Neill cup and handle, great example of VCP. And there it is right from the master. This is what he was looking for. Another example of a top trader, market wizard who uses the same concepts is Stan Weinstein with the stage 2 continuation pattern. This is basically a VCP. This should look really familiar. We've got a leg up, contraction within the base, getting tighter, forming higher lows. Then we've got the pivot breakout at point A right here. And you can see volume pickup on the breakout, volume decline within this base from left to right. And then we're looking to ride this trend up here above the moving average. So, every top trader, especially momentum trend followers, they're often looking for this continuation type setup, this VCP type setup. So you're in good hands if you're looking to adopt this into your style. All right. So let's talk a little bit about tight areas and why they are so important. So there's a few reasons that we'll get to. But first of all, kind of what is a tight range? Tight range for me can be as little as a few days, even 2 days, and that could extend to a few weeks, especially if you're looking on a weekly chart. And a tight range is basically on a relative basis a tighter spread from high to low within the context of the longer term move and longer term character of the stock chart. And what this indicates, especially if there's a lower volume during this range, is a lack of sellers and kind of an equilibrium in terms of price between supply and demand. As I mentioned, The larger institutions, they've been accumulating the stock. They're supporting the stock at that price level. There's no really big sellers coming to market. They've all been worn out throughout that VCP pattern. So this tight area represents, that final bit of equilibrium, that final pause before a really explosive move. And that's what we're looking to take advantage of as traders. And as I mentioned, these tight areas are a key sign of accumulation as buying pressure pins the stock to a level. And it can also be used, as we'll mention in this video, as an entry tactic / setup. And this is because it forms a clear pivot point, a clear spot to actually enter the stock as it resolves that range. You're able to manage risk tightly, either at the low of the range or the low of a higher low within that range. And if it reverses back into that range, very quickly if you're wrong, and that allows you to keep your risk really small. And even if you get stopped out enough times, a couple of times, maybe the stock tries to break out of the range, pulls back in, breaks out again. Even if you're stopped out a couple times, if you're able to catch that one breakout, that one expansion move that completes a larger pattern, that's when you can get some really nice gains that pays well more than all the small paper cuts that you experience while you're trying to trade that range. So those are kind of the key components of why these tight areas are so important. They represent accumulation, and they can be a really good entry point into a stock. And this graphic right here is something very similar to what we've seen before: a prior expansion trend before, then consolidation, VCP, formation of higher lows. We see a significant level here, which forms that pivot point. This is the range within this longer term base. We expand upward, breakout of this smaller pattern here, this tight range that resolves the larger pattern, the VCP. We expand upwards, form another tight range. This could be an add, or for a swing trade, an initial entry, and we resolve again to the upside. So both this here and this here represent ranges that could be 1 to 2 weeks, or just a few days where the stock really tightens up relative to the character that it's shown within the base and during the trend. And these are opportunities as it resolves through that pivot point that we can take advantage of as traders. Let's see here. Jeff asked a really good question. Do the principles in this webinar work on all time frames? Yes, they do. If you look at a weekly chart, if you look at a monthly chart, intraday, VCP patterns form all the time. And that's because, as I mentioned, it's an element of market structure. It's a function of supply and demand, and supply and demand, creates and resolves price action on all different time frames. I'm going to show charts in this webinar on daily charts primarily, but also on weekly charts. And I've got some intraday charts as well of GME just today, formed a VCP on an intraday basis, and I actually took that trade and traded it from a VCP on an intraday chart. So it works on all time frames, all different styles, and this explosive move, regardless of your style, whether you're a day trader, swing trader, or position trader, you can use that to enter your position and then manage the trade that's relevant for your time frame, whether you want to sell into strength on that first day if you're a day trader, hold it for a few days to a few weeks if you're a swing trader, or try to play the longer move if you're a position trader. It all kind of comes down to your own personal style, but learning to trade pivot points, learning to trade from tight areas, VCPs, can benefit you regardless of your time frame. But really, really good question. Let's see. Sometimes the breakout happens on extended runs coming out of bases rather than tight areas. Is it better to focus on tight areas only? So Edgar, really good question. Sometimes we get a run up off the bottom of the base. We approach this base pivot and there hasn't really been any consolidation. There's nowhere to manage risk. And what I would say is, if you can't manage risk, it's not worth taking the trade. If we've got a run up off the bottom of the base with no consolidation, the stock, and this happens a lot, will often reverse hard, then form a range and then re-break out, or we form a range above the base. And that's a spot where we can manage risk, or we can wait for the reversal down and formation of a range back in the base and then buy that re-breakout. But if a stock runs up all the way here, it's likely to be more volatile, move up and down quite a bit, stopping you out if you try and manage risk tightly. So you want to manage your risk and only look to trade patterns where you can manage risk really, really tightly, because that's the name of the game. It's okay to miss a stock that goes up without you, but if you enter a stock without a spot to manage risk, you're just kind of setting yourself up for failure over the long term, over a series of trades. It might work for one, but over the long term, it won't be quite as effective. But really like that question. Let's see here. All right, I'll keep going here. There's some good questions here, but I want to keep pushing on here. So this is an example from back in 2020 TTD. This is another stock that I traded. We've got a nice kind of cup and handle here. You could also call this a pseudo double bottom, but really we get this nice rounded base. Then we get this handle form. We get a shakeout within the handle, which is another clue, a sign of accumulation. And then within this range, we get the breakout that resolves this shorter term pattern, but also this longer term base. And that led to a move of 200% in just a matter of months and weeks. And that's the type of explosiveness we're looking for. And you can see it never revisits, this prior pivot. And that's a sign of real strength. And that's another benefit of the VCP, is that because the supply and demand, equilibrium is in your favor on this VCP as it resolves itself, we get this explosive move and we get a strong trend right out of the gate, right from your entry point. So you don't kind of experience any pullback, drawdown in your account, and you're just kind of at a profit immediately. You can move your stop up pretty aggressively. And that way, you're just looking to put yourself in a winning position right from the start, where you can manage the position from a position of strength, a position of confidence, because again, a lot of this is mental, and having a stock push right from your entry point without experiencing any pullback, any loss, it just sets yourself up for a lot more success. So this is a good example here. And we've got the same stock on a weekly chart. I mentioned you can use these concepts on a weekly chart as well. We've got this cup. This is the handle here. You can see how tight these weekly closes are. This is another element of VCP, tight closes here. We get that shakeout. You can see it really clearly on the weekly chart. And then the stock's right there, ready to go, resolves itself and just doesn't really look back, forms another base, breaks out again. But this entry point really put you in a strong position where you can manage risk really nicely versus the low of that week on that breakout day, and just kind of ride the stock to higher prices. So on a weekly chart, this is a great way to think of VCPs as well. And you can see this is about, a 10-week pattern, maybe 12 weeks here. So for Lisa, who asked how long these bases are, this is a pretty normal one. We've got, the correction, which leads to the bases, forms the bases, and then the pattern resolves itself up the right-hand side here. And you can see down here, RMV, which we'll be talking about later, on this weekly chart, went right to zero right before the breakout. So we'll get into this indicator just very, very shortly, and how it can be helpful for identifying these tight areas. Here we've got another one. We've got Shopify. We've got this longer term base. I believe this is a daily chart. Yep, that's right. And we see these tight areas form where, we've got the base here, one contraction, two contraction, one really tight contraction. You can see how tight this range is relative to the rest of the base, where we're moving up and down. And then we really tighten up on the right-hand side. Volume is below average, below the moving average here. And then we break out and even form kind of more tight areas, more potential spots and entry points along the way. But we continue to, move up on higher volume, go tight, move up on higher volume, go tight, move up on higher volume, go tight, and, so on and so forth. So you often see that up the right-hand side, especially in stocks that are under significant accumulation. There'll be very little give back, and it will continue to form these tight areas after the stock has even broken out. And those can be ad spots, or, if you missed it and it's not too far from the base pivot, it can still be a really good spot to add shares or start an initial position even. So that is Shopify. This moved 200% over the next year. Not quite sure if I remember exactly what year this resolved itself. All right. I see a question about how to enter as these are breaking out. We'll get to those key steps later on. That's kind of one of the last slides of this presentation. And like Kimberly said, all the above, you can use your own specific entry tactics to enter these larger term patterns. All right, here's Shopify again. I believe this is from 2017. Again, we've got a base forming here, and this is actually part of a longer term uptrend from its IPO move. And we form a base here. And again, we see tightening from left to right, a nice move up the right-hand side, then 4 days, which get really, really tight, pull back, very low volume, and then we explode upward and break out of this multi-month base on very high volume. So again, an example of a VCP with that last contraction being the short-term flag here. And that's what we can, look to identify. And again, RMV going to zero right during this flag, helping you identify that tight area really effectively. Here we've got the famous Google IPO base. It shows the same kind of VCP characteristics, where we've got a consolidation, a really tight area that forms relative to prior price action, and then a breakout off the bottom. This often happens in these IPO bases. And, this is a much lower risk area to enter on this day here than if you wait until, we're at this high. As somebody asked earlier, what happens if the stock just moves up without forming a tight area? If you don't enter here where it's tight and you can manage risk, at the bottom of this day, the day before, or the bottom of this range here, if you wait until you're up here, the stock's been up 5 days straight. So there's not really any spot to manage risk, to put your stop loss at, because it could easily pull back, stop you out, then continue to go. So you have to look for a spot to manage risk, which was the ideal buy point was down here off the bottom as it forms this tight range, or even, here it forms, a short flag here, pushes up here as it resumes to the upside on increased volume. So you can always find spots to manage risk. And those are tight areas throughout the move, whether that's the very beginning or kind of continuation tight areas as the stock progresses higher. All right, here we've got one of my favorite charts to study. We've got Tesla in 2019. This was the monster gap that it had where I think it was first turning profitable and kind of turned the corner in terms of its guidance. We saw a huge volume on this gap, huge continuation volume on this gap the next day as it progressed further. And then, if you didn't get involved here, it's not too late, as we well know, because if we know what happened afterwards. We wait for a stock to form a tight range, which it does right here. You can see RMV come down to right near zero. We form a pivot here. This is the range. This is the tight area. It pushes higher. And then even here, if you missed it, it wasn't that big a deal. You might have even got stopped on this gap down, but it always is going to form another tight range if it's going to progress higher. And it does right here. It gets super tight, then pushes higher on a pickup in volume. You can see how low the volume was during this tight range. And then we see that definitive pickup in volume as we progress higher. And this was right at the end of 2019 in the fall. I remember it really clearly because I missed it. We just progressed higher, and I think it was up over 100% in just a matter of days and went into a climax run before kind of the April pullback due to the COVID correction. But really nice tight area here. So once you identify kind of that changing character, that longer term uptrend, the signs of accumulation where you've got a big gap up on volume, strong push higher, then you got to wait for that tight range to form and look to, use your entry tactics and resolve and enter the stock as they push through those pivots. And we've got a tight area here. We've got one here as well that would have been really great entries into a promising stock that was already showing signs of accumulation. We're not trying to buy a stock that nobody's heard of, that's not showing any, positive signs, that's just in a downtrend because we think it can't go lower. We're looking to buy strength. We're looking to buy continuation patterns after the stock has already shown its hand and shown that it's being accumulated. And there we go. It was 190% in just under 70 days. A really powerful move and a great one to study if you want to go back to 2019, 2020. All right, so I want to kind of give you a little bit of work here today to make sure that you're not just listening to me and you're actually applying these concepts. So I want you to kind of train your eyes to look for the tight areas in VCP action that we've been talking about today. So as I mentioned, tight ranges, tight closes, low volume up the right-hand side of the base. That's what we're looking for. This price tightness, these tight areas can be as little as 2 to 3 days. And as we'll get into, we're looking for, on RMV, about a value of 12 or less, maybe 15 or less. The tighter, the better. The closer to zero, the better. But we'll get into how that can help you spot these tight areas in just a few slides. But in this chart of PLTR, I want you to think to yourself, where are the tight areas on the chart? So just take a moment here. I believe I have the answers on the next slide. So hopefully you guys didn't see that too much. So take a moment and look at this chart, and maybe I can even blow it up a little bit here. And think to yourself, where would you identify the tight areas here? And I have kind of two marked with pivots, but think to yourself, we'll just take 20 seconds here. Think to yourself and identify where are the tight areas during the run. And we'll cover the examples, the answers in just a minute here. All right. I should have had some music here, some TikToks. Maybe, Rye, you could hum some music for us. I see a question. What is RMV? RMV is relative measured volatility. It's an indicator that we've developed to help you identify these tight areas. So a clue might be in finding these tight areas is looking for RMV to get really low within its range, close to zero. but we'll show the answers in just a second here. I see a few people dropping dates there. That's good. So I just want to make sure to give you guys the chance to identify for yourself. All right. So let's go ahead and show the answers. Let me zoom out. Okay. So here are the tight areas that I identified up the right-hand side. We've got this first IPO base here. It actually is pretty tight during these downtrends. So if you pick these, I wouldn't be mad here. Even these 2 days are pretty tight, but it really forms a nice range here below this pivot right here. Again, we're always looking for ranges within ranges, and we get a nice breakout. But then, as I mentioned, the stocks under accumulation will continue to form these tight areas. We get one here for a few days, it pushes up. We get this one for a few days, pushes up. That's the end of really the climactic IPO move. But even within this base, we see tight areas here for these 2 days, tight areas within this range. These 3 days are tight. These 4 days are tight. So again, they can be very short term, but we're looking for these characteristics that are signs of accumulation, but also, again, potential entry points up the right-hand side of a base. So here, we're kind of moving up the right-hand side. We've got this tight area. This could be viable. We go tight again. We try to push out. This fails. You might get stopped out here. But then on this last tight area, we get that breakout on huge volume. And this could have been a really nice swing trade up the right-hand side. So these are the kind of the tight areas I picked out. Again, there could be a little bit more, but let me know in the comments how many of these you saw. And if you didn't, maybe you're newer to this and this is great practice for you. If you got all of them, fantastic. You can tune out of the webinar right now. Just kidding. Don't do that. But hopefully you guys got a decent amount of these, but if you didn't, that's what we're shooting for today, to help you identify more and more. And the RMV indicator, as we'll get to, can help you spot them really, really easily. So let's go ahead and push on here. All right. So this answers the question that people were asking in just a minute. What is RMV? RMV stands for relative measured volatility. If you think about what that means what is the volatility of the recent range relative to recent price action, normal price action of the stock. So RMV, what it does is it compares the current volatility to the average over a certain look back period. And typically by default, we use a 15-day look back period, but you can set this to whatever you want in Deep View. So you're basically comparing the current volatility to the average volatility of that look back period and seeing whether that current volatility is a lot higher than normal as we're seeing price expansion, or it's a lot tighter than normal where we're forming a tight area, a tight range, as we've been talking about. So RMV ranges from a score, a value of 0 to 100. The closer to 100 it is, that basically means that we're expanding in terms of volatility. We're seeing expansion, and the closer to 0, the tighter we're getting in terms of the price action. And as I mentioned, we typically use a default of 15 days. That's what I found is most useful on the daily chart for growth stocks. But in special cases, as we'll get to, you might want to change that default value. Diving deeper and just kind of showing this visually, this is a chart that I'm sure a lot of people are familiar with. You've all been watching it recently. We've got NVIDIA here. We've got the prior uptrend. We've got the formation of a base. And let's take a look at how RMV changes with respect to the price action. So here we're seeing a big spike in RMV all the way up to 100. What happened? The stock gapped up on earnings. We're seeing price expansion. Then, over here on the right side, we're forming a range here of 5-6 days. What's RMV doing? We're contracting because this price action is tighter than the recent price action and what's normal for the stock. So RMV, as it gets closer to 0, that basically means we're forming a tight range. As it expands, it means we're expanding relative to the recent price action. So these 2 days moving up is a lot more volatile than the recent price action, which was pretty tight closes as we pull back here. So that kind of created this price expansion and push towards 100 on RMV. But very simply, we want to look for, in terms of, if we're looking for tight areas, we want to look for points where RMV is declining really sharply and getting as close to 100 as possible. Here, after this gap up, we see a tight range form right here with these 3 bars. What's RMV doing? It's pulling back sharply and forming a little kind of trough here. These troughs are what you want to really highlight here. We've got another one here as we get really tight, these two bars. We get really tight here where we're forming this tight 3-day range. And then we get tight again here within this handle which we just kind of resolved to the upside, and we're starting to see this price expansion. So in terms of finding tight areas and kind of the hack, the cheat sheet for finding those VCP pivots and all that, we're looking for RMV to get as close to 100 to 0 as possible. And we'll go through a lot of examples to kind of bring this to life, as I mentioned. Rai, are there any questions so far that you want me to answer that I haven't really addressed just yet?
There's a question on the look back period and how that works.
Yeah, so for an indicator like this, because we're looking at a relative basis, we have to set a window of price action to compare the recent price action to. So the look back period is that duration, that subset of price action that we're using to set the standard for volatility over that period. So if we're currently on this day here, we're using a look back period of 15 days to kind of decide, what is normal volatility over the course of this price action. And if the current price action is a lot less volatile to that standard, then RMV will be close to 0. If we're currently expanding either to the upside or downside, and we're a lot more volatile than that look back period of 15 days, then RMV will, basically be pushing towards 100 because we're on the upper edge of that range. It's kind of like a stochastic, if you guys are familiar with that. But really good question. Anything else, Rai, that you think I should go over before we keep going?
How is tight different than sideways? I think that's a good question to tackle. Is tight price action versus sideways price action?
I think it's pretty similar. Tight can also be a slight drift down, and that's kind of what I prefer personally. But tight could also be a slight drift up, but we want very, very slight. So I would say in general, you're pretty much looking for the same thing, but sideways suggests more of a longer term tight area to me. This is kind of a really nice, drift down sideways. But this is also a tight area. So I think they're pretty much synonymous. I can't say that word right now. But tight, it can be a lot less than, this is 5, 6, 7 days, while tight can just be 1 or 2 days, and that can form a pivot that can be a really good entry point. But right. I like that question.
And the depth on sideways price action can be more than 3, 4, 5%. Whereas when you say tight, you want to define your risk to be within 2, 3%, if not less, depending on the type of trader you are, right? So the high to low in that range for tight is always much more narrow. You could define your risk much better. And in sideways price action, it could turn into a flat base for all we know, right? And at that point, it might not be considered tight whatsoever. So
yeah, I'd say it also depends on the character of the stock, right? Whether it's a really volatile name or it's a slow mover that's been around for 20 years. And that's where RMV kind of comes in really handy because it adjusts to whatever the character of the stock is. A volatile stock, if the volatility on a relative basis is declining, we're still going to get that RMV signal. And if it's a stock that has 1 billion shares, it's been out forever, you think it moves, we see a great trend like this and it actually moves only 5%, we're still going to see those same RMV signals because it adjusts to the character. It's normalized to the character of the stock. So that's another great thing about RMV. Anything else, Rai, before we go on?
No, I think we keep going.
Okay. Hopefully with these examples and the live charts we're going to go through, everything comes to life, but hopefully we can answer as many questions as possible. So here we've got an example. We've got another example of interpreting RMV. This is another stock that I'm sure all of you guys are familiar with. We've got SMCI. We've got, clear price expansion where we see spikes up to 100 as the stock is pushing higher. Then we push lower and we see a little bit of price expansion. But overall here, we're seeing price get tighter, RMV come down. We see a drop all the way to 0 on these tight days. You can see how tight these are relative to this price action here. Look how we're going sideways, not moving up and down much at all. Tight closes, all of that. That's what causes, this to go to 0. Then again, we push higher, we break out of this range. We're seeing price expansion. Then we contract, form this sideways range. And again, we're seeing RMV reflect that, fall all the way to 0. And then we get some more expansion, this time to the downside, form a little bit of a tight range. We pull back slightly, then we expand up, we break out in a big way and see that price expansion. This pushes 0. So again, the key thing with RMV, price expansion is when we move higher towards 100. A tight area is when we get really close to zero and go sideways for, at least 1 to 2, 3 days and form a tight range. So in terms of the tight ranges here, we've got one here, we've got one here, and we've got one here. And this overall is a little bit tight relative to normal price action. And back here, we've got a tight range as well. You can see 1, 2, 3 days. All of these are pretty much grouped right on top of each other, going sideways. We see RMV drop really low. So this is a good example of RMV and expansion, power, and then a tight area that could be used as a really good entry point, and a very subtle entry point that most traders who aren't like Oliver Kell, aren't a top trader, they won't spot this entry point, this short-term pivot where you can manage risk at these lows, this low of the day, and jump on this trend. But if you're using RMV, you'll be spotting this point just like those top traders, and that's what I think is the real benefit of this indicator, is highlighting these subtle tight areas that are a sign of accumulation, and then again a potential entry point into the stock. So I saw. Okay, welcome back, everybody. It's my pleasure to introduce our next presenter, Deepak Uppal. Deepak is a top performer in the U.S. Investing Championship, where in 2023 he returned 259%, and he is currently among the top competitors in the Money Manager division this year in 2024. And he'll be presenting on likely the most important part of trading. This is something I'm really excited about, risk management, stop loss management. I know many of you have questions about this topic, and hopefully we'll get a chance to cover and answer all of those here today. Deepak, thank you so much for being a part of this, and really looking forward to this.
Thanks, Richard. I appreciate you having me join you for this conference. It's a great honor to be part of it, and I think you guys do a great job. So I'm excited to be here and share kind of what I think is, like you said, a very important topic, which is risk management for consistent returns. So let me go ahead and dive into this. All right. So in terms of the agenda that I want to cover is, I'll kind of go through my background, how I think about risk management, and then talk a little bit about each of those aspects of risk management, and then get into some examples of, some trades that I've taken and, how I kind of manage my risk. And then, some books and resources I found useful during my trading journey. And then we can open it up to Q&A to end it. Sound
Awesome.
good?
Let's dive in.
All right. So just in terms of my background, I've been trading for over 30 years, and mostly just kind of on my own, just trying to figure things out. And over those 30 years, I probably have made like all the mistakes people think about and hear about when they read books and talk to other folks. But, I traded obviously stocks, I traded options, I traded Forex for a little bit, I traded Bitcoin, you name it, I tried it, and, was not successful for many, many years because I really didn't put any structure around my trading. And so, that trading was not my background. It was just something that I was found really fascinating and interesting. My background, for 30 years, what I did was I was in management consulting and in tech or software sales. And like you mentioned, I really took me a long time to kind of get to where I am, but I, studied and took some more structured kind of courses and read books and all this other stuff to kind of get to where I am. And I'll talk a little bit about some of the resources I used at the end that I found very, very helpful, that kind of helped me turn turned things around for me as a trader. And as of last year, I decided to put my skills to the test and go up against other great traders. And I finished in 5th place last year, as you mentioned, with a 259% return. And this year, I also decided to join the investing championship as well in the money manager division. And at the end of Q1, I was in 2nd place with a 45.7% return. I think the Q2 standings will probably come out in the next couple of weeks. So, excited to see kind of where I fit at the end of Q2. But, like I said, I really am very passionate about trading, and it took me over 30 years. But as of the start of last year, I decided to just do it full time because I had, the confidence in the skills and kind of what I had learned. And, that's what I do, and I love it, and I enjoy it thoroughly. Down below on the slide is a link to the interview, Richard, that you and I did in early January after the 2023 standings came out. And in that interview, if anyone's interested, I kind of go into a lot of the detail of, what I did and kind of the way I think about trading and how I pick stocks and other things. So if anyone's interested, feel free to take a couple hours and go through that video.
Yeah,
But,
just jumping in. I just want to double click on that. I think it's a really good, great resource. And today you're going to focus on risk management, but you really cover your whole process there and go through a lot more examples. So yeah, I would definitely recommend it for people after watching this. Take a look at that for sure.
Yep. So, one of the things that, people always ask me, or friends, when you're talking to them and, they know what I'm doing, it's like, hey, what stock should I buy? What should I buy? What's going to move up or what's doing well? And, I can rattle off a handful of stocks and tickers that they should be thinking about that are looking good. But at the end of the day, if I gave those tickers to like 5 people or 10 people and I gave them a month, like they'd all end up with different returns. And only a handful of folks would probably make anything substantial out of those tickers. Because, I think people are just kind of wanting the tickers and buy, but then they don't know what to do. Like, how do you manage your risk? How do you know when to sell, et cetera? And so to me, in my trading journey, one of the biggest things that, was an aha moment for me was really learning about risk management. And I think that's the key to consistent returns. I mean, picking stocks is important and picking the right stocks is important, but I think we all spend way too much time trying to figure that out. But to me, I think it's an important part, but a smaller part versus risk management. And, when I think about risk management and through my journey, kind of here's the 4 things that I found to be like the most important when you start thinking about risk management and getting consistent returns. One is market conditions. You really need to understand what market you're in as you're making your trades. And then the second thing is position sizing. That's real important. And I'm not sure too many people talk about position sizing, but I think, that's something that I'll go into. But it was a big learning experience for me, and it took me a while to kind of understand how to size my positions without getting, nervous and things like that. But I think a lot of that comes through understanding how you manage your risk. And then, small losses is obvious, using stops. That's something that, you hear about, but everyone's a little different on that. And for me, that was kind of a big hurdle to get over for whatever reason. It took me a while to kind of, do an introspection of myself and why I wasn't using stops. And that took me a little bit of time to kind of work through that. And then the last thing I think really is the most important is to understand your math, not the math, but your math. Like, how do you trade? What are your average returns? What are your average losses? What's your winning percentage? And then, understand that and understand whatever edge you're trying to use and work that into the math and understand that very, very well. So that you can be consistent about getting returns. One of the big things that I had problems with was that I'd have great returns when the market was great, but then I'd lose it all when the market went down. And that up and down really was frustrating. and really took a lot of time to really figure out what I was doing wrong. On the right side, there is kind of my equity curve from last year during the competition from that account. And as you can see, you know, most of my gains were in the middle of the year, like through the end of July. And I basically could have just been in cash the rest of the time and probably ended up pretty close to, you know, where I was. And, you know, I went through a lot of trading from July through December to end up actually a little lower than where I was at the end of July. So, you know, I think it's important to understand, you know, the market conditions and sizing and all that. And I'm going to get into that. But one of the things that I always hear about, or not hear about, is I follow Dan Fitzpatrick from Stock Market Mentor. And one of the things he always says is don't lose your dough. You know, otherwise you're going to be working at a 7-Eleven or something to make your money back. But it kind of just sticks with me all the time, is that, you know, the most precious thing you have is your capital, and you want to treat it like gold, and you know, do whatever you can to keep it safe. So a big lesson that I learned was, you know, really think about the capital that you have and not letting that go. So one of the things I did early on was I started to look at market conditions and trying to figure out, like, you know, how do you know what the market conditions are? Here's an example of last year, right? Like when you look at the spiders from last year, they kind of had 3 or 4 phases, I would say. You know, the first part of the year was pretty flat, a little choppy, I'd say. It went up, it came down, went back up. But really from May through like the middle of July was really the sweet spot where we were in a great uptrend. And then, you know, from middle or end of July till like the end of November almost, you know, the market was basically going down. And, you know, then it kind of turned around at the end of November and went up. And when I looked at that and compared that to like my equity curve, and I did this earlier, you know, previous years to it was kind of an aha moment for me. But if you look at my equity curve from the right from last year, from the competition, right? I mean, it mirrors exactly kind of what the market was doing. And so the first part of the year, in the yellow, you can see there, you know, I was pretty choppy as well. I kind of followed, you know, what kind of the market was doing. But then, you know, in May through July, I also kind of I was part of that. I was able to make some good returns during that time. And if you look, you know, I mean, it took me about a month or 2 months, and I was able to get a 200% return during that time. I mean, that's all it takes. You need just one good time of the year to jump on board and understand what you're doing, understand the market you're in, and try to get that return. I'm not saying it's easy, but it's something definitely that you need to bear in mind, that you can't be trading all the time. And then the last part here, you know, was during the correction. And this, I actually kind of had a difficult time during this period as part of the competition. Actually, my competition account actually went down because I was trying to be too aggressive and pressing to try to get the returns to, you know, during the competition. It's interesting because when I look at my other account that wasn't in the competition, it didn't go down as much, and it was fairly flat because I wasn't in the market as much trying to get the gains. So, and then at the end, you can see I, you know, came back a little bit, you know, in December when the market was doing well. So it was an interesting exercise for me to do, because it kind of helped me understand, you know, how was I trading during those periods. And I'd say that's a great exercise for folks to do. You know, go pull up the equity curve, your equity curve from your account from last year, and compare it to the market cycle. And how does it compare? You know, were you able to, you know, avoid the chop and the downturn here, or were you able to make a good solid return during, you know, the May to July timeframe? And, you know, if you weren't, dig into your trades. What were you trading? How much were you buying? What were your position sizes? You know, those are some things to kind of take a look at, so you can start to kind of dissect your tendencies in terms of how you trade and kind of what kind of returns you're getting.
I just wanted to jump in with a question. You know, obviously that period where you did phenomenally and got 200% or near 200% was a really fantastic period. And I like how you mentioned, you know, it just takes one period like that to make your year. In a typical year, how often do those opportunities arise where you get that kind of 2-month period where you can really step on the gas and make good gains? And, you know, maybe what are some things to kind of recognize in the moment that, hey, things are really, market conditions are good, and this is when I should be trying to accelerate and make that money when the market is good.
Right. I mean, and that's, that's the big task of
question.
trading, right? Trying to
Yeah.
understand what that is. So I'm going to talk a little bit about that, but I think it's a variety of different things. It's not like one thing you look at. You got to kind of judge it and feel it. But I think, like, when you look at a typical year, you probably get that a couple times a year, 2 to 3 times, I'd say at the most. It depends on the year too, right? If you're in a bear market, you're not going to get that, right? But if you're in a good market like we've been, we had a couple, it looks like two to three times last year where it was like this. This year we've had it, once or twice, I'd say, so far. It's been a little choppier this year than last year. We didn't really get that really nice, smooth sailing, kind of like we did from May through July last year. But yeah, I'd say 2 to 3 times a year, you could probably get those sorts of periods of time, and they may not be 2 months, they may be a month, but that's really when you have to strike and go get your returns.
Yeah. And one more thing, or actually, sorry, I'll let you finish your point if you had more to add.
No, that was it.
Yeah, I just want to say and kind of ask, and the rest of the year is your goal to just kind of, not hurt yourself, not overtrade, pretty much go flat during those periods when you're not trying to step on the gas.
Yeah, exactly. I mean, my goal is to try to stay even, flat, or, lose very minimal. You're going to get drawdowns during those periods because, you're just always feeling out the market and things, but, you want to try to avoid the big drawdowns during those periods.
Yep. Sorry to jump in. I just think.
Yeah, no. So, market conditions is a real important thing to understand. And it took me a long time to kind of figure this out as a key component of trading and managing your risk. So when I look at, how do you tell the market conditions, right? There's a few things that I look at, and I'll kind of walk through these. One is market cycles. If you go out there, there's lots of these available, or you got to subscribe to some of them, or if you're part of a service, they sometimes have these charts, but there's different cycles that are out there, right? There's a 10-year market cycle that says that, in general, here's how kind of markets behave on a 10-year cycle, right? And then there's a 4-year presidential cycle that has an impact on the market. And then there's seasonal cycles, right? Like from September through October is usually not the best time, but November through January is usually a pretty strong time in the market where you really get good returns. That's not to say that happens every time, but if mentally you kind of just have these cycles in your mind, it's helpful. It helps me out. For example, in this one, right, this is from 2024, the S&P composite cycle. And you just want to see kind of what's the trend, right? I mean, here it is kind of a little choppy. It's up, but it's moving up, right? You get a little downturn, but then from June through, September, it looks like it's a pretty decent up cycle. Then we got a little some pullback through, November, and then it's up from that point on. So kind of similar to last year's cycle, but not that I'm going to trade off of this, but it's just mentally good to know, like, this is where we are in terms of this cycle, and just see how the market's doing, right? So that's one part of it. Just that gives you the big picture of where are we in the cycle for this year, right? And then you kind of look at the daily market. I look at the daily market environment as well. So there's a few things that I've got, and I shared this in the video that we did earlier in the year as well. But I've got just a little piece of paper that I go through, and every day just write down the things that are going on in the market and the things that I look at. You may have other things, but these are the things that I like to look at. I like to look at what's the VIX at, what's the put call ratio at. I look at the percentage of stocks over the 200-day. I look at the bulls versus the bears to get an idea of sentiment. I also look at the CNN greed index, kind of gives you an idea also on sentiment. I pay attention to the IBD market trend. And then there's a few other proprietary indicators that I follow that are part of a couple of services that I use. So, I kind of have all that every day. I kind of look at it, see kind of what's this telling me from a daily market environment. It's a little bit more detailed, I think, than the market cycles. But at the end of the day, the best way to tell kind of what the market environment is your stock action. you're making trades, you're seeing how they do, and you're looking at looking at the performance of the stocks when they break out. Are they going up? Are they coming right back down to where they broke out, or dropping down? And the most important is, how's your portfolio doing? Like, if you start seeing traction in your portfolio and you're starting to see some good gains, well, that's an indication that, the market may be in one of those market trends where it's starting to go up. But, if the stocks you're buying, if you're buying good stocks that are set up properly and they're breaking out and they're running, that's probably the best indication that you're onto something, and that, we may be at the start of a market rally. And one of the quotes, that I think is real important, that I try to think about all the time, is you don't need to trade every day of every year. That's something Jesse Livermore said, and I think it rings true. If you're trying to be consistent and you're trying to get those big returns. So for me, general market conditions is a key component of managing your risk.
And you mentioned that stock action was kind of the most important of these three. How would you kind of weight the other two in terms of, what you consider when you're determining how you're going to be managing risk, how much risk you're going to have, how aggressive you're going to trade, all those different things?
Yeah, I mean, you may have stocks that are breaking out, but it's kind of like where we are now, right? I mean, we're kind of way overextended, though the VIX is low, but the sentiment is really, really bullish right now, which tends to scare me. It's at close to extreme levels. And so, if you look at an IBD, bulls versus bears, right, you can see that we are pushing the top edge of the bulls. So that's kind of something that kind of scares me. So even though I'm aggressive, I'm definitely not as aggressive as I probably was a month ago. Mm-hmm. So, I think that's kind of how I use that daily market environment piece of it. There's some indicators that are just saying, the percentage of stocks over 200 days is also very low right now. And so, those two things kind of scare me overall, and the VIX is super low, so everyone's really giddy. But if things are working, keep going. And, that's kind of what it comes down to. So you got to balance it out. It's not one thing trumps everything else. It's kind of a balancing act, if you will.
Yeah. Holistic. Yeah. Nice.
Yeah. Yeah. So that's it on general market conditions. And then when you go on to, position sizing is also something that I think is real important, especially when you combine it with market conditions. This is something that took me a long time to figure out what to do, because my general operating procedure was I'd always buy the same amount of a stock that I was buying. I wouldn't buy more. Just A, I was scared, and B, I just assumed hey, if I buy 1,000 shares, it's good. If it goes up a few points, that's great, or it'll double or whatever, right? And it wasn't until I read some books, especially Mark Minervini's books, talking about concentration of a portfolio in a few stocks. I started to look at it and really dissect it a little bit and run some kind of scenarios around it. And I was of the mindset, what you always hear is diversify, it lowers your risk, buy 10%, buy 10 positions in your portfolio, and you're good to go, right? And if you have a small stock account, right, having 10 positions isn't going to get you anywhere, because everything's always going up and down, right? So it kind of neutralizes everything. And that's kind of how you would probably get market returns, right? So for me, one of the big things was understanding how you size your portfolio or your positions in your portfolio. So for me, concentration is one of the key things that I've figured out is the key to making big returns. And but you have to do it at the right time. So 4 to 5 positions at the most, 20-25% position size. And I'll take even larger positions, 25% plus, if markets are in a strong uptrend. And that's the key. If you're in a strong uptrend and things are just going, I would be of the mindset of having 1 or 2 positions to really, you need to be in the right stocks, obviously, that are the stocks of the moment, if you will, and really press the gas to get those returns. And then, having a lower concentration of a 5 to 10% concentration on a stock trade is kind of what I would do is in a difficult market environment. Or if we're, in a bear market and you just want to kind of get a feel for stuff, testing the waters, buying some small number of shares to see how things are going versus, being aggressive when market conditions aren't warranting that. And then the last thing is cash, during a correction or a bear market, cash is something that a lot of folks don't think about, like they always need to be in the market, something needs to be working. And so that was kind of a learning for me as well, because I did all these things, right? Markets going down, I'm buying, my normal 1,000 shares and getting clobbered, not going into cash because, there's always percentages to be made, right? No matter what. And so those are some things that I had to rewire the way I think. And those were really, really helpful for me in terms of trying to understand how you manage risk in your portfolio. So let's talk a little bit about, I talk about, being concentrated and having, especially when the market's good, right? Or even when the market's bad. One of the key things you need to learn to do that took me a long time was to use stop losses. There's lots of different things around stop losses, and I'm going to just boil it down. It's by no means kind of a full list of types of stop losses, but when you read a lot of books, they say, hey, just use an 8% generic stop loss. Once you make a trade, go 8% and you're good to go. There's a technical stop loss. So if you're looking at it from a technical perspective, there's certain areas that make sense to put a stop loss on. So you need to, look at those potentially as an area for a stop loss, or you can use even a trailing stop as a stop loss, right? Especially if a stock's moving quickly or really kind of accelerating to the upside. But a lot of people don't use stop losses, and there's a variety of reasons. These are just a few that that I put down that I think that I was probably guilty of, right? It's an admission that I was wrong on a trade. I always believe that if a stock goes down, it'll come back. Or it was just being lazy, right? Not doing it, not going through the work of figuring out that trade fully, not understanding the math of investing, which was kind of an important thing that I don't think a lot of folks take the time to do. I didn't do it for 20 plus years probably, but once I kind of got into it and started to understand what that meant, it was really it changed my game. Or people don't know where to put the stops based on technicals of a chart, or else some people think stops don't work because they always get hit and the stock turns around and then runs, and they weren't in the stock. Those are called shakeouts. So it happens, and you guys just deal with it and live with it. It's part of the business that trading is all about. So Mark Minervini, uses this great quote: "Not using stops is like driving without brakes," right? That you'd be insane to drive without brakes in your car. It's a similar sort of thing with your money, right? Why take a stock trade and all the money is at risk that you have on that trade, right? Versus if you have a stop, you can manage that risk in terms of how much, where that stop is and how much risk you're taking. So stop losses are so important. And this is something that I think a lot of people struggle with. And it's just something that you need to kind of think through, why you would take a risk on all your capital that's in that trade versus managing that risk and just taking a smaller loss. You can always go back right into the stock if it starts to turn around and jump right back in.
Yeah, I love the bullets there, and especially the last one. And to your point on shakeouts, you can always buy it back on the next setup if it tightens up again. And sometimes the shakeout almost improves the setup in a way because you shook out all the weak holders, and then the stock can be ready to rip. So yeah, I love those points right there.
Yep. So stop losses, I think, is a real important thing to understand, and to figure out, if you're not using them, why you're not using them, and if you are using them, figuring out if you're getting stopped out a lot, there could be a lot of different reasons of why. Maybe you're not buying it right. Maybe your stops are too tight. I mean, there's a whole variety of reasons, but that's where I think it'd be a good exercise to take some of those trades that you've made and put them onto a chart and, you know, where'd you buy it? Where was your stop? And then take a look at it and see if it makes sense. The other thing that I think that for me was also a real important thing was understanding the math. And, you know, for me, there's really two types of risk that you're trying to manage, right? One is your portfolio risk, or the capital that you have. And typically on a trade, you want to probably not risk more than 1 or maybe 2%, 2.5% of your portfolio on a particular trade. So, and then the second thing is, well, let me talk about the portfolio risk piece of it first. So I've got this portfolio tracker that it's just an Excel sheet, right, that I put in. And really, I just update the portfolio value when it goes up. I'll put in the current value. My max loss is usually, you know, for me, I use a little bit higher, but, you know, max loss is 1%, maybe 1.5%. And then I've got the risk, the 1R, you know, which is the risk you're taking. The 2R is, you know, if you double for every dollar you invest, you make double. 2R is kind of, you know, kind of the ideal, typical what you're trying to do. But, you know, obviously you're trying to get higher than 2R return on your trade. And, you know, mine goes across the board, you know, from 3, 4, 5, 6, 7, 8 on the spreadsheet, but I cut it off here at 3. But, you know, so that kind of gives you an idea of, like, when you look at your portfolio, you see it's up like $4,000 on that trade. You know, you're at 4R of your risk typically, so you may want to sell or cut it in half. So at least now you've gone to a 2R in the bank, if you will.
Right.
You know, so this is something simple to do. So if I was going to buy NVIDIA, for example, you know, I'd put in the price that it was at. It's at 122. I've got mine set at 25% of my portfolio. That means I can buy 204 shares. And to be at a 1% portfolio risk, I can have a $4.90 risk on that trade. So once I know what my max risk is, then I got to look to say, okay, if I buy it at this price, does a technical stop make sense on this? Or should I just use the 490 and go into it? And what are the chances of me getting stopped out because it's just like not really a good technical spot to put the risk? And I'll walk through some examples of this too. And then on the other side, you know, like I said, I always heard like, you know, take an 8% risk on your trade, right? And in this example, if I were to take an 8% risk, a max risk on this same trade, right, I'd have to take a $9.79 stop loss, which would mean I'd be risking, you know, close to $2,000 or 2% of my portfolio. And it sounds simple. It's kind of like, no kidding, like that makes, you know, total sense. But I never used to think about things in that perspective. I used to just say, okay, I'm going to put an 8% risk, right? 8% loss. But if I was only, you know, investing 12% of my portfolio, yeah, that would make sense because then my risk would be 1%. But if I was investing 50%, right, and I just used an 8% loss, I'd be risking quite a bit of my portfolio and my capital, which doesn't make sense. So using the max 8% loss just generically, I think is a bad idea, even though that's kind of what you read in a lot of the books that you read, especially, you know, like I remember that was always an IBD max risk is 8%. And once you kind of start to think about it and understand it in the perspective of managing your portfolio risk, I think it makes a little bit more sense, but you got to balance the two accordingly so that you're not just using an 8% max risk, if that makes sense.
Yeah, not by default using it.
Yeah, exactly. If it makes sense from a technical perspective and that's 8% and it's 1% of your portfolio, then that's great. Use it. So I'm going to walk through just some examples of kind of how I use this in my trading. And so the first example I'm going to use here is Palo Alto. So these are all really current trades, right? So when you looked at this thing was setting up really nicely. And so I took the trade, I bought it as it was coming out of this small like pivot or consolidation here. And I bought it as it was coming out at $322.62. And so I put it into this trade tracker. and I bought 25% of my portfolio, and it meant I could get 77 shares at $100,000 on a $100,000 portfolio, and my point risk was $12.90. So I could have gone down up to $12.90 on this trade for it to be within my 1%. But what I saw was that, you know, that would put it right down here at this point of this bar, which is kind of a risky place to put it, because chances are it could come down to here and there'd be nothing wrong with that trade, right? It could then shake you out and just go right back up. So I didn't want to use that as my stop. And so what I did was I actually took a little bit of a larger stop. I took a $15.19 stop to put it underneath the 21-day line here. And as the 21-day line was going up, I figured that that might be enough room for this to, if it was going to go underneath the 21, then I probably want to get stopped out versus taking that risk that it comes down to the 50-day here. And so I took a little bit of a bigger risk, but my thought process was, you know, I took a 1.16% of my capital was at risk on this trade, even though I took a larger point risk or dollar risk on the stop. But the risk on my stock trade was only 4.7%, which is, I think, a pretty good risk. You know, I try to keep it 3 to 4 to 5% in terms of my risk on a stock trade, right? However, if you look at it if I just use the generic 8% and I just said, hey, I'm going to buy it here, I'm going to put an 8% stop, right? I would have had almost 2% of my portfolio at risk, so close to $2,000 with a $25.80 stop. So I hope that makes kind of some sense in terms of how I think about a trade when I'm going into it. Like, those are the things that I'm looking at and thinking about just to manage my risk. And, you know, that's a 25% position size. And like I said, that would be like more with a good market like we've been having over the last month or two.
Are you often trying to put it just below the 21 EMA or what? Yeah, the 21 moving average there?
No, not necessarily, but like in this one, it was just so close to it. Like I would go underneath it. I mean, it just depends technically where the stock is. It's not a hard and fast rule that I would do that all the time.
Gotcha.
Because sometimes if it's really extended, you know, if I were to buy it here, for example, right, that would be way too low.
Right.
To put that stop. So yeah, it just happened that in this trade, this was so close to the 21-day. I just took the extra, I think it was like $1 or something extra, and put it underneath it just so there'd be a little bit more room. And also I saw that this was kind of moving up in an upward trajectory, that it would be kind of pretty below the 21-day. That should keep me hopefully from getting shaken out, and then you know, the stock turns around and moves.
And I think a question that people watching are probably asking is, you know, as the trade progresses and here pushed up after your buy point, are you, as you mentioned, are you continuing to use that 21-day moving average as your stops? You're kind of trailing it beneath that, or are you doing some other method to move up your stop as the trade works for you?
Yeah, so great question. I've got actually a slide I was going to show at the end, but what I would typically do is, like, once this thing starts to move and I've got a little bit of a cushion, I'll start to move up my stop, right? Like, and like I would probably move it up to like being right below these. Like if it was like, yeah, a couple bars here, like below that would be probably my next stop. And as the stock moves up, like I would keep moving it up. So stock stops are something that you should definitely be looking at like every day, right? Based on what the stock did the day before. And so you got to adjust your stop so that you're at least not going to lose money, especially if you're in the green, right? And at this point here, you know, a logical stop would be either right below this bar right here, or, you know, maybe it's kind of an interesting one because, you know, it could potentially fill this gap where it gapped up. And you could put it like right below there as well, like right below that close, a buck, you maybe $1 below it. But then you're risking a lot of your gains, right? So I probably wouldn't do that. I would probably just put it like right below this. Yeah,
and to ask a follow-up, would it be after we had that gap up that you would adjust your stop to below those two lows that are pretty close together, or at what point would you want to move it up to that point that you pointed out?
Yeah, I think I would probably, like, there wasn't really that much of a profit to begin with, even when it was up here. I mean, it was like $5. So it was okay, but it wasn't even probably close to 2R. So I would have probably I did wait on this one until it moved up till past that. Yeah.
No, that's perfect. Thanks.
Yeah. Here's another example of a trade that I took. So this was Eli Lilly. And as you can see, like, this was pretty good resistance here across over the last like probably 2 months, 3 months. And so when this thing broke out, I bought it on the first day at 801.23. And at 801.23, right, I actually loaded up on it just because I thought this thing was going to move. And I took a 75% position on this trade of my portfolio. So as I went through it, I took 94 shares and I could have a $10.68 stop to be within my 1% max loss on the portfolio. And so when you look at this, right, that was the max stop, which I did take. So my stop loss was at $789.73, right? Like it was right below the low of that open of that day. And so that's where I took the trade, and that's where I had my stop loss, $10.50, and I was risking about 1% of my capital. The risk on the stock trade, the actual trade risk on this trade was 1.3%. So if I got stopped out, I'd lose 1.3%. And so what ended up happening on this trade was, it was behaving pretty well. And then, like we talked about, it came down and it shook out the low on this, and I got shaken out. So I got shaken out of this thing, and it turned around and then just ripped. And it really, I guess I could have rebought it around here, but I didn't. And then, it just kind of took off, and it was one of those trades where you say, oh, shoot, I missed that. But that's what trading's about. I didn't, sit around and, cry about it, but it was, it kind of hurt a little bit, but it is what it is. I was safe with my money, and I did kind of what I would do all the time. So it was fine. Now, if you look at it, if I would have just taken the 8% generic stop, it probably would have worked out in this situation because I wouldn't have gotten stopped out. But my risk, if it had gone down, because it's a pretty volatile stock, I would have been risking almost $6,000 or 6% of my portfolio on this one trade, which is, just way too excessive. So, but that's the kind of stuff that happens. And this is just an example, like it happens to all of us, right? Like this kind of stuff. So you can't, you can't say the stops don't work. They're there for a reason.
Yeah, I don't remember who said it, but somebody said we manage risk in real time. So, as the stock is pulling back in there, it could easily have turned into a failed breakout. You don't know. So we gotta manage our risk when we have it and get out when we can, for sure.
Yeah, exactly. So, so I wanted to share that example. And it was a very oversized, when you look at it, it was a very oversized trade at 75%. So, when you look at it and, everyone's like, wow, that's so, risky of you to take a huge one big position like that in your portfolio. But when you look at it, if you manage it properly, like you're not taking that big a risk, right? I was taking a 1% risk on my portfolio on that trade, which is like any other trade that I would do. But I thought that the upside would have been much larger, and in this case it was larger, but I got shaken out, so that's the way it goes. But taking a large position or concentrating your portfolio into one or two stocks doesn't mean that you're just being very risky and just kind of like gambling, if you will, in your portfolio. The next trade was NVIDIA. So one of the things that, one of the things that I've learned to do, and I typically do it all the time, is like I won't hold over earnings no matter what. Like even if I have a cushion, usually I'll sell out. And if I have, and the reason I do that is that if I keep a small position over earnings, to me, it's kind of like, okay, I'll keep it, but, I'm not really going to make that much on it. But my downside is always there, right? So why do that? I'd rather just sell it, take my profits, and then let the earnings come out, because if the earnings are good, you know, we'll see how the stock reacts. But if they're bad, or, you know, they're okay, but the stock goes down anyways because expectations were too high, chances are you might have a better trade that it could just, you know, come back up the next day right after it falls. It might give you a good buying opportunity. But here's an example of NVIDIA of after the last earnings, right? I sold out the day of the earnings, before the earnings were going to be announced on this day. And I had bought this earlier, so I had a nice profit going on this trade. I sold it, and then the next day when it opened, obviously they had these stellar results. The stock gapped up quite a bit. I forgot what the percentage was, but it was I think it was like 10% or something like that. It was up at the open. And so what I did was, and you know, everyone was upping their targets, and so the situation was right that I just took the stock right kind of when it opened within the first 5 minutes. And I took a 50% position on it, right? So it was a pretty aggressive trade for a stock that was already up 10% at the open. So what I did was I took the trade, I bought it at 102.44 and on this day, but what I did was I put my stop right below the low of the day. So wherever it opened, that was the low. I put a stop right below it. And if the stock was going to go break that, then I knew that it was not a good trade, right? Or it was going to try to go back and fill that gap. And so I put my stop at around $100.73. So when I, you know, put it through the tracker, 102.44, I got 488 shares, and my risk was $2.05 was the max loss that I could take. But when I looked at it from a technical side, right, my technical stop was a lot less. It was $1.71. So my risk was really small on this trade. So I just put it right underneath there and just held it. It never broke that low of the open, and it just kind of, you know, started to run after that. So you look at it, I was risking 0.83% of my capital on my portfolio. The risk on the stock trade was only 1.6%. So if I would have gotten stopped out, it was really minimal. But for me, I thought that the upside was huge on this stock, just based on kind of how the market was treating NVIDIA, AI, and all that, right? So that was the theme. And so I was pretty comfortable making that sort of a trade. However, if I would use an 8% generic stop on that trade, it would have been about 4% of the portfolio, which is a little too large, I think, especially at a 50% position size. And so, you know, this trade worked. And in this situation, it gapped up again. And I had to stop right underneath this gap the next day. And I did get stopped out. But, you know, I made quite a few points on it. I think like 10%, 15% on that trade. So it was a good trade. And, you know, now I just waited to reset, and it reset over here a little bit. So I bought some more, but a similar sort of thought process of my buy at this point as well.
And it sounds like mentally, each time you traded it, it was a new trade for you, because you mentioned even before the earnings gap, you owned it and you sold it beforehand, and you're treating every new trade, you're going through the same process. What is my risk on the stock? What's my risk to my portfolio? And just recalculating that every time.
Correct. Yep. Every trade I take, like even if I buy in like, you know, increments, then each trade is separate.
Right.
All right. So that's the NVIDIA example. Here's an example from Meta. So this is a stock that, you know, has been consolidating for a while. And to me, it looked good. Like there was a little pivot forming here, a little consolidation. So I wanted to buy coming out of here on this date. And so I did buy it when it broke out of this consolidation, and I bought it at $505, 25% of my portfolio, so I could buy 50 shares, and the risk I could take was $20.20 on that trade to fall within the 1% max. And so when I looked at it, right, once again, the $20 would have been probably somewhere around $20 from 505 would have been about 185 or 485, which would have been around here, which would have been fine. I think that would have been a good stop loss. But then when you look to the left, you see this long bar, right? And I mean, this was a pretty bullish bar. And so I thought, well, this would be kind of like, if it falls below this, is kind of means that, it's going to close that gap, or it just isn't as strong as you think, or, it could come back and close this area. So I put my stop actually right below, I think $1 below this low of this bar. So it was an extra $2 that I had to put onto my stop. So I was risking actually 1.1% of my capital, which was a 4.4% risk on the trade. And that's kind of, what I ended up doing. So, I'm still in this trade, and I think this is like,
It's pushed higher nicely.
Yeah, it's much higher now, but and once again, if I would have used the 8% generic stop and not done all this calculation and the work, right, it would have been 2% of my portfolio with a $40 stop loss. So just another example of really trying to understand the math and where your technical stops should be, and what kind of position sizing you can take without risking too much of your capital. The next trade is MicroStrategy. So this was a trade that I took. Kind of Bitcoin was bottoming after its run. Like, I think this was like the start of May, end of April, start of May. And so, there was definitely a downtrend. It broke the downtrend, and then it started to consolidate here. I like this kind of inside day. Next day was also a good, strong close. But then it popped up the next day, it gapped up. And I think Bitcoin was just starting to move up, and there was a lot of talk around the halving, or there's something around Bitcoin that was going on. So it made a nice gap in the morning. So when it made that gap, I kind of did the same thing I did with NVIDIA. I bought it right away in the morning in the first 5-10 minutes. And I put a stop at the low of that first 5 or 10 minutes bar that was there. So, I bought it at 13.79.33, 25% of my portfolio, which means I could buy 18 shares. And I had a $55.17 stop loss that I could take on it. But my stop was so close and so low to this thing. I put it right underneath the bottom of this, which was only a $30 stop. So, I risked 0.5% of my capital. The risk on the stock trade was 2.2%. And, the stock did well, and I started to, get out of it as it moved up. I think from here to here was almost a 400 point move. So, I mean, this thing moves a lot, but it's kind of a wild bucking bronco, as Mark Minervini would say. So kind of a dangerous stock to trade, but you can trade it if you keep your risk manageable.
And is that sorry, just want to jump in with a question. And is that why you only risk 0.5% of your capital there, which for you on a relative basis is kind of on the lower end, kind of for total account risk per trade?
Yeah, I mean, the reason I did that was because technically, right, like my thing was, if this is really that strong of a gap and it's going to hold it, then it should just hold it and move up, right? It shouldn't come back down. And so that's why I could use a stop at the low of the open, or whatever that was at. It was a little bit higher than, I think it was like 13.52 or something like that. And so since this is a larger dollar stock, I keep this, I'll give it $3, $4, $5 from the low as my stop, versus like, just $1, because it can move $1 pretty easily.
Yep. Perfect.
All right. So the other example I was going to just talk about, you had mentioned like, hey, I wasn't in this trade, but if I was, this is one that's moved recently, just had a stellar gain of almost, 60, 70 points in 5-6 days. But like in this sort of situation, if you were in this stock, like, this was probably the point to buy it as it maybe moved out of this little consolidation here on this day or this day or this day, you could have probably bought it. But if you were in the stock, like, how would you manage this in terms of stop losses, right? You'd have your initial stop loss wherever that was. But as this thing started to really accelerate, right, you would probably start to move your stop losses. I would have done it, would have been like, underneath this low And then just every day, as the bars are not coming down below the previous day, I would just keep moving the stop to that lower, whatever the low was of the previous day's bar as my stop loss. So just keep adjusting it every day. So you're kind of ratcheting yourself up. You can also be selling some of it on its way up more towards the high, and then put your stop loss in, from the previous day's low, so that you're starting to really capture that gain as well, and not just letting it ride. So lots of different ways to do stop losses, but that's kind of how I would approach a stop loss on Tesla if I was in this trade. But I thought this was kind of an interesting one to kind of show how you can, a way to manage your stops on a stock that's kind of going a little parabolic here.
Yep.
So yeah, those were kind of the examples that I had, and then what I wanted to do is just share kind of the key takeaways. I mean, that's kind of the key points I wanted to make. One was around, market conditions, is really understanding, where we are in the market cycle. And there's, different ways, a macro, kind of a more of a day-to-day. And then the biggest one is, how stocks are behaving and how your portfolio is acting, right? Trying to understand and balance between those three in terms of market condition. Position sizing, we just went through that, getting aggressive when the market's in a strong uptrend, and really treading carefully during a choppy market conditions. I kind of feel like we're in a very choppy market right now to a certain extent, right? But the other thing is, small losses, using stops. Always use stops for your trades based on the math. And if the math doesn't work from a technical perspective, don't just say it's going to be 8%, unless the 8% makes sense, because more than likely it'll get stopped out. If it doesn't make sense, don't take the trade. And then, understanding the math, which is, the examples I just went through. Understand the relationship between your portfolio risk and the stock trade that you're about to take, and the risk that that's going to take on. So kind of balancing between those two, I think, is real important. Any questions on that?
Yeah, and I think this sums it up really nicely. And thank you for putting this together. I definitely have some questions. First, would you mind going back to the position sizing slide that you had? Sorry, that's kind of at the earlier end.
Yeah, this one?
Yep, right here. So yeah, I love this slide. I think it's excellent. First, from a kind of, here you've kind of got it segmented, a strong uptrend, good market, 25%, 25% plus, testing the waters, 5 to 10%, and looking for cash in a correction. From an overall portfolio exposure point of view, so not talking position size, but total position portfolio exposure, what are you trying to do in a strong uptrend versus a testing the water situation?
Yeah, good question. So in a strong uptrend, I mean, I use margin, and I think we talked about it in the other interview that I had with you, is that if it's a strong uptrend, I am fully margined out. I'm going, maybe 2 positions at 100% each in my portfolio, but I'm using the same risk management tactics for stops and the risk I'm taking on my portfolio. That I just shared. So, I feel more comfortable just because I've been doing this so long, but I would say if you're a newer trader, yes, stick with the 1 or 2%, don't use margin. But if you are, if you've been doing it and you're kind of comfortable with it, that's kind of what I use to make those big gains during strong market up cycles. And I may loosen up my risk as well, right? I might take 2% risk or 2.5% risk on each of those 2 trades, right? So 5% of total portfolio risk, I'm okay with that. I'm comfortable with that. A lot of folks aren't. So it just kind of depends on your own risk tolerance, if you will. And then if lower concentration, if we're in a difficult market environment, I mean, I might put 10, 20% of my portfolio into the market, but probably not more than that. And I won't be concentrated in a lot of different, in 1 or 2 stocks. I might be 20%, but I might be in 5 stocks at that time, or 4 stocks, just kind of seeing, and maybe all from different areas as well, just to see kind of what's going on in the market. Are things behaving well or not? And just to kind of keep a pulse of the market. A lot of times what I do is, if I'm going to be 10% or 20%, I may not even buy a stock. I might just buy one of the indexes and just kind of hold on to that and kind of see what it's doing.
Yeah, I really like what you just said there about feeling it out and having those different feelers maybe in different potential leadership areas and themes. I think that that's a golden nugget that people should pay attention to.
Yeah, like I mean, I trade a lot of the ETFs, so I'll trade the stocks for to see kind of what's going on. I'll trade the Qs. I'll trade the biotech ETF, and like I said, biotech, I find trading a particular biotech name very difficult, but I would trade the biotech ETF and buy a little bit and see kind of how it does, right? To see if things are going to start moving in that sector or not.
Yeah, and getting back to your concentration, when you're talking about that, and just now, it reminds me of the Stanley Druckenmiller quote. Put all your eggs in one basket and watch it very carefully. That's kind of the methodology that you follow as well.
Yeah, and you know what? For me, I just find it easier, like, to have a handful of stocks. I mean, honestly, I probably trade. If I were to go through all my, all this different stocks I trade, I probably trade like 10 to 15 stocks during the course of a year, and that's it. I'll keep going back to the ones like, I probably traded NVIDIA like 10 times this year already. I'll buy it and I'll be concentrated. I'll let it go up. I'll make, the 3, 4, 5 hour on that stock. You can make 5, 6 hour probably on a trade if you get it in at the right time from the right spot. I'll make that, I'll sell it, and then I'll just wait for it to set up again and go buy it again, because I find it that, I like to learn kind of how stocks behave. Different stocks behave differently during different parts of the day, and they, do shakeouts during the middle of the day and come right back to close strong. But like, if you kind of know how stocks trade, it can just kind of help ease any fear that you might have in terms of, hey, it's the middle of the day. This thing it was up $5. Now it's only up $1.50, right? Only to come back and close up $6 at the end of the day. So a lot of stocks, they have their own personality and their own way to move. So I find it easier to just trade a handful of stocks and just keep going back to them as they reset.
Yeah, excellent. And another question regarding exposure and this slide here, I'm sure people always are asking about progressive exposure and how you go from kind of the test positions to then, all right, the trend's strengthening. I'm noticing that things are working. How do you kind of scale from 5 to 10% positions up to that 20, 25% when you recognize that shift and you recognize it's a time to start getting aggressive?
Yeah, I mean, I'm a pretty aggressive trader. So for me, it's, I'll change it on a dime if I start seeing things are moving. It's looking at the charts as well, right? If the market starts moving up and the testing that you've done, and those stocks are starting to move, right? That's kind of an indication that, hey, things are turning around, especially if your test, your feelers that you have out there start to work. Then take a 25% position size on a stock and see how it does. And if it starts to move, add to it or find other stocks that are starting to move and are set up properly. And, I'll go from 10% to 150% and, in a morning if things are starting to move.
So just to dive a little bit deeper into that, say you put on 5% positions. If does it take 4 of them to work for you to get more aggressive, or is it 3 of them to work, or is it really just more of a feel for how those stocks are doing, as well as the setups that are appearing in the market, all of that? I understand there's a lot of nuance there, but just to add a little bit more detail there.
You know what? For me, it's more of a feel. Like, I remember last year, I think in May, kind of when people were still pretty negative, because I think we were just coming out of the whole banking crisis last year.
Mm-hmm.
And I think that was last year. Yeah. And so, in the start of May, I think things were kind of like, everyone was still pretty negative, but, I think I bought Netflix or something, and I bought it and it started to just run. And then all the mega caps just started to go. And so it was just kind of a part of it was a feel, and I just started seeing things moving, and I just went in pretty aggressively at that point. And so I caught it early, and I, stayed in it till middle of July, when things started to sell off, right? Things started to turn around. One of the things that's kind of a good telltale sign is if you see the market just, shoot up in the morning, everyone's aggressive, everyone's buying for the first hour, and then things just turn sour, right? I mean, that's kind of the start of a turnaround many times. So I look for that. If I start seeing that happen, then, and it's not just one stock, but like everything starts to turn. That's kind of an indication that we may be towards the end of that little cycle, if you will, of uptrend.
Yeah, and I actually wanted to ask about that as well. When we go from a strong uptrend and we've been in that for a few weeks, maybe a month or two, what are some signs that you look for to say, hey, okay, now I'm not going to be as aggressive. I might not go 25% on a typical trade. I'm going to size down back a little bit, be a little less cautious, try to trade less, I guess. What are some of the signs that you look for in terms of price action?
The biggest sign I look for is I look at my portfolio. And if my portfolio is up, 7-8% in that day, like that's kind of a sign. Or if it's up that much in the morning, like if you get that sort of a big bump up in the morning, that's not going to last, right? And that's where you should start to trim down your size pretty aggressively. Like, so what I try to do is that once I see something like that, I'll just sell half of everything I have.
Mm-hmm.
And then just kind of watch, right? So I'm still in it. If things turn around, at least I have half my position still in there. If not, I've kind of saved half, and then I'll keep watching. And if things start to deteriorate even more, I'll start to sell. But I mean, when you start seeing crazy moves, it's kind of an indication that, we may be ready for a little correction.
Yeah, perfect. And maybe we could go back to the Tesla example for this question. But maybe any of them would work. But I want to ask more about when you're not just moving up your stops, but considering selling some into strength. For you, you're a swing trader. You're pretty aggressive in your sells and also moving your stops up. A position trader might be playing this Tesla trade a little bit differently. Trailing at a moving average. Trailing a percentage off highs. But for you, when do you start to consider selling into strength? Is it when you reach an R multiple and you kind of want to lock stuff in? How do you kind of approach that?
Yeah, so I really do try to use the R multiple, because I think this just kind of keeps it a little bit less
Subjective.
emotional.
Yeah.
Yeah, it's just kind of like, hey, if I get 3 or 4 R on a trade, if I got 5 R, I'm going to sell half of it, like no matter what, just because that's a pretty good trade, right? And then maybe keep the other half, and then put some trailing stops, and then I'll look at it like, what technically would be kind of an indication that this is turning around now, right? Especially like when you look at, like, for example, on MicroStrategy, right? This was kind of a good example of what I meant. Like, here's a day where it closed strong. It opened the next day. I don't have the open where it opened, but it did go above that bar. But then it didn't really make any progress, and it started to turn around and then started to come right back down, right? That's an indication right there that, maybe this little upswing of 400 points is kind of over for now. And that's where you got to like learn to just get out. So even if you wouldn't have gotten out here, this next day would have been another day where it broke this low. You should have been out of it by then, because then it did correct for a few days and came down, and it's been correcting since then.
Yeah.
So yeah, I mean, a lot of it is based a little bit on feel, but also technically, like, what is the chart showing you? What's the chart doing? And adjusting your stops accordingly.
Yeah, excellent. And one other question I had, and maybe we go to LLY for this one, because it did have that shakeout there intraday. It seems like your stops are anytime, anywhere, while versus other traders might look to sell only on the close if it triggers on a daily close, or some even longer term traders are more like a weekly close. But it seems for you it's like when it hits that level, you're out no matter what time of day it is.
Yeah, I don't really look at the time of day. If it's not doing well, I'm going to get out of it and save my money. But my trading is very, like, that was a good point you made, right? Like, for me, everything I'm talking about here is very like swing trading.
Yeah.
You know, my average hold time is, you know, probably 4 or 5 days, 6 days max, for a trade. So I don't really hold on to it very long, but you know, I'll put on bigger positions. But if I make 3 or 4% on a trade, you know, 3 or 4% on an $800 trade is a pretty good return from a dollar perspective, especially if you're overweighted on that stock, or even if you have 25%, that's still pretty good return.
Yeah, and do you have any specific rules about if you do get stopped out, it reverses strong and then sets up again, you look to buy it back, or it's just kind of, you know, if you see it again when you're going through your focus list and you notice the setup again, then you'll take it, but you don't have any kind of hard or fast rules about getting back in after a shakeout like this?
Oh, I mean, if it's a shakeout, and I would try to get right back into it.
Mhm.
Lilly was kind of an interesting one. You know, I think I've mentioned in the past that I really don't like trading biotech stocks, or healthcare stocks in general. And I just have never had luck with Lilly, but this looked good to me, so I traded it, and I got shaken out on what would have been
Yep.
a great trade. So it's just kind of, you know, you have these mental, I think, things around, you know, trading certain types of stocks or certain names. But that's why I didn't look to get back into this one. But you know, there's certain focus stocks. Like I said, I probably have like 10 focus stocks that I'm always looking at. And those are the ones where if it was to shake out and I got shook out, I'd be watching that real carefully to see if it sets up again and it makes sense to buy it with a limited amount of risk.
Yeah, perfect. And for this one, if you hadn't gotten stopped out here on that shakeout, how do you think you would have handled selling this and moving up your stops for this example?
Yeah, I mean, this thing was pretty strong for a good 2-3 weeks, I think. I mean, you know, I would have probably gotten shaken out, or not shaken out, but you know, I would have probably put a stop like right here underneath this one,
Mm-hmm.
this day, and I don't. It looks like it
Undercut
dropped
that a little bit.
and right
Yeah.
back up. Yeah, so that would have been one spot, and then the second spot, I think, where I would have probably gotten stopped out would have been probably somewhere around here, because this is a big trade. Like that's 80 points.
Right.
Up. So on a 75% portfolio size, like that would have been a huge winning trade for me. But yeah, I think that's kind of how I would have looked at it. Like I would have started to ratchet things up, maybe even sold half of it, like on a day like this,
Mm-hmm.
and then kept the overweight on it, and then I would have probably gotten stopped out right here, I would think.
Yeah.
But I would have been happy with that.
Yeah. Sorry. Just to kind of confirm what I was thinking based on what I heard you say, you know, on that day where it kind of pushed up higher after it was already up a few days in a row, that's a spot where you might look to ratchet up your stop and sell maybe a little bit into strength. Is that right?
Correct. Yep.
Cool.
Especially in this situation where this was, you know, 75% position.
Yeah.
I would have definitely done that.
Yeah, and I'm so glad that you shared this trade, because this is trading. This is going to happen, you know, to everybody, even the best traders. So I think this is a great example to show. So
Yep.
yeah, this is excellent.
But you could have bought this one back, actually. You know, when you look at it,
Yeah,
this was a tight day here. Like
those
you know,
two highs are pretty close.
yeah, those two highs are close. It was a tight day. This looked like a total shakeout because it came down below the breakout
Yep.
but closed at the high. And you could have actually, if you wanted to be aggressive, you could have bought some like at the high of this little inside day here,
Yep.
or the high of this, right? And then just put a small stop on that, and then just let it go, and you would have probably been okay with it.
Yeah, but it happens. It happens to everybody.
Yeah, it happens to everyone. So yeah, you got to just learn to live with it.
Yeah, excellent. One other question I had for you was in terms of your overall account. Do you have kind of a circuit breaker rule regarding, you know, percent off highs where you'll kind of say, okay, you know, I'm in a drawdown, I'm going to trade less aggressive, I'm going to size less. Is that something you consider, or it's more as, you know, just kind of gradual and based on the immediate trade feedback versus looking at your equity curve specifically?
Yeah, it's a little bit of both. Like I think for my you know, I have certain goals I'm trying to get to, like in terms of returns and stuff. So it's based off of that and kind of where my equity curve is.
Mhm.
But if things are starting to move down, I'll just get out. I'm not going to wait around probably too long. So I try to keep it as low as I can in terms of the drawdowns on the equity side.
Yeah, excellent. This has been really great. I think there's a lot of concrete tips and strategies that you shared today. So I want to thank you again for that. Just have
There was
yeah,
one
go
other
ahead.
thing I wanted to just share was I was going
Sure.
to just show some of the things that I thought were kind of instrumental in me turning around my trading and
Oh yeah.
some books and things. So I just want to share that with folks. So, I found that these like 6 books or 7 books here, I've read these things a few times each, were, I thought, really, really valuable in terms of helping me turn around my trading. And then in terms of resources, I think, Richard, you guys do a great job at TraderLion. There's so many great traders that you guys interview and so much great information that you guys have that, great resource for a beginning trader or, someone that's been trading for a long time. You always find some great stuff in there and learn from other folks. I think, I'm part of Intervening Private Access, which has been really, really helpful for me. I'm part of Dan Zanger's chartpattern.com, which is also just a great resource and a great site as well. And then Stock Market Mentor with Dan Fitzpatrick. So those are kind of the resources that I use pretty much regularly. And then those are the books that I read to really kind of help me think through all aspects of the trading, if you want to call it a game, the trading game.
Yeah, I've heard the rule mentioned multiple times, and I've been meaning to read it. What were some of the kind of the key takeaways from that one specifically? That what would be kind of your pitch to everybody to read that book?
Yeah, I mean, I think the rule is basically if you get into something that you shouldn't be in, fix it right away. The rule is just sell it. So in trading, it's just sell it. Larry was at one of Mark's seminars last year, and he said, one of my rules was, I realized I was in a bad relationship, and so I just got divorced. So just end it. Like, don't sit around and I think he said that. So so don't sit around and kind of live through the pain of something that's wrong. Just fix it. Just fix it right away and be done with it and move on, because you'll waste too many cycles thinking about that, and it'll ruin everything else that you've got going on.
Yep, that ties
So
in
his
nicely
rule
to your
is,
topic.
what's that?
That ties in great for risk
Yeah.
management. Yeah, it's
Yeah,
good
I
life
mean, it was
advice
kind
too.
of like an eye opener. I kind of read it, and he gives some great examples in there, just in general of, what were the odds of him doing this and that. And, anytime he got into something that he feels like, oh, I shouldn't have done that, he just fixed it, right? Like, so just get out of a bad trade. You can always go back in. Don't sit around and, because if you're in a bad trade, you just keep holding it, thinking it's going to come back. A, you're wasting time. B, you're losing money, and you're just kind of, your mental state is going to get affected by that, and it'll impact kind of the next trade that you take. So, fix it as fast as you can if you realize you're doing something that you shouldn't be doing.
I think that's one of the favorite things that you've said today is it's attacking you on all fronts if you're trying to hold a loss. So just keep those losses small as you can. Cut them once it tells you that you should be out. I love that.
Yeah. So yeah, great books. Can't say enough about them. If you haven't read one of them, you should probably try to find one and take a read.
Yeah, excellent. Yeah, just kind of 2 last questions here.
Sure.
First, if you had an exercise for people to do based on your topic of risk management that you think would help their trading, what would you assign homework, if you will, to everybody watching here today?
Yeah, one of my favorite exercises was around not using stop losses. And so what I did was I downloaded all my trades from my account, and I just put them in order of where I made the most money to the amount that I lost, percentage terms and dollar terms. And then what I did was I took all the stocks or all the losses that were more than 8%. And I just said, okay, if I would have just said 8% no matter what, I'm going to stop it. If I did that, what would the impact have been to my returns for the year?
Right.
And it was eye popping for me. Like, I would look at it and I was like, holy cow. Like it was like huge, like double digit extra return in my portfolio. And that was an eye opener. So I would recommend like you go through that exercise. It is a fantastic exercise to do with your own trades and see how many trades did you do where you lost more than 8% because you didn't use stops or, whatever. And see kind of what the impact would have been to your bottom line had you just said 8% for sure. And like I said, I just went through all this. 8% is probably too much for most cases.
Right.
But if you just use that as a flat rule on your trades, see what it does. I mean, see what it does to your equity at the end of the year. I mean, you'll have thousands of more dollars in your account probably if you would have done that.
It's amazing the impact of capping your losers can have with trading, and it's kind of an effect that you don't realize how important it is until like you said, you do the math. And I think Mark did that same thing and mentions it in his book as a turning point for him, is doing that same exercise and capping his
It was
losses.
in Mark's book. I think I was reading Mark's book and I stopped reading it right there and I
it?
downloaded it and
Yep.
went through it and I was like, holy cow, this is eye-opening here.
Yeah.
So yeah, I mean, risk management, I think is the holy grail. It's not the funnest part. Like, it's more fun to look for stocks and things that are moving up and look at charts. But to me, I think understanding the risk management and the math, and Mark does a really good job in his books walking through that, I think,
Yep.
in terms of how you manage that, was really kind of a huge game changer for me. Because what I was noticing is I was making money, but then I was also losing the money when the market went down because I wasn't managing my risk. So it was just kind of like I had the upside, I wouldn't say figured out, but I was doing well enough that if I would have been able to cap my downside, I would have been doing real well.
Yeah, and by the way, I really liked how in this presentation, most people when they hear risk management, either they're very vague about what that means, or they just kind of think of stop losses and cutting losses. But today you also tied in market conditions to everything, position sizing, and you tied it into position sizing, total exposure, all of that. And that's such a key layer to kind of unlock, because the same risk management techniques, if you just do it all the time in all market conditions, it's not going to have the same effect. And you really want to be tying in reading the market, how are stocks doing, how are setups performing, all of that into how aggressive you are with your positioning, total exposure, all of that. So yeah, I just wanted to say I think that's a really important point that everybody watching should try to incorporate into what they learned today. So anything to add on that front?
No, I mean, like I said, when I started, is that was kind of a key component that I really didn't understand. Like you said, it's usually pretty vague, and I really kind of tried to, study and understand what that meant. And so that's kind of the way I look at it, based on kind of all these resources. I mean, like I said, I've been trading for a long time, but I got a little bit from all these books and these resources and sites that I follow to kind of come up with that sort of an approach. And it seems, it works for me. So, that's kind of what I use.
Yeah, and I think your presentation today was the opposite of vague. It was very practical, and I think a lot of people can have some great takeaways. So thank you again. And just as one last question, if there's any advice that you would give people watching today, it could be trading, it could be life if you'd like, what would you kind of say to inspire them, share some tips, whatever you'd like to leave everybody with?
Yeah, I mean, I think The Rule is a great book. Like, I would read that. Like, and it just doesn't apply to stocks; it applies to life in general. I think Larry's story of how he grew up and where he came from, and the rule that he learned was just it's just really inspiring, and it's a great book. It's an easy read. It's really an awesome book. And the second thing is just, if you've been trading and you've been having difficulties, or you're trying to figure it out, you're new, if you're new, I think it's great because there's so much resource out there now that you can learn from, that you don't need to go through the school of hard knocks for as many years as maybe I did when I started, because there wasn't all this information readily available, or at least I didn't know about it. So I think it's a great time to trade. Believe in yourself, put the time in, the effort in, and literally you can do just as well as anyone else can trading stocks.
Yeah, excellent. I think that's a great sentiment to leave everybody with. So thank you again for your time. Really
Yeah.
enjoyed this, and to everybody watching, hope you guys did as well. Make sure to thank Deepak in the chat. The link to download the slides as well will also be there, so make sure you take a look at those. Would definitely recommend, analyzing all the examples that he shared on your own. Take a look at them and, on your own screens or your own charting platforms. Go ahead and do that. And we'll be right back with the next presenter. So stay tuned. Cheers. Okay, welcome back, everybody. It's my pleasure to introduce our next speaker, Jeff Holden. Jeff is the head of trader development over at SMB Capital, and today he'll be talking about how to elevate your trading game and sharing some of the secret sauce behind the development of traders over at SMB Capital. Jeff, thank you so much for your time, and really looking forward to this.
Thanks. Really honored to be able to share what we do every day. But I didn't want to jump into what we do every day without providing some context. So I figured today, if everybody's comfortable with that, I'll take you on a little bit of a story of how I got into where I am at our firm. And through that, we'll really dive into a couple different things. The things that are important to us as a trading firm, the things that we want our traders doing every day. And we'll talk about the strategies that we really focus on with our traders, but then we'll also dive into their trading specifically. And we're actually going to wrap by providing a very clear trade that traders on our desk take that we've actually found works on a bunch of different time frames. So it's a great trade to cover here. So I'm excited to be here and looking forward to this.
Yeah, let's dive right in.
Okay, great. So, this entire presentation, when we were putting it together, we were thinking about what do we call it? And that's ironically one of the toughest things to do with this whole thing, because a lot of times we know what we want to talk about, but it's tough to get a catchy title. We know what we do every day, but it's tough to put all of that into a title. So I hope that this isn't too misleading, but elevate your trading game, strategies for winning in trading. That's what we do every day on our desk is we show up and our traders almost expect to win. Most of the traders on our desk, we're an intraday trading firm. Most of the traders on the desk over the course of an average week will have 3 really good winning days. They'll have 1 flat day and they'll have 1 day when they're slightly down. They come in with an expectation that they will win. They come in with an expectation that they will make money every day. There are a lot of things that go into that, but think about the power of coming into trading as an individual expecting that I'm going to get a good trading opportunity. I'm prepared to take advantage of that trading opportunity, and then being surrounded by others who have that same mentality. I started out as a retail trader. I started out trading on my own. I learned from some people that I really, really liked about what trading was. I then went on Twitter and learned some more. I went on StockTwits, YouTube, everything. So I started out truly as someone who just had this passion, this interest in trading. We'll get into a little bit of these 3 steps that we see traders on our desk taking as they go towards pro traders. And we'll start there. Then we'll get into those habits that as a pro trader, and really we think any of the levels of trading, if they implement these very simple but very important habits, they can achieve a lot more success. And then we'll talk about some of the things that we see on the desk as really important outside of that. And like we said, we'll wrap up with the strategy. But for me as a retail trader, I started as a swing trader. I saw somebody on Twitter that had this swing trading strategy, and I followed them for a little bit and I loved it and it made sense to me. And I can't remember if I took a course, but I certainly learned a little bit about that strategy. And I started executing it. And I realized there probably was the beginnings of edge there. Now, the thing that I struggled with so much was I would execute it, and then I'd see that they executed it on Twitter as well. I'd make the buy, and they'd say, yes, I'm in this same thing. And then I'd have what I thought was a reason to sell, and I would exit the position. And I thought that was their reason to sell as well. And then they would say that they exited the position also. But then a couple days later, when the stock kept going higher, then they said they were exiting their position. And I was really confused. I was like, wait a second, like you just told me 2 days ago you exited, but somehow you're still in it. I know I exited, but I never heard about it anytime the trade went against them, what they did, right? So it was really like me just kind of learning and figuring stuff out as a retail trader. I realized very quickly that I needed some trading edge, real trading edge. if I didn't have real trading edge, if I didn't know what to do when the trade worked, and I didn't know what to do when the trade didn't work, I didn't have anything. I had trade ideas. And ideas are really important, but they need to be surrounded with some sort of structural edge to them. A reason why that idea would work out. And when you have a reason as to why that idea would work out, and what we talk a lot about on the desk is who's actually driving that trade. You can start to begin and to develop a thesis around when that edge is present, these are the variables that would be there. And when that edge is actually not there, these are the variables that will be missing. So it allowed me to go from this retail trader who, was doing okay to actually being an independent trader. And an independent trader is the next kind of level up from retail trader. An independent trader, typically you're making money or you're making some money consistently, right? You've got a strategy that you can start to evolve a little bit. So you understand the basics of the strategy, but you're into that area that we talked about where you're recognizing that this trade might not work out because this variable isn't present. And so maybe I'm going to change my risk management strategy a little bit. Or I'm recognizing that these variables that usually aren't there are actually there. And so this might be a 5x or 10x type trade because these variables are present. So you're getting into that a little bit. So you have trading edge, and then you're getting a little bit more into the depths of the strategies that you're using. I recognized when I was an independent trader, so I was making money and I understood one of the strategies. I had, 4 or 5 trades, maybe a week on a busy week, right? It was really eye-opening to me to realize that some of the traders on the desk that I'm now a part of, they had 15 to 20 really good trades a week. And what was even more eye-opening was that they needed to have such a bigger group of strategies to be able to get to those. It wasn't that they were using the same strategy to do it over and over. So I always knew that technology was going to be something that was helpful for me. So even when I had that one strategy, I was trying to find ways to use technology to bring me other trades that are still in that same strategy. I wasn't going outside of that strategy. Still trying to use technology to bring me ideas that maybe I would miss. We do a lot of chart work, and we'll talk more about that habit in a minute. But there's only so much that you can cover, and technology just makes it really easy to not miss your best trades. So even as an independent trader, a lot of my focus was on developing technology associated specifically with those trades that I knew, that I understood, and that I had some edge in. And this was I was still pretty much swing trading and starting out in some other forms of trading. I had started to do more intraday trading at that point, but I still needed that technology component to bring me trade ideas. I had the opportunity to meet Steve and then meet Bella, and it was just truly, truly eye-opening to see the traders on the desk where I had one edge and I was consistently profitable and doing okay, to see them trading with 10 or 12 different edges. And what that gave them was this dynamic ability to, if one edge wasn't present in the market, they didn't have to sit out and they didn't have to force. They would just go to a different edge that was showing up for them. And so over the course of a month, they might only trade 3 or 4 of their edges that they have, but over the course of a year, they're probably tapping into all 10 or 12 or something along there of those different edges. Just each month is comprised of this collective group. So I think for me, recognizing that I wanted to go from independent trader to professional trader was really about recognizing I wanted to be surrounded by people and then bringing the skills that I already had to the table to help them grow as well. So I was able to share a little bit of my edges that I had developed, but learn a lot more about the edges that other traders were developing. And what I recognized was so many traders smoothed out their P&L curves simply by trading intraday strategies. It gave you more opportunities to trade. It gave you different opportunities to trade. The variables were a little easier to track because they're happening real time so much faster than they were in a swing trading type environment. But that was really what what led me to progress into professional trading was if I want to do this, I want to have different things to do all the time.
And can I jump with a question,
yeah,
Jeff?
go ahead.
Sorry.
Yeah.
Sorry to interrupt.
No.
I'm curious, how do you, and maybe SMB Capital has kind of a specific definition for this, but how do you define an edge? Because people watching this, edge gets thrown around a lot on Twitter, everywhere. But how do you guys concretely define an edge, and maybe one or two quick examples that you kind of can refer to?
Yeah, so what we define as trading edge. So there are two edges that we study on our desk, and one is the edge that we'll get into in just a second. That actually involves you personally, or me in this case, and I'll give examples of the way I support that edge. But trading edge is really an understanding of an event that's occurring and why that event would be occurring in the market, right? So let's talk about a breakout. Right? Why would I have a breakout is something that happens, right? Buyers step in and then price goes higher. It's out of a range. Everybody conceptually can grasp that. But why would I have trading edge buying a breakout over someone else? What's my trading edge there? It's not the fact that the stock is looking like it's going higher. There has to be something about me acting in that specific way and then looking for others to act in that way behind me. Because if you're buying a breakout, you're actually buying and placing a bet that other people are going to be buying more than you at higher prices than you. So you're making a bet that your entry is actually a speed-based edge. Mm-hmm. You're buying before others are going to keep buying. In the event of trading with bigger players, they might have just way more to buy, and they can't buy their entire position in that one moment. So you can buy and look for them to come in and buy behind you. That's just a very simple example of a trading edge. Another example, to use an overextension as kind of the basis of there, and these are very straightforward, but they actually occur on every time frame, is there could be forced selling. We actually got this really cool note the other night. It was forwarded from one of the traders on our desk about all the happenings that have involved in some of these funds that have blown up. And actually, they're not talking about the people, and these notes are not talking about oh, that wasn't that awful. They're actually analyzing the structural components that go into when that fund gets a margin call, how do the banks respond? Right. How quickly do they force them to sell? How much time do they give them to cover that loss? And that to us is really talking about when you get into an overextension situation, there is so much edge there because there is typically in a real overextension, a participant that is forced to act in a certain way. They are forced to sell it. Their underwriter, whoever is essentially saying to them, you need to sell this position or we will sell it for you. They're acting in a way that is not price sensitive at all. It's need based. So they just need to get them out of the position. That creates these tremendous effects of an imbalance between supply and demand. Well, you don't have edge in knowing that. You only have edge when that participant is done selling. And your edge is based on the idea that when that participant is done selling, that forced liquidation is done. It's providing us a tremendous amount of opportunity because there's been a short-term price imbalance, and we can take advantage of that through a very specific set of steps that we'll use. The third example, and just not to kind of go over it too much, but it's going to highlight a little bit of what we'll share later, is continuations. Mm-hmm. And this tends to be a trade that a lot of people forget about because especially in a breakout, you look for the breakout and then you look for the overextension to be where you exit your position, right? But along that process, a lot of the traders on our desk use continuation trades where you're monitoring for continuation. Maybe it extended a little bit too much off that first leg, but comes in, and we're looking for those big buyers to still be there and to continue that drive higher. That's a tremendous trading opportunity and trading edge that we try and capitalize on a lot. So those three, we just highlighted the big components and the types of trades you really look for. But those are three examples of trading edges that we're looking for. and not in pattern based, but based on who is participating, and then what we expect them to do ultimately leads us to trading edge.
That's excellent. And I just have one more quick question, and you may kind of go over this, but I was curious, based on these three steps, retail trader to professional trader, how long did that evolution kind of take for you? And maybe you mentioned, of course, meeting Bella and meeting different mentors, but what were some of the key steps that you took to make that evolution and kind of continue on your path and improve as a trader?
Yeah, I mean, it's so interesting because now working on the trader development side on our desk, working with traders, meeting traders who are at various stages of their trading career. I can honestly say it's different for everybody.
Mhm.
And the reason why it's different for and I'll answer what mine was. And I hope mine's not the norm, but it was for me. But why it's different for everybody is I think it's the story you're telling yourself. I think it's really what you're committed to do every single day. If I'm committed to go in and try and find the trade idea and put some risk on, I'm likely to stay in the retail trading side for quite a while. My journey was essentially about a year as a retail trader, where I was just really not sure what I was doing, but I would go in and I would look through. I would get a watch list from somebody in the morning and I would be like, yeah, this is my watch list too. And then I would just kind of find a trade and all that stuff. Once I started recognizing that I needed some edge, I started to make that transition into independent trader. Because I had that one edge that I was looking for. So it was really a story of I knew specifically what I was looking for each day. And that allowed me to focus on the habits that would help me get to that consistently profitable trader. My independent trading phase was about 9 months. As an independent trader, very quickly, I realized that my one edge was great and I loved that. But, I think I had the opportunity it was actually through somebody that I was working with as an independent trader. They knew Steve and they were like, why don't you get in touch with Steve? And it was like, okay, well, really quickly, my eyes were open to what it meant. I didn't get the opportunity to join the desk, unfortunately, for about 3 or 4 months after meeting Steve. I should probably go ask him why he didn't give me that opportunity for 3 or 4 months. But I'll be honest, I worked, if I read something that said do 1 playbook a day, I was doing 2. And that started from as I was a retail trader. And looking back at some of my work as a retail trader, it wasn't very good, but I was trying really hard and I was learning. Every time I would do something and it wasn't very good, I would go back at the end of the week and look back at that and be like, hey, why do I think that wasn't very good? Why do I think, what could I learn from this? And so that learning really helped at each stage. And as a professional trader, I think people would be astounded at how much professional traders are just really quick learners. We really are learning and adjusting and learning and adapting even on an intraday basis every single day.
Yeah.
So, that's my story. I've actually seen a lot of the traders on the desk spend less time as a retail and independent trader, and they more quickly get to that professional trader level than I did. But I do think it comes down to the fact that I was just having fun as a retail trader at first. It was fun to be a trader, right? Like I was hoping that I would make money and I had dreams about making a lot of money and being able to do this, like, where I was, I think I'm kind of embarrassed to say it, but I think I had like a picture of like a Ferrari or McLaren or something like that as my screensaver for a minute, right when I started trading. And I was like, I'm gonna make all this money as a retail trader, and I'm gonna do all this stuff. And like very quickly, I realized just because I saw somebody else doing that doesn't mean that that's actually what I wanted out of it. But it was fun in that moment, and so I think I stayed in that phase a little bit longer than I needed to. As an independent trader, I think I probably could have been more aware of collaboration as an important component of being a trader. Collaboration meaning you're working with other people, you're sharing your ideas. I think I got a little protective of my one little source of edge. And I was like, look at all these people, they don't have it figured out. I know what I'm doing, but if I start talking about my edge, like it might go away, like all those horror stories. I haven't seen that ever happen where if you start talking about your edge, all of a sudden it goes away. I mean, the reality is as traders, even on our desk, there are traders talking about their edges all the time, and it doesn't seem like those edges go away. The market dynamics adjust where the edges are present much more than anybody trading any specific strategy we have. So I think I held myself back probably a little longer than I needed to. But you know, I've loved looking back. I've loved so much of the journey that I've had.
Yeah, perfect. And sorry to jump in, but I think it might be helpful for people watching this to kind of think about where are they within those steps. So I think that's helpful.
Yeah, and we just categorize it because, you know, we kind of need to categorize everything so we understand where people are along that journey. I mean, our job, my job, and what we do at our firm is our job is to help people make money. That's what we do. At whatever stage they're at, our job is to get them to that next stage. And even as a professional trader, our job is to make sure that our traders are 7-figure and 8-figure traders. And we're constantly working to make sure they're 7- and 8-figure traders. That's the expectation on our desk. And it's unrealistic, but it's something we need to hold ourselves to, and we need to work towards every single day. So, you know, a big part of that is the thing that we're going to talk about now, which is you being ready. So we talked about two different edges. There's the market edge, but then there's also the edge where that you bring to the market. And sometimes it's a little bit of the way you look at the market, but more often it's the way that you're prepared to show up to trade every single day. And even if you're a swing trader, if you are showing up with the potential of pressing the buttons, these are 4 components that we find are absolutely crucial to make sure you're nailing day over day, week over week, month over month. And not that you're getting it right every single day, but you're getting it right enough times that you can build up a little bit of we call it kind of a bank, right? So your sleep bank, right? I think when I talk with developing traders, particularly in the retail side of it, you know, maybe they have another job, maybe they have other things going on. I know when I was a retail trader, I felt like I probably should just let go of the sleep component, and I should stay up an extra couple hours and do some work on my trading, right? What we found on the desk is you need to get 7 to 8 hours of sleep every night. Like Lance has talked about this a bunch. Bella actually initiated a challenge for our entire desk. And it was astounding to see the traders that get 7 hours of sleep a night and their performance over time versus the traders that didn't. So making sure you're well rested. We don't need to talk about some of the best practices there. There's a ton of videos about it. But making sure that you're well rested and you get an appropriate amount of sleep is an absolute critical thing. We just have our interns in here now, and that was the first lecture. It was about sleep. It was about sleep. It was literally just like, get in here. You're in New York City. You're in college in New York City, but you still need to sleep 7 hours a night. Yeah, like it wasn't really. I don't think they loved hearing it, but it's important. The second thing that we think is absolutely important is nutrition, and we don't call it diet, but because it is really the fuel that you're giving your body. You'll notice traders in the desk eating a lot of vegetables, a lot of good, clean protein. You know, you won't see many sugary snacks. You will see some, but not very many like sugary snacks across the desk. When people go out to eat, to grab lunch, they're usually, you know, we're in Midtown. There's a ton of choices that we could have. Most traders go to about 5 or 6 places because we know the quality of the food that goes into that. And for us sitting at our desk 6.5 hours a day trading, and then, you know, on both sides of that with the market, and then some of us commute and then doing all those other things, we need our energy levels to sustain. And so we know that sleep and nutrition are really a big component of that. The third thing is exercise. I think there's a little bit of a misnomer for a long time that I certainly had about exercise. I thought exercise was about building your body and, like, you know, how vain it is to see people that just exercise all the time and are looking in the mirror and posting selfies and all that stuff. But really, exercise to us, it doesn't have anything to do with that. It has nothing to do with the physical components of what the result of the exercise is. It's actually about finding a way to lower your stress levels and push yourself and challenge yourself every single day. You know, I know a lot of us talk about Huberman stuff, and it's like you do one thing mentally challenging every day and one thing physically challenging every day. There are a lot of people that talk about that sort of stuff on the desk. It's not just that people will be exercising. They'll actually, and I even have it right here, like they'll have specific workout plans that they're committed to over the course of a 6-week period or an 8-week period. And even more importantly, they're taking notes on the different activities, right? So it's like one fun component about exercise that you'll see traders on the desk using is a lot of them will, have a workout routine or an exercise routine that centers around a reset process between exercises. So think about as a trader, you get stopped out, you have to work some sort of reset process before you're mentally capable of making a good decision on the next one. You'll see traders incorporate that a lot into their exercise routine. So I do this set, here's my reset process, I'm on to the next set. The other thing that you'll see traders doing a lot is, especially on the weekends, is finding ways to make it a lot of fun. So their exercise might be, I'm going to go play soccer for a couple hours, or I'm going to go play tennis, or I like playing basketball, so I'm going to go do that. They're trying to bring joy into these things that they're doing every single day. And maybe not every single day they're doing it, but they're trying to find like big fun moments over the course of a week that they can stay motivated by. The final thing that we really stress on the desk is mindfulness. It's a process, it's a habit that traders on the desk do pretty much every day. Typically, a mindfulness routine is focused on your breathing for about 5 minutes. Sometimes some people do it right when you wake up. Some people do it right before the trading day. Some people do it as a reset in between the trading day. But that mindfulness, that ability to kind of bring yourself back to where you are, it just clears everything. And if you've done these 4 things, a lot of times you're actually building yourself over time into the type of person that can show up and be the best version of you as a trader. These seem like simple things, but it's actually a little bit challenging to do them consistently. And you don't have to do them perfectly. It's more important to just do them consistently. So the sleep, nutrition, exercise, and mindfulness are really key components that allow you to show up ready for the market every single day. That opens the door to us coming in and taking advantage of Trading Edge. So we're going to get into idea generation, which is really a key component of what we do. So it's you show up ready, you have good idea generation, and then you can focus on execution. So good idea generation to us, and I'll pick things up a little bit now because this is kind of the thing that I feel like we've laid a good we've laid a good foundation here. Now let's move on to the really fun stuff. And good idea generation is important for every single trader on our desk. The way that we view it is a 3-step component. We do catalyst, setup, and trade. Catalyst is essentially that first part of that edge component, right? What's anything that's going to force other market participants to make a trading decision in a stock. So it might be really good earnings. It might be a big shift in earnings potential. It might be even a technical catalyst, like a technical break out of a range. That's going to force market participants to do something, to make trading decisions. And again, like we talked about, that higher time frame overextension, which essentially is forcing market participants into doing something. You need a catalyst. On our desk, you need a catalyst. If you don't have a catalyst, you're likely subjecting yourself to too much randomness. So we're always talking about and looking at what catalysts are there. That's where our idea generation begins. Then we take it that next step further and we talk about the specific setup. And these are named setups that we've observed and traders on the desk have observed for now decades almost. And what there really are is describing what a lot of people would call higher time frame technical analysis. They're very specific patterns that are occurring. Well, when you combine those with a catalyst, you're already starting to put together a little bit of more, I hate to use the word predictive, but it is sort of predictive value. And it's more discretionary, like our ability to cut out the things that aren't behaving in a way that would match up instead of us predicting what's going to happen. We're more taking the variables and saying, okay, I recognize this wedge patterns occurring above a key resistance level after this really good earnings potential catalyst came in. To me, that makes so much sense of I could get long this on the break of the wedge because I would expect other people to be getting long it as well on the break of the wedge to the upside. But if it fails and goes to the downside, am I going to want to be shorting that? Well, probably not, because of the really good positive earnings catalyst behind it. I might actually look for a failed breakdown to get long it later. So that's a bit of how we remove a little bit of the variance in our trading by combining the catalyst and setup. The big thing that we do is then we look for the specific price action And for intraday traders, we do it on an intraday basis. But that price action is really a named trade. And it's us taking the order flow that is present and recognizing the way that those patterns are going to play out specifically and have historically. Usually we use back testing and then forward testing to verify these are things that make sense to us. A lot of times what a trade is just observing a market pattern, the way it plays out, and then saying, I wonder how often that plays out. So we'll write a back test for it. We'll run it back against different periods of volatility to understand how often it occurs. And then we'll forward test it looking for very specific examples. Then we actually have a trade. We actually have something that we know has edge. We understand why the edge is present and we can execute it, and we put specific trade rules around it. Underneath all these, we put examples of what they are. You know, for a setup, we covered the catalysts. These are not all inclusive. Like there are a lot more from here, but you know, trending is a really good setup. Balancing, mean reversion, volatility, and range. These are really good setups. We talk about breakout, failed breakout as well. And then specific trades. You can look for a fashionably late trade, which is one we teach a lot. You can look for a big dog consolidation, which, you know, is another one. And then the MACD base hit, which I thought was one of the more relevant ones we could cover today. And we'll jump into that in a second. Because this MACD base hit is actually something that occurs very frequently on all time frames. And so after you have a breakout, you can look for that MACD base hit trade. Before we get to that, though, I really want people to learn how much of a focus on process and consistency we have. So here are 4 things that we'll do to support us coming up with those really good ideas. You know, maybe we're doing chart work, which is literally just going through. We have a list of names that we look at every day, looking through those charts, right? We'll take the charts that make the most sense to us that we want to study, and we'll do chart art on them. So we'll take screenshots of them and we'll mark them up. We'll mark up the dynamics that made sense to us, the things that maybe we had questions about. Again, we're not even at the point where we're coming up with a trade idea, and we're certainly not judging ourselves for missing or taking anything specifically. This is all just us coming up with this process that we know over time is going to lead to really good results. Out of the best chart art, we create a book of charts. And that really is this nice book that you can review on the weekends or maybe even before the open. And it's a collection of very specific trades written up in a specific way, in that you can very quickly look at them and go, oh, I remember when this happened. I remember why that happened. I remember what I was looking at here. And in the book of charts is the first place you'll actually see execution rules. Chart work and chart art, you typically won't see execution rules. You'll see things that are noticed. Book of charts includes specific execution rules around it, because at that point we actually have a trade. And then finally, you know, going back to when I started as a trader, it's important for everybody on the desk. Once you have that book of charts, you can use technology to help you find more trades. It's not enough to take the trades that show up for you that you find. As a professional trader, and even as an independent trader, you want to find every single trade that is really close to setting up for you, so that you're not going to miss something that is A+. The difference between missing one A+ trade and taking that same A+ trade, you know, over the course of a year is amazing from a P&L perspective. So we cannot miss our best setups. So we're always using technology to bring our best setups to us, our best trades to us. I really recognized when we talked about my development a little bit earlier, I really recognized that maybe that's why Steve didn't invite me to the desk for 4 months, but I really recognized as an independent trader, that's where I kind of knew that I needed to do it, but I just fell short for a period of time. And I think it was because I was relying on that one edge. So I was using technology to bring me trades, but I wasn't specific enough with it. And then the biggest mistake I made, actually, which was really interesting, was every time I would get one trade brought to me, I would kind of overvalue that information. I would sit there and go, well, it hit my alert. I probably am going to be taking this trade. And so by doing that, I put myself in a really tough spot, because I never developed the skill of saying no to a trade. And now being a part of the desk, I recognize how much saying no is a critical component to what we do every day as traders. So we'll get to an interesting stat here, but on our desk, traders are actually most of the time looking at a trade idea, doing the work to prep for it, and then saying no. They're not actually taking that trade. And I think it comes from specificity and experience, but if we're doing that as professional traders every day, retail traders should feel comfortable doing that. Independent traders need to feel comfortable doing that as well. Looking at a trade and recognizing why that really isn't the best trade for me. So saying no to most trades kind of helps slow you down. And I think it's a part of just recognizing what really is good, because when it's really good, it's so obvious. And when it's not, it's really obvious as well. It's just we find ourselves talking ourselves into that trade far too often. If we can just say no to everything that isn't pretty obvious to us, we can focus on the best. We can really put ourselves in a good position to actually develop the skills we need to execute those trades consistently, because we'll have a trading plan. We'll have risk that we're going to allocate to it. We'll understand the dynamics of that trade. So if we're saying no to everything that isn't one of those trades, those best trades, we're really putting ourselves in a better position to build those appropriate habits and take advantage of the opportunities the right way. And then ultimately, we're maximizing our potential. That's what we're all here to do, right? Is as traders, our goal is to maximize our potential so that we can then get to the next level. And even as a pro trader, there are a bunch of levels beyond that. There's a 6-figure trader, 7-figure trader, 8-figure trader. Then there's a team lead. There are all these levels that you're constantly trying to get to. The fastest way to do that is by maximizing the potential that you have with your trading edge. So the stat that we found amazing on our desk was out of 100% of the ideas that you prepare for, right? And this is across every level of traders. The traders that are really successful are trading about 1 in 7. So 1 out of those 7 ideas they're actually taking. So that if they prep for 7, they're actually taking about 1. And it's not perfect, but think about that. You're doing all the work to prepare for, say, 7 ideas. And the one you actually should be taking, maybe you're not taking the other 6 and you're only taking that one. That one is the best one. Think about how broad your prep process needs to be and how good that needs to be. So you're not wasting time on things that aren't really there. And you're still getting to that 7 to 1 trade that you're planning to take category. And even more importantly, when you're using technology, which is such a huge part of our desk, if you're getting alerted to things, you can't expect that the alert is going to have the same results if you're taking 6 out of 7 as if you're really prioritizing what that 1 out of 7 truly looks like, and then just waiting for that 1 out of 7. And a lot of times it's that combination of that catalyst and setup and trade that shows up in that 1 out of 7 opportunities. And if you take those, you're just going to be putting yourself in a much better position to grow as a trader. All right, we talked about a lot of theory, and I appreciate everybody sticking with us. So now we're going to talk about the specifics of execution. I've always hated when I listen to a presentation and there isn't something that I can walk away with. And so we're going to give you a MACD base hit strategy. And what this does is it combines the idea of why a trade exists with the timing that often can be so difficult in trades. And we're going to bring in an indicator. This is from somebody on our desk. His name's Garrett. He works a lot with indicators. And he and I were watching something trade one day and we were just talking about it. And he was like, oh, it's really interesting. If we layer on a MACD, and I didn't really understand what MACD was. He was like, if you layer on a MACD, it's actually telling us that this trade is likely to set up. And I was like, what do you mean? It's a continuation trade. He was like, yeah, but layering on the MACD is actually giving us some rules around it so we can time our executions a little bit better. The reason why we chose to share this one today is because it does happen on every time frame. And I think on this example, we're going to use a daily chart. The key component to this is when we're talking about the catalyst and the setup before we even get into this trade is you want to make sure you're trading something with a catalyst in the direction of the trade that you're making. So if it's a positive catalyst, like if they just beat earnings, you want to be trading this to the long side. Positive breaking news, you want to be trading this to the long side. Technical breakout to the upside, you want to be trading this to the long side. You don't want to be trading this as a reversion strategy. It's just, it tends to be a little bit tougher that way, and you get a lot of false positives. So, that's the first component to it. The second component to it is you actually want to be trading this strategy as a continuation trade. So you're trading with the direction of the trend or maybe the catalyst, but then you want to be trading it as a continuation trade. So the key component of this trade is that it put in a consolidation and then started the break before you're looking for this trade. So it's out of a technical breakout. The way a lot of our traders will use this, and really this is kind of a little bit of a difference between professional and independent traders that I've found, is a lot of our traders will use this as a trade within a trade. So they're making the breakout trade already, and then they recognize this MACD base hit is setting up. And so they'll take this trade as a totally different trade. They won't bring the two together. They'll create a totally different trade around it with a different stop, different target. Everything will be independent from that first trade. But it's like the opportunity just presented itself to them, so they'll take advantage of it. And it smooths their P&L curve and it pads their stats a little bit. And it doesn't really hurt their EV, because honestly, if this trade breaks, if this trade fails, it's highly likely that their core trade is going to fail as well. So a lot of times it allows them to kind of get out for break even or recognize something was happening a little bit faster. So that concept of finding trades within the core trade and not adding to your position is a really important thing that we see a lot of traders doing really, really well on the desk. Hopefully that made sense to everybody. If not, we can go into a little more detail. You can always email us. But we don't just want to teach you this trade. We actually want to give you the cheat sheet for this trade, because there are a little bit of a couple things that you have to customize with the settings that we found improve the probability of this trade. So you'll see in the bottom left the MACD settings, but you can scan that. I think there's going to be a link associated with it. You can go and download this specific cheat sheet, so that you'll have all the rules, you'll have the, kind of the dynamics, that reason for the edge existing that we talked about. And then most importantly, you have the settings that we're using here to cover that. So this is exactly what this MACD base hit strategy is. We adjusted the MACD settings from the default to 395. And the reason we did that is because, again, this is a trade within a trade. So we're already looking for the momentum. You can see this consolidation and then the breakout, and we're looking for the continuation of the momentum. So the specifics of this trade are, we're using the two MACD lines and we're looking for crosses, but we're looking for specific types of crosses, right? So we're not saying, oh, the fast is going above the slow. Like, that's not what I'm saying here. And I wouldn't even pretend to do that. Like, what I'm talking about specifically is you have this price action lining up where we're describing a component where there has been a short-term correction in price, which is leading to that MACD kind of the blue line dipping below the red line. And then what we're looking for is that quick, abrupt move back above where that cross occurs. As long as this is occurring within the context of a higher time frame breakout, we can just use the MACD as our entry signal. Our stop simply goes below the low of the candle of that, the low of that pullback. And then the easiest way to do it is actually use MACD for your exit as well. When it crosses back, when the blue crosses back below the red, so I think it's the 3 crosses back below the 9, you can actually exit your position. That tends to be the best way to get the timing right and at least learn this trade. As you evolve, you'll start to pull in some different components, and maybe you'll say, I'm going to exit half there and I'm going to hold more. But just for starters, this is the very straightforward example. We've shown it 3 different times where it occurred on this one daily chart. And it's just something that happens over and over inside a bigger picture trade. If you were taking this just as a breakout, you probably were taking the break where you saw the volume come in you know, on this way over here on the sides, and I can't even, there's my cursor. Like right here, you're probably taking it here and you're trailing it, and maybe you have a reason to sell of, you know, the first lower high, I'll sell some, or something like that. You know, the first lower low, I'll exit a position. And I guess that first lower low would probably be somewhere over here, right? But you know, within that trade, you're missing out on some opportunity. So this MACD base hit strategy, we hope it's something that's helpful. Trying to teach it in a really quick way. I'm sure there are a bunch of questions on it. Just go ahead and download the cheat sheet. You know, we have scalping at smbcap.com. You can shoot emails if you want to. But the biggest thing that it's really important about this is making sure that you're finding ways to make sure in your best opportunities, you're getting paid as much as possible. You're putting yourself in a position to make as much as you possibly can out of your best trading opportunities. I want to genuinely say thank you, and I'm sure there will be some questions in a minute, but I genuinely appreciate people who are really enthusiastic about learning about trading, studying trading, studying themselves and the edge that they can bring to their trading. Our desk is just stacked with people that are having very specific conversations about how to improve their sleep scores, very specific conversations about their diet, very specific conversations about not, hey, what workout are you doing, but how are you doing the workout that you're doing every day? How do you stay consistent if you missed it for a day? You know, people are even talking about their mindfulness and you know, oh, I feel like I need to go for a little break. I need to calm myself down, like whatever it is. Like those are amazing conversations that really don't have anything to do with trading, but have everything to do with us showing up and being our best every day. And if those conversations are so specific, imagine the conversations about trading and how specific those are. And, you know, that's just such a fun thing when you can collaborate with other people about your trading, about who you are as a person, and about the trading edges that are present. You can just go so much further faster. And I really hope that for many of you out there, you find this useful, you find this valuable. And if you have any questions, you're always welcome to reach out.
Excellent. Well, Jeff, thank you so much for putting this together and presenting it. I took a lot of notes here. I'm sure everybody watching did as well. Excuse me. I definitely have some questions, but first, again, thank you for being a part of the conference. We definitely appreciate it. To start with, I want to ask, you know, about when new traders first come into SMB, what are some of the first resources, books that you assign them to study? Where does the process kind of start to lay that foundation?
Oh
That they
man,
can build off of? I'm
you're
sure
gonna
there's a
make
lot
me
there.
give away the. You're gonna make me give away the secret sauce? No, no, it's not the secret sauce at all. It's actually very interesting. So it's a great question because the first thing we do when somebody joins the desk, and we're talking about maybe somebody that was a retail trader and showing some promise, progressing into that independent trader stage, but realized they really quickly wanted to become a prop trader. That tends to be a lot of it. You go from retail to independent, but recognize you want prop because you want to be surrounded by other people. We're really focused on understanding and helping them build their mindset and their expectations for what they're capable of as traders. And so, you know, there are a lot of really good books out there, but I can talk about this intern class and we'll cycle through them. But we actually give people book reports. It's not enough to say, go read this book on our desk. It's actually go read this book and write up what that meant to you. What that does is we don't give people 3 books either. We give them 1 book and we say, do a book report. When they email us that book report back, we'll take a look at it and usually have some questions to better understand the way they processed the information in that book. And then if they've kind of done a pretty good job and they were thoughtful about it, then we'll give them the next book. So the very first book that we started with this year was Atomic Habits. It's a great book. It's all about habits. A lot of people have already read it, but even if you've read it, we say, go back, read it again, send us a book report, right? So that was the very first book, Atomic Habits. So much of what we do and what we just talked about is consistency, having specific habits that you're doing every day, understanding that there are going to be times that you fail. How do you get back and get back into the routine? But consistency is so key. And so we want to set that stage, set that tone very early. So Atomic Habits was the first one. For those that sent in a good book report, a lot of times it was focused on, I'm going to use a good book report was was I'm going to use the concept from Atomic Habits to improve my chart work. Right. So I'm going to make sure I'm doing my chart work consistently. I'm going to make sure that I'm making it fun for me. I like listening to music while I'm doing my chart work. I'm going to share it because I really like collaborating with other people and getting their feedback. All those things about making it more fun. And then like, I'm going to do it at this time of day and committing to that habit. All those things from that book, people would actually lay out in a plan. Somebody else said technology. Somebody else said studying the scalp radar that we do. So they were studying every single day. All these things are just habits that they were building, but they were really, really important. The second book, we split it. We did a split test. I had never heard this term before, but somebody told me about a split test where you give half the people one book and half the people the other book, and you see how it goes. So for half the people, we did Think and Grow Rich. And for the other half, we did The Daily Trading Coach by Dr. Brett Steenbarger. They both wound up flip-flopping over time. So the third one was whichever one they got the other one. But it was really interesting for us to see. Those that went to the Daily Trading Coach actually had better reviews of the Think and Grow Rich than those that had Think and Grow Rich did of the Daily Trading Coach. So I don't know if it was something about they just loved the fact that they got a trading book instead of two non-related trading books and then a trading book. But so I think moving forward, we'll do those three, but it's essentially the list will be, Atomic Habits, The Daily Trading Coach by Brett Steenbarger. And why we chose that one over all the other trading books is our jobs as traders is to put ourselves in the best position possible. We have to learn to coach ourselves. I can be a trading coach. I can work with traders. Dr. Steenbarger is an amazing trading coach that works with us. He is always trying to teach us to coach ourselves.
Mm-hmm.
Because in that moment, that is all that matters. If we can coach ourselves in that moment, we can recognize opportunity better. We can take advantage of opportunity better. So that's why we think it's so important to learn the strategies associated with coaching yourself. We didn't really cover that in this presentation. We talked more about the things you do to get ready for the day and the ways that you find trading edge. Because I think those two things are really important for everybody to be doing. But you asked, for traders coming in on the desk, we're expecting that they're doing those two things really well. So then it's how do they manage themselves? How do they coach themselves in those key moments? So that's the second book. And then the third is Think and Grow Rich, because the reality is trading presents us with endless opportunities. We say all the time, the markets are opportunity generating machines. And a lot of times what actually limits traders from their ability to achieve their goals once they have the skill and then the ability to coach themselves is their ability to recognize how much money you can make as a trader. It's really tough to have a big enough imagination as a trader sometimes. You're like, I remember when I was like, man, if I could make $1,000 a day as a retail trader, I was like, if I could just make $1,000 a day, that would be amazing, right? Imagine how that would be crazy. I show up, make $1,000 trading, and then I walk just on. This is the opportunity that I'm being given. My job is to execute on it. So that's why we do the Think and Grow Rich, is essentially to try and push people to expand what they're capable of by using some basic habits. So.
Well, thank you for sharing the secret sauce. And I think we both know that the real secret sauce is hard work, dedication, continuous improvement, all of that. But thank you for sharing that book list.
I will say the secret sauce is really everything you said, but it's also like you read a book, you do a book report.
Yeah.
You don't just read a book and say, that was a really good book. Oh, I love that book. You actually write your notes on it. And what's interesting is now traders on our desk will have the same 8 or 10 books that they'll read year over year. So they're not reading new books all the time. They're actually going back to the books that they read previously because they're different people. The trader's a different person. And it's like reading that book, it's almost like you're reading it as a new person, which is really interesting. And so if you don't take notes on it, you don't remember what really you saw last time. So that's kind of that whole thing. It's really interesting to see how powerful that process can be.
Yeah, for sure. And when you were showing the slides with, I forget the exact thing, but it was going over health, nutrition, exercise, why that's so important. I was thinking of Atomic Habits, and for people, you don't want to just go all in and say, all right, I'm going to work out for 3 hours a day. You want to start small, build that habit up. You
Yeah.
mentioned consistency was so important. And it's funny, you mentioned comparing like sleep scores on the desk. Internally over at TraderLion and DeepView, we have our own internal Whoop group that compares all that stuff every day, competes each other. It's a lot of
So
fun.
where do you
Yeah.
fall on that? Where do
What-
you
what-
fall on that?
What do you mean? Where do I
In the
fall?
sleep scores? Yeah.
I'm okay. It's tough for me because I'm on the West Coast. I moved here from
Yeah.
the East Coast, so I'm still kind of getting used to my schedule here and trying to. But I always try to get 8 hours and give myself
Yeah.
the opportunity to give myself 8 hours. I think it's so
Yeah,
important.
that's good. No, I always laugh when somebody's like, "Yeah, we have this group," and I'm like, "Well, where do you fall?" You know, we're all pretty competitive people, and so it's kind of fun. Everybody's told me the West Coast is about the hardest time zone to trade. People in Europe love
Yeah.
trading in Europe. Even traders from our desk love trading in Europe because it's like it's the best time zone. It's like it starts in the late afternoon, goes to the early evening, or I guess 10 o'clock, depending on where you are. And then, you know, you're done for the day, but you have the whole morning. West Coast is brutal, man. Hawaii, I know is even worse, but you know, that's okay. Well, good luck on the West Coast.
Yeah, thanks. It's tough sometimes because I might have a soccer game that ends at 10 and
Yep.
you know, I got to be up and ready and get sorted and before the bell at, 6 a.m. my time, but I make it work.
Well, how much prep do you do the night before? Because that's what we've heard from
was my
the
switch.
people in the, yeah, okay.
Yeah, that was my switch. I really had to do almost all my prep work, and it's a little bit easier for me because my time frame's more swing position trading, so things don't change quite as fast. So I can do more of that prep work, on the weekends, the day
Yeah.
before. So that's
Yeah.
definitely helpful.
Yeah, that's what we've heard from traders on our desk is if they do 80% of the prep the night before, then they're less rushed the morning of. And at, when the market opens at 6:30 in the morning, and if you're up at 4:30, it's just tough. So they're like, yeah, gotta make sure that we're getting the prep done the night before. So that's cool. Yeah.
Yeah, for sure. And doubling down on my question about, traders coming in and kind of the program for them, specifically about risk management, cutting losses, stop losses. Are there any key principles that you guys really try to instill regarding position sizing, making sure that you're not risking too much, but at the same time, like you said, when there's an A plus trade, make sure you've got enough on that it moves the needle. Yeah, anything that you can provide guidance around cutting losses and risk management is so important.
The experienced traders on our desk are always talking about, we use the EV equation, expected value equation. They're always talking about EV components constantly. New developing traders, I don't think are at the point typically where they need to be worrying about the EV component as much. You really need a source of edge first. And on our desk, once you have a trade that you understand, so we built this thing called the scalp radar. And what it is it's I had built it with some other traders in the desk, and we built it because we would have these new developing traders come in. And what do new developing traders do? They hear something called out on the desk and they're slamming into it right away, right? And then they slam into it again, and then they slam into something else. And it's like you need to be able to slow yourself down and focus on edge as a new developing trader. And so we built this technology that's available publicly, but it brings the trades to you, and we teach the trades very specifically. The core component of what we teach in each of those trades is this is why this trade has edge. And so here's where your stop should be because of why this trade has edge, right? We talked about an overextension earlier. Your stop can't be halfway, up a candle from the lows if the trade is really below the low. If you don't understand that, if you can't conceptually grasp where your stop could be, your sizing is going to be off. You're not going to be able to accurately predict your EV because your sizing is going to be off. And even worse, your probability component is going to be off as well. So you have to understand structurally what trade you're looking for, where the appropriate stop would be. We say start with your stop. Once you have your stop, then you can start to think about what my sizing should be based on the other factors. But without that, you don't really have much that you can fall back on. And we'll see a lot of traders make a lot of mistakes. So we teach those very specific, that structure, right? excuse me, we teach that structure so that you learn how to apply it to any trade you might take. Then, you want to understand what variables need to be present for you to actually have an entry. And that's really where your position sizing comes in, right? So an A+ version might look very similar, but it has 3 or 4 or 5 other variables that a B version doesn't have. That's where we start to gravitate traders into that EV, bet sizing component question. We just had a meeting earlier today with some of our developing traders that have just started. The number one thing that they want to work on over the next month, we're coming to the end of the month, so we're setting monthly goals for July, was position sizing, was bet sizing. It was almost like, I think 60% of the traders said, independently from each other, I'd really like to get better at position sizing. I'd really like to get better at bet sizing. But they're all, a month to 4 months in. So you think about, none of them had that as their number one thing when they first started. But after a couple months where they've learned some strategies, they understand what they're doing, that's becoming more and more important. A good number that we use on the desk is you have to see about 20 examples of one specific trade in order to understand what variables might be present that can allow you to bet a little more dynamically, to actually focus on your EV equation. So, it might be 1 month or 3 months or 4 months that you get those 20 examples, but you have to see about 20 before you even can start to think about your bet sizing. And the next month is going to be a lot of fun for me, because that is the part of trading that I think most of the edge really comes from. Most of your ability to capture the edge, not where the edge comes from, but your ability to actually capture the edge that's present comes in your ability to size correctly based on the right opportunity.
Yeah, I think everybody just rewind that and listen to it back, because I think that's a really important point. So really good, Jeff. And is there, to start with, maybe a baseline percentage of your portfolio that you guys recommend risking? Obviously it depends on the volatility, but is there a baseline number that you guys use?
No, we focus entirely on daily stop.
Okay.
So we have a number that is your daily stop. We trade intraday. Most of our strategies are intraday.
Yeah.
And so but you could use this on any time frame. We'll give you a little bit of an equation that you could use on any time frame to figure out what your general daily stop, or how much you should be risking broadly in a trade, might be. It's not 2% of your portfolio. It might actually wind up being 2% of your portfolio, but here's the way we think about how to calculate a daily stop. So if you've been trading for any period of time, you should have an average winning day, you should have an average losing day. Or if you're swing trading, you should have an average trade win and an average trade loss. And then you should also have the number of trades that you win and the number of trades that you lose. Basically your batting percentage, right? For most traders on our desk, like we talked about, it's 3 days profitable, 1 day probably flat, and 1 day down a little bit. We're still taking the average winning day and looking for and then the average losing day. And as long as the average winning day is larger than the average losing day, we're taking about 70%. And you can use half or 70%, but you're taking about 70% of your average winning day, and that becomes your daily stop. So what you're thinking about is, on an average day, I really shouldn't be losing more than 70% of what I make on an average day. And you could do the same math with trades. And the numbers shift over time depending on the volatility. Right? So if volatility is higher, that percentage might be lower, because you can't expose yourself to too much. If volatility is lower, that percentage actually goes a little bit higher. Like, it's really interesting to see. The reason why it works that way on our desk is because volatility should work in your favor on our desk. It should mean more opportunities, better opportunities. So you actually want to risk down a little bit in that moment, because you're going to get more hits. You're going to get more attempts to trade, and they're more likely to follow through. So if something isn't working, you want to cut it off faster. So that's where that little bit of a sliding scale. So sometimes you'll hear 40% up to 70%, but that's roughly where you want to be.
Yeah, perfect. I think that's really helpful. And going back to the MACD strategy that you shared, maybe if you could go back one slide
Yeah.
to the NVIDIA chart. I didn't quite catch whether the stop was the low of, you know, the
How'd you
breakout
know
day
it was
or the low.
NVIDIA?
I've looked at that chart so many times. That's why.
I was wondering if you'd be able to get that. That's
Yeah.
awesome. Nice job. Yeah.
Yeah. So just to ask my question again, for one of those signals, maybe just
Yep.
walk through where you'd place a stop, whether it's under the consolidation or as it
Yep.
finally like pushes up, you put the low end of
Yeah.
the stop there. Yeah.
So for us, what we do, and a lot of times we'll trade this on an intraday basis, but the stop would be below the low
Gotcha.
of the pullback. So right here, you have a consolidation, you know, that's where the stop would be, right? And then then it triggers here and you would be in, and then you would look for continuation. And then in theory, you would be out, I guess where the break occurs, which is somewhere right around here, right? So your stop is always just below the low of the recent pullback. This one's a little tricky. And actually,
Yeah.
we were debating, do we put it on here or not? Because it does sort of invalidate the rules because they both one of them goes below the zero line. But the debate, I was asking Garrett about it, and he's like, you got to put it on there because the reality is you need to be buying this. Off of that, like even if your stop's all the way down here, you need to be buying this because you don't know if it's going to go parabolic. And it kind of tries to here. And it's like, even though your stop's all the way down there, like Garrett took this trade and he was like, you know, you need to be buying this on the close. Like you don't have a choice. Once this triggers, you need to be buying this. And he's right. The reality is you need to be taking that trade. So we left it on there. The third one, you know, so your stop would be really far away here, but you have to be taking that trade. The probabilities are so on your side. The risk reward isn't as good, but the probabilities are so high of follow through at that point. You have to be taking it. This third one's much more simple. It's just the stop would go right below here. You get the trigger, you take it, and then I can't see the kind of continuation part of it where we would exit, maybe right around there. But it's just something where your stop always goes below the most recent, I think it's called swing low, but that's basically where the pullback stop, that's where your stop goes. And sometimes it's a little more abrupt than others. Sometimes it's a flat line, but that's the same component all the way through.
Gotcha.
And then
yeah, go ahead,
the
please.
idea is as it starts to accelerate, you know, there are a lot of different ways to trade this. The easiest one is wait for the turns to exit, the crosses back to exit. The reality is you'll find traders as it starts to accelerate, moving it up for a single or double bar break, the prior day close. They'll use a 9 EMA or a moving average to essentially trail themselves out of it. You know, there are a lot of different ways that traders will exit this, but we wanted to keep it as simple as possible. But yeah, that's the most straightforward way.
Yeah, the exits are always the tough part. That's true.
Yeah.
And
Yeah.
on the one that you guys were debating, that had an extra catalyst on earnings. So
Correct.
there's that
And
extra push there.
that was literally what Garrett said. He was like, their earnings were so good. You can't like give up on a trade just because you're like, oh, the stop's really far away. He's like, that had that extra kicker. So the probabilities were even higher that trade was going to work. So you have to take that trade. And I was like, all right, fine, we'll leave it in.
Yeah. And for this strategy, which I know you guys mostly do on the intraday basis, is it a buy on the close of the bar that triggers
Yes.
it? Okay.
Yeah,
Gotcha.
because the moving averages need to cross each other. And so, or the MACDs need to cross each other, and that doesn't happen unless the bars close. I know on some platforms it indicates it, but you need the bar to close in order to confirm that. Because I was actually in a trade today and it looked like it, and then it closed the other way. And I was like, oh, and I had like predicted it. Like I was going to go into a meeting. And so I was like, oh, I want to get this before. And like it looked like it was going to do it. So I was like, oh, I'll buy some. But then the where the close of the bar was set it back and it didn't actually trigger. So yeah, that's a good question. You want to make sure that it's the close of the bar.
Perfect. Well, yeah, that's helpful clarification. So thank you. Pivoting back to the traders and development. I was curious how you guys at SMB measure improvement and like kind of objectively define that. And maybe if you could give some guidance for people watching to measure their own improvement as well, because often as traders, we're doing all this chart work. It feels like a grind. Our trading doesn't really seem to be improving too fastly, but taking a step back, you are making advances, and it's hard to stay confident when you're improving, but your results aren't quite showing that. So I'm sure you have some useful thoughts there.
Yeah, I'm gonna try and draw this and hopefully you guys can see it. This is what we do with traders in our desk. It's for every habit, and I don't, you're gonna have to let me know if you can see it. I don't know, can you see this here?
Yep, there we go.
Okay, so this is quality and consistency, right? So when we talk about improvement, we measure it by one habit at a time, right? So if you're talking about chart work, you want to make sure that the quality of the chart work you're doing is as high quality as you can do it. The purpose of chart work is to identify trading opportunities. So you can measure that based on how many trading opportunities out of all the trading opportunities I saw did I capture, right? Or did I plan for? How did I plan for those? Did I make an auxiliary plan for those? Those are all ways to increase the quality, right? What are some of the variables that I need to see that wouldn't just put it on my list, but put it higher on my list as a priority if I notice something on the chart, right? Those are ways to increase the quality. Consistency speaks for itself. You need to be really consistent with this work. If it's a daily habit, you need to be doing it every day. Your goal is to keep your habits as high on this quality consistency scale as you possibly can.
Mm-hmm.
If then you look across all of your habits and you recognize that some of them I'm not doing with enough consistency and I'm not doing with enough quality, well, you either need to drop that habit because you're never gonna do it, or you need to say, I'm gonna move this up. Everything needs to be in that top right quadrant. If it's not, what are you even doing? Why are you wasting your time doing it? If the quality isn't there and the consistency isn't there, it's actually not serving you. It's probably hurting you more than you think. So that's what we focus on with traders on our desk is we look at their habits and whatever habits they commit to, and those are different depending on the trader and their time frame. But whatever habits they commit to, where are they falling on that quality and consistency? And if you're doing things enough, if your consistency is high enough, you're going to recognize that there are increasing higher levels of quality that you can be doing. But you have to be constantly doing that in order to keep growing. So I do think it's a little bit of a never-ending quest, but it kind of feels a little bit better when you look back at your chart work from a year ago and you're like, wow, I see so much more nuance than I did before. Well, that really only comes by doing it the best you can do today consistently.
Yeah, I love that. And there's that saying, I forget exactly how it goes, but if you don't look back at your past self and be embarrassed or something, you're not improving. And I think that's so true. Like you said, with chart work, even me looking back very early on at YouTube videos, you can see how far you've come. So I think that's a great way to look at it. And one other thing I wanted to ask you, Jeff, you've mentioned the importance of teamwork multiple times today. How important is it to kind of have a community where you can go to bounce ideas off of each other, learn from each other, learn from their mistakes as well as your own, and also have that support network as well. It's not just idea generation, but support network. How can that kind of help accelerate your learning curve?
Yeah, when we have new developing traders do projects, very rarely are they doing projects independently. They're almost always doing projects in a team of 2 or 3. On our desk, very rarely will you see a successful trader trading independently. I know there's that idea that you'll see traders trading all by themselves, but most of the time, on our desk at least, you'll see traders trading in I think the term pods is thrown around. I don't really see it as pods anymore. I really see it as packs. And their packs kind of hunting opportunity. And when there's really good opportunity there's this palpable sensation in the air that just like everybody knows it's go time. Everybody's ready to go. You're ready to hunt. You're ready to pounce on the opportunity. You're ready to take advantage of it. And everybody in your team is ready for that. There are 2 levels to that collaboration. There's one that's getting you into the grind and through the grind. And like you talked about, that accountability of I'm going to do my habit every day. And so early on in traders' careers, they will have accountability buddies to make sure that there's somebody that they met that is like, hey, listen, I can help you. Can you help me? Sort of thing. That's really, really important. But the real fun comes in when you can kind of hunt in a pack of other traders, when you can really look for opportunity, know when to back off because it's not just right, and have everybody back off, and then really take advantage of it when there's good opportunity there for you. That's where the real fun comes in collaborative work.
Yeah, excellent. Perfect. Well, Jeff, this has been really fantastic. I've really enjoyed it. Do you have any kind of closing remarks for everybody watching to inspire them, give them some words of wisdom, apart from what you already have, of course?
Yeah, so we have this mural on our walls in the office, and maybe we can send you a photo and you can play it, you can show it at this time. But
Sure.
it's a quote from Dr. Steenbarger, and it actually says, "You were meant to do something great." That hangs in our office because we really believe that for every person that wants to be a trader. You're here to do something great. The actions that you take every day, the people that you associate with every day, the type of learning that you do every day will be a reflection of how you view yourself. But from our seat, you were meant to do something great. So our expectations and our hopes for you are that you will act that way, you will be surrounded by other great people, and you'll do something great every single day, because that's who we believe you are.
Great. I think that's a fantastic place to end it. Jeff, thank you again very much for your time today. I really appreciate it. I learned something. Again, look forward to watching this back. To everybody watching, make sure to thank Jeff in the chat. Leave a like down below if you enjoyed it. Subscribe to the channel as well. And we'll be right back with our next presenter. So Jeff, thank you again for your time, and cheers, everybody.
Thanks.
All right, welcome back, everybody. Looking forward to this next presentation. We have Brian Feroldi. Brian is a financial educator, the author of Why Does the Stock Market Go Up, and a long-term investor since the early 2000s. Today, he'll be giving an excellent presentation on the business cycle and the stages all companies go through. And I think it should provide a really excellent context in terms of the longer-term trends that stocks go through, and also really good insight into how institutions think about analyzing companies during different stages of their life cycle. So Brian, thank you so much for being here. First of all, really looking forward to this, and yeah, I'm excited.
Awesome. Well, thank you for the nice introduction, and thank you for introducing me. And I will get right to it, shall we?
Yeah, let's do it.
All right, cool. Well, hi, everybody. My name is Brian Feroldi. I've been buying and selling individual stocks for about 20 years now. I am primarily a long-term buy and hold investor. And my presentation today is about this, the business growth cycle, something that I did not understand at all, was never explained to me when I first started. And if I had this bit of information in my brain when I first started, my results would have been dramatically better. First off, I am a huge fan of this framework. You're going to be investing your time watching me talk about this. So what do you get out of it? My hope is that by the end of this presentation, you will be able to identify which stage a company is currently in the business growth cycle. So if you can do that at the end of this talk, then this talk was a success. Here is a rough roadmap for what you can expect over the next 45 minutes or so. We're going to start talking about what the heck is the business growth cycle, talk about what stage a company is in. We're going to show you specific financials so that you can identify which stage a company is in. And then I'm going to end with a quick review and some common questions and answers. So here is the most important visual that I'm going to show you today. This visual shows you the 6 distinct stages that most publicly traded companies go through during their life as a business. There are 6 stages, and I'm going to break down the key traits that a company has in each stage. Now, a great question to ask me is, did I just make this up, right? If you've never heard of this concept before, is this just something that came off the top of my head? The answer there is no. I borrowed this idea very generously from Aswath Damodaran. He is a famous valuation guru and teacher at the NYU Stern School of Business, and he has a great book called The Corporate Life Cycle, and I borrowed very heavily upon his ideas to adapt this to my own. So here are the 6 stages that a company goes through during its run from birth and from startup all the way until death. So phase 1 of the business growth cycle is the startup phase. During this phase, a company is trying to bring a new product or a new service to market. So the goal in this stage is to establish product market fit and to really drive all effort towards getting the company's sales higher. So getting product market fit is something that the company is desperately trying to do. It's very common for companies that are in stage 1 to basically have no revenue at all or very little revenue. Now, they're often building out a product or service that requires a lot of upfront investment. So because they have very little revenue, but their expenses are growing, these companies are not profitable. They have negative net income, and their net income as time moves on is actually getting worse. So they're losing more money as time progresses. Now, an example of a company that is in stage 1 today, the startup phase, is a battery maker called QuantumScape. They're focused on next generation lithium ion batteries, and I'll show you their financials a little later in this presentation to show you how we know they're in this stage. Okay, so once a company graduates from the startup phase, which is a major achievement, they have now clearly established product market fit. So they've gotten through stage 1 and to stage 2. During stage 2, their primary goal shifts ever so slightly from growing sales to growing gross profit. For those that are unfamiliar, gross profit is simply revenue minus the cost of producing that revenue. So if you're selling a car, for example, the gross profit would be your sales price of your car minus the cost to manufacture the car. Now, companies in this phase are growing their revenue extremely quickly because they have established product market fit. Their gross margin, which is gross profit divided by revenue, is expanding towards its ultimate stage. So the company is really optimized for the gross product of the product or service. Now, in this stage, the company is still losing gobs of money, but the losses have stopped to increase and the losses are now decreasing. It's a major inflection point for the business. Now, the example of a company that recently went through this was Transmedics. This is a medical device company that keeps organs alive in between a patient dying and being implanted. And the company recently went through this stage. All right, moving on to stage 3. A company graduates from stage 3 and finally enters the self-funding phase. And the company's goal here is to become profitable. Stop losing money, start making money. Now, it's very common for companies in this stage to have very fast growing revenue still. Their profits and their losses start shrinking, eventually reach break even, and then they become positive and start to grow extremely quickly. So these companies are finally making a profit, but the profit is teeny tiny. They're basically not making any money at all, but they're not losing money. Now, a company that recently went through this stage in the public market is Insulet Corporation. This is a medical device company focused on the diabetes market. All right, once a company makes it all the way through stage 3, then they start to enter fun stages. The next stage that they hit is stage 4, the operating leverage stage. Now, the primary goal in this stage is to maximize margins, aka to start to focus on maximizing how much profit the business can generate. Now, because the company has gone through phases 1, 2, and 3 already, revenue is still growing in this stage, but it's growing at a more moderate pace. The company still has a bigger base of sales to build off of, so the sales growth rate is slowing down. However, a key feature of this phase is that the company's profits are growing at a much faster pace than revenue. And they're doing this because instead of focusing on the top line, they're now focusing on driving profits higher. A company that recently went through this stage, or at least was in it briefly, was Tesla. Then we get to stage 5, the capital return phase. The company's primary goal in this phase, finally, is to reward shareholders. Use the company's profits to reward shareholders with stock buybacks, with debt paydowns, with dividends, with acquisitions, etc. Now, in the capital return phase, a company's revenue should still be growing, but the pace of growth should be very modest. 5%, maybe up to a high of 15%, something around there. Now, the company is going to start generating meaningful amounts of free cash flow. In phases 1 through 4, the company was investing heavily in its infrastructure. And by phase 5, those investments should start generating meaningful amounts of free cash flow. And as I said, dividend and buybacks become the preferred thing that management teams focus on. An example of a company in stage 5 would be Home Depot, slow-moving cash flow machine, dividend and buyback machine. Now, unfortunately, all companies will eventually reach stage 6. It is a force of capitalism. Revenue and sales are declining, and the company's primary goal in stage 6 becomes to return to stage 5. Now, you can often tell a company is in stage 6 because its sales and its profits are declining. Its balance sheet is often very distressed. It has a lot of debt. It has a little bit of cash. Management teams are very commonly in this stage making capital allocation errors. And the ultimate, if you in stage 6 for too long, the ultimate end is bankruptcy. We recently saw Bed Bath & Beyond go through exactly this. In fact, many retailers, big stodgy retailers, are in stage 6 and have gone through the bankruptcy process. So here is a brief summary of these 6 stages of the business growth cycle, as well as what the company is primarily focused on in each stage. Now, a key question to answer is, well, great, this sounds very academic. Why the heck does this matter to me if you're an investor like I am? Why is knowing these stages important? The reason that knowing these stages is important is because the way that you value companies depends heavily on which stage of the business growth cycle they are currently in. For example, one method of valuing a business is called total addressable market analysis, where you basically forecast how big could the company be if it successfully achieves its goals. This is a wonderful analysis to do when a company is in the startup or hypergrowth phase. You often have very little information to go on when a company is in these phases, so it's often the only valuation method that you can use. As the company matures and achieves that goal, this kind of analysis for valuation purposes becomes less and less useful, and you really shouldn't use it at all when a company is in the mature phases. Or how about using multiple analysis? Probably the most common way that we value stocks, using the price to sales ratio, the price to earnings ratio, enterprise value to EBITDA, etc. Well, multiple analysis is one of the trickiest type of analysis you can do because the multiple that you should pay attention to depends heavily on which stage of the business growth cycle a company is currently in. For example, in phase 1 and phase 2, when a company's revenue is getting ramped up, the only metric that you can look at from a multiple perspective is price to sales. Price to earnings, price to free cash flow, EV to EBITDA. These multiples are useless to you as an investor when a company is in stage 1 and stage 2. Moreover, as a company moves up the business growth cycle and graduates from phase to phase, the multiple that you should pay attention to as an investor also changes. The most common mistake that I see investors making when it comes to valuation is they try and use the price to earnings ratio, which is only useful in stage 5. They try and use this in stage 4 or stage 3 or stage 2. And if you do that, if you use the wrong multiple in the wrong stage, you're gonna get the wrong answer. All right, let's talk about method number 3, a very common one for professional investors, a discounted cash flow valuation analysis. Well, as my table here tries to convey, this method of valuing businesses is essentially worthless when a company is in phase 1 or phase 2. It's modestly helpful in stages 3, stages 4, and stages 6, but I don't think it's the ideal valuation method to use. However, a discounted cash flow model really shines when a business is in the capital return phase, in phase 5. So if you try and value a company using a DCF model in any phase but phase 5, it's going to be utterly useless. The final valuation method that I think is worth studying is a discounted cash flow analysis. This is one of my favorite ways to value businesses. And as you can see, this model is also only useful to investors when a company is in stage 4 or stage 5. And outside of that range, it is not really all that useful. Now, another way that the business growth cycle can help you as an investor is for you to focus in on what phase or what stage of the business growth cycle you prefer to deploy capital in. So I like to put all the investing greats that are out there, from, Mark Andreessen to Warren Buffett to Michael Burry to Chuck Akre, I like to put them on what I call the valuation mindset spectrum. All of these investors think differently about valuing businesses. And one reason why they think so differently about valuing businesses is that they invest on different stages of the business growth cycle. Take Mark Andreessen, for example, the co-founder of Andreessen Horowitz, one of the most famous VC firms that are out there. Mark Andreessen exclusively invests in phase one. This is the highest risk category to invest in, but it also has the highest return potential. So Mark Andreessen thinks completely differently about valuing businesses because he's in stage one than an investor would in stage 5 or stage 6. Now, in phase 2, this is where you find some early stage growth type public investors like Cathie Wood and David Gardner. And then comes phase 3, where some other investors certainly lie. And I think it's really in phase 4 that other investors that you've heard of start to enter the phase, such as Peter Lynch and Chuck Akre. These investors really like to put their money in companies that are in phase 4. Now, phase 5 is where I would argue most of the investing greats that you have heard of like to deploy capital. Terry Smith, Manish Pabrai, they live in phase 5. And then finally, phase 6, the decline phase, you can make money in this phase if you really focus on valuation and you get your timing right. And this is the phase that Michael Burry sometimes like to invest in, and Benjamin Graham is certainly famous for investing in. So it's really important when you are an investor that you study yourself thoroughly. And one key thing to know about yourself is which phase of the business growth cycle you like to deploy capital in. That's a really key thing to know about yourself. All right, so those are the 6 stages, some famous investors that are in there. Let's talk about answering this question. So, well, how do you know which stage of the business growth cycle a company is currently in? Well, the answers there lie from looking at the company's income statement. And it's even more helpful if you can look at multiple income statements over a period of years, because you can see the progression happening in real time. Now, if you're unfamiliar with how to read an income statement, let's just review some of the key numbers on here. Up top is revenue, all the sales that a company generates. Then you're going to look at gross profit, which is revenue minus cost of goods sold. The third number to look at to figure this out is operating income, which is revenue minus cost of goods sold minus all operating expenses. The fourth number that you're going to have to pay attention to is net income, aka earnings, aka profits. And the final number on the income statement to look at to figure out what stage a company is the shares outstanding, and specifically the direction that shares outstanding are moving. Now let's quickly review just all of the phases of the income statement just to make sure we're all on the same page. I hope this is a review for you, but revenue is at the top. This is the total sales that a company generates after accounting for discounts, chargebacks, rebates, and all that kind of stuff. Cost of goods sold is all of the costs that go directly into manufacturing or making the product or service. Gross profit is just math, revenue minus cost of goods sold. Then there's operating expenses, which could be categorized in a variety of different ways, but this basically includes all of a company's overhead costs related to sales and marketing, research and development, depreciation, amortization, fixed costs, etc. Now, after we subtract that from gross profit, we get operating income, which is the profit that a business generates from its ongoing operations. Then we have to account for some non-operating income and expenses, such as if a company earns interest from cash held at a bank, that's income that the company gets, but it didn't operate to earn that income. And then comes the company's pre-tax income, which is all of the company's profits before paying taxes. Then comes the company's tax bill. Finally, the bottom line there is net income, which also can be called earnings, which also can be called profits. And we would normally stop there if this was a one-person business, but since we're analyzing public companies, we have to divide that by the total number of shares that the company has outstanding. And then finally, the next number is the company's earnings per share, or net income on a per share basis. But let's zoom out for a second and let's think about the income statement, how the income statement evolves when compared to the 6 phases of the business growth cycle. So let's start with thing number 1, a company's revenue. Just think about revenue for a second, which is the dashed yellow line right here. Well, in phase 1, the startup phase, a company often has very little revenue or no revenue at all. In phase 2 and phase 3, revenue is growing extremely rapidly, about 25% plus per year. In phases 4, it slows down to, say, 15% growth. In phase 5, it slows down to 5% growth. And then in phase 6, a company's revenue is often declining. Now, you can often tell what phase a company is in just by looking at revenue. But if you want to get more specific, we do have to go to the next number, which is gross profit. Now, gross profit is often negative in phase 1. So the company is losing money by selling the product. Then gross profit grows extremely rapidly in phases 2 and phase 3. The growth rate moderates in 4 and 5, and gross profit often declines in stage 6. Then comes the company's operating profit. Operating profit is negative, and the losses are getting worse in phases 1. The company's operating profit is negative in phase 2, but it's often getting better, or at least the expenses are peaking. In phase 3, this number gets towards that magical 0 number and turns positive. And then in phase 4 is when it starts to really grow rapidly. Growth finally slows in phase 5 and declines in phase 6. It's a very similar story for the company's net profit, net loss or net earnings. Losses grow in phase 1, they peak in phase 2, they get back to 0 in phase 3, and then they grow rapidly and then more slowly. And then finally, we need to think about the company's share count. When a company is in phases 1, 2, and 3, it needs money from outside investors to fund itself. One major way that these companies fund themselves is by issuing stock. That's why they go public or have first, second, third rounds of financing from venture capitalists. Because they're issuing stock to fund themselves, their share count is growing very rapidly in phases 1 and phases 2. In phases 3 and phases 4, the share count is still growing, but the growth rate is moderating. This is often due to stock-based compensation. By phase 5, the share count should be extremely stable, or even better if it was declining because of stock buybacks. And then in phase 6, a tricky phase, it's often stable, or in some cases, the share count is declining, which all of a sudden becomes a bad thing. This is one reason why stock buybacks, as a side note, can be very controversial. Stock buybacks can make a whole lot of sense in stage 5, but they're a disastrous use of capital in stage 6. So here's how those key numbers map up against the income statement and how we can tell which phase a company is in. All right, so that was the theory of how to tell what stage a company is in. Let's actually show you some real financial statements and show you how we could tell what phase these companies are in. So let's talk about the startup phase. Remember, this is the phase when a company is beginning to sell. And we know it's in this stage because it often has very little revenue. Every other number looks terrible. The share count is rising very rapidly. And I said at the beginning of this presentation that QuantumScape, a ticker symbol QS, is in the startup phase. Well, here is QuantumScape's income statement from the years 2020 to 2022. So let's go top to bottom and tick off those 5 numbers. Well, let's start with revenue. There is zero revenue. There's no revenue and there is no gross profit at all. Based on that alone, we could tell that this company was clearly in the startup phase. But for the sake of thoroughness, let's keep going. So the company's operating income, operating loss in this case, is growing. So the amount of money that the company is losing is expanding with each passing year. It's the same story for net income. Net income is getting wider. And then finally, the share count. The share count is growing extremely rapidly. Why is that? Because QuantumScape is selling stock in order to fund its huge losses. So very clearly, based on revenue alone, QuantumScape stage 1. All right, let's move on to stage 2, the hypergrowth phase. This is when a company is primarily focused on revenue and gross profit. Every other number looks terrible, and the share count is often rising very rapidly. So the company that's in this stage is TransMedics, ticker symbol TMDX. So here's a couple years of TransMedics income statement. So again, let's key in on those numbers as we look down it. So let's start with revenue. So this company has revenue. Revenue is growing fairly quickly in this phase, 20% plus. Gross profit is a positive figure. That's a good sign. And it's also growing very quickly. In fact, it's growing faster than revenue. Now, how about the company's operating numbers? Well, the company is losing money, and the amount of money that it's losing is actually expanding in this case. Similar story for net income. The losses are getting bigger. And then there's the company's share count. The shares outstanding are rising pretty rapidly. In this case, about 10% dilution year over year. So this would be a great example of a company that was in phase 2. It has revenue, it has gross profit. Everything else looks pretty bad. All right, moving on to phase 3, the self-funding phase. Remember, in this phase, a company's goal is to become profitable, stop losing money, reach break even. So from an income statement perspective, we should see positive numbers on top, and these numbers below it should all turn positive. They might not be impressive, but they're positive. So let's take a look at Insulet Corporation, ticker symbol PODD. So let's start at the top with sales growth. Very rapid sales growth from 463 million to 738 million over a 3-year stretch. Similar story for gross profit. This figure is expanding quite rapidly. Now, if we key in on the company's operating income and net income, what we'll see is in 2017, it was losing money on both an operating and net basis, but these numbers flipped to profitability in 2018 and 2019. That is a key sign that the company is in phase 3. Now notice in 2019, the company's net income is not that impressive. $11 million in net income on $740 million in sales, very little profits compared to the company's sales, but that's a clear sign that they crossed into profitability. And then finally, the share count is still increasing, but at a relatively modest pace, something like 3 or 4% per year is the company's dilution rate. All right, moving on to stage 4. This is when a company's goal is to maximize its margins. Remember, prior to this, the company's goal was to get to break even, not to make money, just to get to break even. Now that it's there, its goal shifts to maximizing margins and maximizing profitability. So you can tell a company is in this stage when every number is positive and every number is growing at an accelerating rate below revenue. And a company that was recently through this phase was Tesla. So here are Tesla's income statement for 2020 through 2022. And let's look at sales growth. If this is hard to see, sales here grew from 31 billion to 81 billion. Huge growth. Gross profit grew from 6 billion to 20 billion. So that is a tripling of gross profit. Now, revenue doubled, gross profit tripled. So it's growing faster. How about operating income? Well, this number went from 2 billion to 13 billion, a 6x increase, a six-fold increase in operating income. Net income went from 1 billion to 12 billion. That's a 12x increase in net income. So a doubling of sales, tripling of gross profit, sextupling of operating income, and a 12x of net income. So this company was clearly starting to shift its focus, instead of being on revenue, to profit. And then finally, if we look at the share count here was increasing, but at a relatively moderate pace. Now, if you're looking at these numbers, it can be hard to tell how much they're increasing when compared to each other. This is why margins and margin analysis can be so useful, because you can help translate the raw numbers into percentages, and you can use those percentages to tell, well, what phase is the company in. So the three key margins to look at are gross margin, operating margin, and net margin. So to find each of these, we simply take those numbers and we divide it by revenue during the period. Now, let me show you why this is useful. So here in 2020, we take gross profit of 6 billion, 6.6, and we divide it by sales that year. We see the company's gross margin was 21%. Well, the next year, if we do that same math, gross margin jumped to 25%. And then it rose the next year to 25.6%. So it's a lot easier to tell under this scenario that, yeah, gross margin is increasing. Let's do that same math for operating margin. And we see an even more dramatic rise. Operating margin rose from 6% up to about 17%. And then finally, if we do that same calculation for net margin, we see that net margin went from about 2.7% to 15%. And that change there, that focus. So the focus here in 2020 was let's grow the revenue, and the focus over the next 3 years became let's grow profits. And you can see that a company is in phase 4 by watching its margins. All right, let's move on to phase 5, the rewarding shareholders phase. So a company has successfully made it through 1 and 4. It's reliably producing profit, net income, and free cash flow. And its focus now becomes taking that cash flow, returning it to shareholders. So Home Depot is a company that is very clearly in stage 5. Let's go through its key numbers to find out why. So if we look at sales growth, revenue, we see that sales growth is increasing, but at a fairly modest pace. Same story for gross profit. Gross profit is increasing, but at a fairly modest pace. Operating income positive and growing slowly. Net income positive and growing slowly. Now, the key thing to understand about phase 5 is that if you look at the share count, the number of shares outstanding, this number is now declining. The company is buying back stock. That is reducing the number of shares outstanding, which is a clear sign that the company is in the capital return phase. Okay, finally, let's talk about stage 6, the decline phase, the phase that no company ever wants to be in, right? So there's trouble happening at the company, and the primary goal becomes just save the ship and turn the company out and return it to its former glory. So let's take a look at Bed Bath & Beyond's numbers so that we can see if this company is in stage 6. So here we have revenue declining by, 20% per year? That's not good. Gross profit, same story, declining at a 20%-ish per year rate. Operating losses are negative 700 million, and those operating losses are are wild. And there's also cost cutting happening in the company's overhead. And there's also lots of restructuring charges in there. So that's not good. And then the company's net loss is negative, and it's not looking good for the business. Now, funnily enough, if you look at the share count, this is a company whose share count is decreasing extremely rapidly. So management is looking at the stock. The stock looks cheap. It's using a lot of cash flow to buy back that stock from the public market. And this proved to be a disastrous use of capital. When the company was most in need of cash and cash flowed, management was buying a stock that just 2 years later would be worth $0. So this is again why stock buybacks can be a funny thing. In phase 5, they can be a great use of capital. In phase 6, disastrous use of capital. So as a reminder, here is a quick summary that you can use as a rough guide to tell what phase of the business growth cycle a company is currently in. Okay, I just threw a ton of information at you in a relatively short period of time. I hope that it was useful. Let's review some of the key points that we discussed, and I'll answer some very common Q&A that I get when talking about the business growth cycle. So key takeaway number 1, the business growth cycle exists. The vast majority of publicly traded companies go through these 6 stages during their life as a business. In stage 1, the goal is survive, grow revenue, and establish product market fit. In phase 2, the goal is to grow gross profit, grow very, very rapidly, and expand margins. In phase 3, the company's goal is to efficiently manage its cash, reach profitability, and grow fast. In phase 4, the company's goal is to drive operating leverage and to really focus for the first time on increasing profits. In phase 5, the company's goal is to effectively allocate its capital and to use that capital to reward shareholders. And in phase 6, the company's goal is to get back to phase 5, fix its distressed balance sheet, and just survive. Now, you can tell what phase a company is in by looking at its income statement, and specifically these 5 numbers on the income statement. And this analysis is incredibly important if you're going to try and value a business. You should never attempt to value any business without first knowing what stage of the business growth cycle the company is currently in. So let me answer some very frequently asked questions that I get about this. First off, how long do companies stay in each stage? There's 6 stages on there. The honest answer is there's no set amount of time. Companies can stay in any stage, almost any stage, for a period of hours to decades. There are some biotechs, for example, that have been in stage 1, the research and development product market fit stage, for decades, and they're just taking in capital from shareholders and losing money. Coca-Cola has been in the phase 5, the capital return phase, for about 100 years. So companies can spend a very short amount of time in a stage, or they can stay in a stage for a very, very long time. Question number 2 is, can companies move backwards on the business growth cycle? And the answer there is absolutely yes, they can. Companies can move backwards accidentally or on purpose. Netflix, for example. Netflix, when it was purely a DVD by mail company, was in stage 5. It was in capital return. But management there chose purposely to move backwards to stage 2 as they shifted business models to be towards streaming business. So that was an intentional move from stage 5 to stage 2. And if you look at their financial statements, they reflected that change. The final question I get is, do all companies follow this pattern exactly? The answer there is no. There are some companies whose economics are so great that they are essentially in capital return phase right out of the gate. Some companies just immediately start generating revenue and profits for their investors on day one and are profitable. However, I think that most publicly traded companies do follow this, because companies that come public need outside capital from investors in order to fund their losses. So most publicly traded companies, but not all, follow this pattern at least loosely, but it is not a guarantee. There are different economics for all different businesses, and some companies have cyclical revenue, some companies have cyclical profits, but still the mental model, I think, is incredibly important if you're going to invest and buy individual stocks. Well, thank you all so much for your time today. I hope that this was helpful. The best place to connect with me, if you're interested in this kind of information, is on X or LinkedIn. On both, my name is just Brian Feroldi. Thank you.
Brian, thank you so much. First of all, you explain this stuff extremely well in a way that even a trader like me can understand. So thank you very much for that. And it's really fascinating to me how many parallels there are in terms of what you do with valuation and the cycles, and kind of how we interpret the longer term trend of a stock price too. Because we have something called the stage analysis cycle, which was developed by Stan Weinstein. And stage 2 is kind of the stage
uptrend?
2 to 3 uptrend, exactly. And then, you know, it goes through 4 different stages: uptrend, sideways, decline, just like that. And it's of course driven by the long-term revenue and profit changes, as you've shown. So it's very cool to see that. I have a ton of questions here to start with. I'd love to ask you if, and you've already touched on this a little bit, but how much the industry a company is in changes their trajectory throughout the cycle. You mentioned biotechs, of course, which can jump, but yeah, how does that come into play? Where there's, of course, more cyclical companies, there are more companies focused on hyper-growth software names. So how does that kind of come into play here?
Yep, there's no doubt. Some companies do not naturally follow the business growth cycle exactly. I mean, the chart that I had a pretty smooth revenue line and a pretty smooth profit line. In both cases, that's assuming that the company is probably in a consumer goods business, probably a retailer, probably a software or a tech company. But if you kind of map out the revenue of, say, a semiconductor manufacturer or a steel maker or an industrial company, you're going to get wild swings in the company's revenue. You're going to get their profits going from extremely profitable to unprofitable, to extremely profitable to unprofitable. So figuring out what stage those businesses are in is just much tougher. There are some companies that do that from a financial perspective, and just from a business model perspective, do not neatly fall into the business into the mental models that I think are very helpful. Financial companies do not, insurance companies do not, real estate companies do not, and biotechnology companies. Those are 4 industries that require a whole different level of analysis and thinking when analyzing their financial statements. But even if you're looking at companies in those phases, they might be more the exceptions than the rule. And I still think knowing the rule is incredibly important.
Yeah, for sure. And I'm also thinking about, you know, especially software companies and a few more of like the tech companies of the past 2 decades. They seem to be really focused on that hyper growth phase for longer almost. We know Amazon that, you know, just recently turned the switch on profitability, just kind of on purpose. The software names, which are growth at all costs. Is that a recent trend that you've noticed, that more companies are focused on, you know, staying in that phase 2 for as long as possible and just growing, taking market share?
Yeah, absolutely. So to be clear, over the last 30 years, with really the rise of venture capitalism as a thing, or maybe even 40 years, companies have had the option of following this pattern. You know, I remember reading the biography of Nike when it was founding, and essentially Nike had no way of generating outside capital. There was no VC market. The company would have to go to a bank and beg, borrow, and steal to get a loan of any kind. So effectively, phases 1 and phases 2, by the nature of the market, were closed off. Were not available at all. So companies were forced to start in phase 3 and were forced to think about profitability right from the get-go because there was no easy way to access outside capital. The rise of venture capitalists has really enabled companies for the first time to focus on phase 1 and phase 2, or at least easily access both private capital and public capital to do so. So these are relatively newer phenomenons. That's a similar story, by the way, for the price to earnings ratio. Forever, the price to earnings ratio was a great way to measure the value of businesses because businesses were immediately trying to optimize for profits. And the accounting actually made it so that the earnings was a useful number. This is why so many people have been trained price to earnings ratio is a useful number to look at. A lot of that goes right out the window with the developments that we've seen from accepting outside capital over the last 40 years.
No, that makes sense. Thank you. And I really liked in your presentation how you broke down different investors and different phases that they focus on. Personally, what phase do you like to operate in, or is it multiple phases, kind of a melange a little bit?
Yep. So my sweet spot is phase 4, the operating leverage phase. I like to find companies that have already crossed into profitability, that are not yet optimized for profits, but they have a very clear path over the next 3, 4, or 5 years to start focusing profitability. That concept of operating leverage of a company focusing on profitability confuses a ton of investors. Amazon, for example, has had a crazy price to earnings ratio for the last 20 years. How many times have you heard Amazon doesn't make money, right? Their price to earnings ratio is sky high. Amazon has been in phases 3 and phases 4 for the last 25 years. They've intentionally not made profits. As they've shifted towards, hey, let's actually make profits over the last 2 years, the price to earnings ratio has gradually become more useful. But I think there's opportunities for investors, especially long-term investors like me, to find companies in phase 4 and for them to most likely be misunderstood or mispriced because people don't understand the operating leverage phenomenon.
And I would imagine kind of knowing your domain that you like to operate best in, whether you're a hyper-growth investor versus you operating leverage investor, focusing on that, really learning the details of that style, that's an edge, right? In the market is staying true to one domain.
Yep. I don't care if you're a trade. I don't care what your investing style is. You could be a hyper trader, an options trader. You could be a long-term investor. You could be a dividend investor. Aswath Damodaran, the guy that I based the talk on, has probably one of the best quotes I've ever heard about investing. He says, the most important investor to study thoroughly is yourself. Yep. You really need to know what type of investor you are, what your goal is, what your strategy is, and importantly, what your strategy and goals are not. Because it's very easy to look at what other people are doing, seeing that being successful, and say, hey, I'm going to adopt that style for right now. And then the market changes, and then you say, hey, I'm going to try this other style over here. That's a recipe for disaster. It's really important that you define for yourself what you're looking for as an investor before you make any trades.
Yeah, 100% agree. And I would say, just thinking about, obviously I'm a trader, I've got a different time frame and everything, but I would say phases 2 and 3, the hypergrowth to self-funding, where a stock's just turning profitability, that's probably where I focus on most, because it often, just when they first announce profitability or give guidance that this year finally they're going to be profitable, that often starts really nice longer term stock trends that then I can ride bits and pieces of them. So it's really cool to see the different parallels. And that phase 3, like you said, depending on the company, it can be profitable, not profitable, not profitable. There's like a battle that happens. Is there anything when listening to an earnings call, conference call, beyond the numbers that helps you determine if a stock is transitioning from that hypergrowth to phase 3 self-funding?
Yep. So to me, the answer there is to look at the margins leading up to that. A company's you'll learn so much about a company's financials priorities by watching its margins, which is just simply take a profit number, revenue, gross profit, operating profit, net profit, and divide by revenue. You can learn a lot about where a business is heading by watching simply the recent trend of where its margins have been. If you see that the company has a net margin, a negative of negative 50%, the next year it's negative 35, the next year it's negative 15. Well, you can be pretty confident that the next few years is going to be -5, 0, +5, and the general trend is going to go higher as the company continues to scale. Some companies will also outright come and say it, and they'll say, our goal is to be EBITDA positive by 2026. Our goal is to generate GAAP profits by 2027. That's not something that every management team will do, but if you want to infer that, just simply watch their recent margin results.
Nice. That's helpful. And by the way, I love the Netflix example because they, of course, had that reinvention that you said where they're investing into streaming, but then they almost had a secondary investment into original content that drove another really nice move and expansion. And you mentioned, of course, 1 year in decline, and they kind of chose to go kind of take a step back and reinvest. But when in decline, buybacks are kind of they're a very bad sign. Would you prefer to see a company that's in phase 6 decline reinvest into R&D? Where would that capital be best used?
Yeah, so Warren Buffett has a great quote on this, and he says, when you find yourself in a chronically leaky boat, the best use of your effort is to attach yourself to a non-leaky boat. Effectively, what he says is, if a business is in stage 6 in a permanent state of decline, use that capital to buy or build another business. If you actually study Berkshire Hathaway, the actual business Berkshire Hathaway, this is exactly what Buffett did. Buffett bought a stage 6 textile manufacturer, Berkshire Hathaway. And he, for years, when he was running this thing, he actually fired the CEO and appointed himself to be the CEO. And when he was running the company, his employees were begging him to make capital expenditures in the business. They're like, we are uncompetitive because we're running old technology. Give us money. We will reinvest it and we will become more competitive. Buffett said no. He absolutely refused to spend money on capital expenditures because he knew that that was reinvesting in a stage 6 business, in a business that was fundamentally uncompetitive. He used the capital that the cash was throwing off to start to buy and build businesses that actually had a brighter future ahead, including putting that capital into the insurance business. And that's how he started to get into the insurance business. So he started with a stage 6 business, used the cash flow there to buy a stage 4 business. And that was the rock that built Berkshire Hathaway into what it's going to be. Now, there are some management teams that are skilled at taking companies that are in stage 6 and turning them back into stage 4, but that is exceedingly hard to do and exceedingly rare. So when you find a stage 6 business, the best thing you can do in most cases is sell, learn a lesson, admit defeat, and deploy it in something better.
Very cool. And I also want to ask you, do you position size any differently, whether you're looking at a phase 4 company versus a phase 2 company? Because there's probably a pretty different dynamic in terms of risk and potential in the different phases.
Absolutely. Yes. Yes, I do. I do not own individual shares in Microsoft, for example, but Microsoft is very clearly stage 5, growing, profitable, buying back stock, paying a rising dividend, just a monster of a company that is super clearly stage 5. So Microsoft is a very stable, mature, predictable business. If I was opening up a position in Microsoft, I would have no problem immediately making it a 5% position in my portfolio, simply because it's so predictable.
Right.
If I was buying a phase 2 company, or even worse, a phase company, if I was investing in QuantumScape, remember that company that had no revenue, I would only put the tiniest little portion of my portfolio into that, because the odds of that making it all the way to stage 5 are incredibly low. But on the off chance that it could get there, the returns that shareholders would generate along the way would be jaw-dropping, like 100-fold kind of returns. So the more risky the company, the less capital it gets. The more predictable, wide moat, big company, the more capital it gets. But again, that is my investing style. If you're the type of investor that invests exclusively in stage 1, you can allocate accordingly.
Yep, perfect. And also, I also want to take it back almost another layer beyond the business cycle to kind of the money supply and the economic cycle. Does that also impact things? Because obviously there's periods where money is more readily available. Maybe the hyper-growth names will benefit the most during that period versus, recently we've seen kind of a transition almost back towards the profitable companies and them trending well. What's kind of your interpretation of that, and you know, do you have any frameworks that go along with that?
Yeah, so the macro absolutely matters. Like, there's
Mhm.
no doubt that it matters significantly on a bunch of things. It controls stock prices, interest rates control stock prices. How easily money is flowing dictates how willing people are to invest in venture capital and how many companies can be funded that are in stages 1, 2, and 3. It also impacts general investor mood, psychology, and valuation. So the macro absolutely matters. But I am generally aware of what the macro is at any given time, but I don't let that dictate whether or not I make an investment or not. Peter Lynch has this great quote. He says, pretend that the Dow, Peter Lynch was investing from 1970 to 1990. And he says, pretend that the Dow was flat. Didn't move during this 20-year period, which would be a horrible result for the market. He's like, he's like, Johnson & Johnson would have still been a fabulous investment, right? General Electric would have still been a fabulous investment. The individual companies that took market share, that grew their revenue, that grew their profits, that progressed through stages 1 through 5, that returned capital to shareholders, those individual companies would have still been a fabulous investment, even though the general macro environment for those companies would have been horrible. 2000 to 2010 was a period when the entire market, S&P 500, essentially went sideways. It was like the lost decade. But if you bought Google when it IPO'd in 2004, you did awesome, right? You earned multiples on multiples of your money. If you bought Apple in 2000, you did awesome. You earned multiples and multiples on your money. So the macro does matter. There's no doubt that it matters. But if you focus on individual companies, what I do, the awesomeness of the company will transcend the macro environment.
Perfect. And I also want to just take a step back, and I know you're obviously a longer term investor, and I wanted to kind of ask you if you have any advice for people out there to take more of a, maybe not necessarily a long term investing mindset, but just a longer term mindset with their style and approaching the market in general. So any advice for people to make sure that they've got a decisive process, they improve it over time, they're taking feedback, iterating, and developing a process like you develop with investing, whether that's applying it to trading, swing trading, position trading, whatever their style may be.
Yep. So one just lesson that I think is worthwhile for everyone to do is to study yourself. Again, look at your own behavior and your own results. If you are trading, you are likely devoting a heck of a lot of effort and energy to studying short-term movements. You are probably spending a lot of time glued to your screen studying charts. Audit your results. Do your results exceed that of just investing blindly into the S&P 500, right? If the answer is yes, and you think that effort is worth it, have at it. But if you're underperforming blind buy and hold investing, it's time to be introspective about what you're doing. So many investors skip this phase. Audit your results and ask yourself, is the effort I'm putting in worth the results that I'm getting out? If it is, have at it. Do whatever you like. But if it's not, time to ask yourself some questions.
Great. And I also wanted to just say congratulations on your book as well. And if you want to, give a brief description of what it's about. First of all, as I mentioned, you explain this stuff in a really easy way for even like someone like me to understand. So I'd love, to hear more about your book and kind of what you cover in there.
Sure. So I've been investing in the stock market for 20 plus years. I've read every book about investing that I can get my hand on. The number one question I had about investing when I was starting was, why does the stock market go up? Why? Why is it that over the last 150 years, the stock market chart goes like this? What is the thing that causes it to defy gravity? And why do so many people have such confidence that we'll continue to defy gravity and continue going up? That question perplexed me, and I never found a good explanation that explained why that was. So I wrote this book here, Why Does the Stock Market Go Up?, to explain in super simple terms, it's at a 5th grade reading level, why the stock market has gone up and why you should have confidence that will continue going up.
Yeah, great. And one more time, would you like to mention where people can connect with you? We'll probably have your links down below in the chat and the description as well.
Sure. I'm on all the social media platforms. So if Twitter's your thing, follow me on Twitter. If you're on LinkedIn, follow me on LinkedIn. If video is your thing, I have a YouTube channel. So wherever you're on social media, you can find me.
Great. And just to cap it off, you've thrown a lot of great quotes at us today, but do you have any other kind of great quotes that you really, subscribe to and do a really good job of kind of defining your own personal style and your approach to the markets or life?
How
It's a
about
little out of
this?
focus.
Yeah, an investment in knowledge pays the best interest. Benjamin Franklin. No matter who you are, no matter what your style is, an investment in your own personal knowledge is something that always pays off.
There you go. So kudos to everybody watching this because you're doing that right now. So Brian, thank you so much for your time. Really appreciate it. Like I said before we hopped on live, there's a lot of traders at this conference. We want to make sure that we present different styles, different points of view, because there's some core principles that all the successful styles share and approaches share as well. So thank you very much for your time, and to everybody watching, hope you guys enjoyed. Make sure you leave a like down below, and we'll be right back with the next speaker. Cheers. All right, welcome back, everybody. It's my pleasure to introduce our next presenter, Stephen Goldstein. Stephen is an extremely experienced trader, starting in the mid-'80s and working at investment banks, including Credit Suisse, Commerce Bank, and American Express. He is also the author of the newly released Mastering the Mental Game of Trading, and has been working as a performance coach for institutional and retail clients since the 2010s. Stephen, welcome. Really great to have you here, and looking forward to diving into your presentation.
It's a pleasure to be on here with you.
Yeah, great. Yeah, and you'll be focusing on understanding minimizing the performance gap in trading. I've got plenty of questions, but let's run right into it, and I'm sure everybody watching is interested as well. As we go, please let us know if you have any questions in the chat, and we'll have a dedicated Q&A after the presentation. Yeah, I'll hand it over to you, Stephen.
Okay, so let's get going with this. So here's, as I think you gave me a good introduction there, so I probably don't need to repeat this slide. But perhaps I can start by just telling you a little bit about the book I had, which published earlier this year, and it's called Mastering the Mental Game of Trading. I have a copy of it here. It's my first book to date, and it introduces a number of I think, from what I gather, are quite revolutionary concepts and ideas, and it explores really both the internal challenge that we face as traders, whilst facing the external challenges with the markets, and the interplay between the two. So, of course, as we engage with markets, as we engage with the price action, as we engage with our system and our process, and we deal with the consequences of randomness and uncertainty and volatility. That creates lots of different feelings within us, triggers lots of emotions, triggers our ego, and then that often becomes a source of lots of problems as we start sort of deviating from our processes. So I'm going to explore that today, and that's what the purpose of the book is. And just interestingly, I was asked by someone just earlier today, why I wrote the book, what was the reason for it. And I guess, it goes back to when I started trading. My first trading experiences were in the mid-1980s. And I was employed by a bank, and then I moved up and I learned various different types of trading. And, the pressure moved onto me to start making money, as you do in any trading role. And I kind of felt that there was a lack back then of reading material about how you are as a trader. Okay, there were lots of technical books about technical analysis, about trading approaches, about different products, such as options and how to trade them and price them. There were a few books, sort of interview, biography books, but of course had the great Reminiscences of a Stock Operator, and the first Market Wizards book came out about that time. But there was nothing that I could really get on, what is this job? How do you do it? And that's what I always felt was missing. And, the idea of writing the book many years later, particularly after having worked with people on these challenges, was to plug what I still felt was a gap in that part of it. How could you actually understand what was going on inside you whilst doing this job? So that's really what the purpose of the book is all about. And I'm just going to go through on this presentation, introduce a few of the concepts and the ideas that have come up in the book, or that I've introduced in the book. The first of these is what I termed behavioral slippage. And I use this graphic in the book to demonstrate it, just to provide an example of where this came from. So since 2010, as Richard said, I've been working as a performance coach, working with traders from right across the spectrum of different trading types, trading roles, from individual retail traders through to institutional traders working in asset management firms, investment banks, and hedge funds, as well as prop trading firms. Now, one day, it was about 10 years ago, a portfolio manager came to me. He'd been working for a hedge fund for about 3 years. Prior to that, he'd had over a decade working at one of the world's leading investment banks where he'd been very successful. But when he went into the world of prop trading, which you do at a hedge fund, he was struggling. His performance wasn't great. As he put it to me, after 3 years there, his returns were mediocre. And he couldn't understand it because he thought he should have been performing a lot better. Now, one of the things this individual did, and this is where this idea, this concept really came clear for me, was that he would write down every single trading idea he had in the markets, how he thought the markets were going to play out, where he could make money, where a value opportunity was, whether he could go long, short, maybe a divergence or a convergence play. And he would write down how much money he thought he should contribute to that idea, how he thought it would play out, where he would add more money, where he would take his profit, or where he would leave a stop, or where he may even add a little bit more as part of a plan if it was going against him. And that great record, he said, look, I don't think I'm performing as well as I should have done. So I said to him, look, you've got a great record here of 3 years of performance of ideas. Why don't you sort of build that portfolio based on what you would have done had you followed those ideas and stuck to things, and just see if there's a difference between what you actually did and what you could have made. Now, he came back to me about a month later, having put that whole thing into a spreadsheet, and was shocked at the difference in performance. He average return would have been about 45% a year, whereas his actual return was close to about 3% a year. And the entire difference between those two is what this graphic represents. You have the potential performance line, which in his case was around 45%, and his actual performance line. This is probably a less exaggerated version of that, because the 45% line was probably unrealistic. You don't actually take every trade that you're going to come up with an idea with, and you don't do. But there was certainly a huge room to move his actual performance up. Even if we said that his potential performance was closer to 15 or 20%, then we knew that there was room to improve that performance. And the difference between those was behavioral slippage. It was mindset, it was mental, it was emotional. It was stuff that was getting in the way. In other words, the system, the method he had of finding value was excellent. His idea generation was excellent. Okay. His understanding of the market, the way he used his market intelligence to come up with ideas and find ideas, his analysis, his research, they were all excellent. What he couldn't do was translate them into P&L, or at least he could only translate them into subpar P&L. His monetizing of those ideas was what was letting him down, and that was behavioral. And this behavioral slippage is something that everyone has. Every human has it somewhere along the line. But of course, how far we are behind it is what matters. I think nearly every single system, every single way of trading has this. I think just about every system has the potential to make money. It's us that stops it happening, not the system. Of course, there's times where systems underperform. There's times where market conditions make performance difficult. Every single market approach or market system has those times and those periods. And if you were, this is actually a representation of some real numbers. If you look at the middle bit of this and assume this is 3 years, the middle part of this just goes sideways. So the system would have been, underperforming during that time, or just neutral. But overall, the drift is from bottom left to top right. So how do we do with that? How do we cope with that? I recognize this from my own trading years. My ability to find value for many years was very good. My ability to monetize them was subpar. So that's this concept of behavioral slippage. Now, the next concept, or another concept I introduced in the book, which is related to behavior slippage, is a poker analogy. And the poker analogy is to look at the system of trading, to look at what trading is. I like people to think of it as a giant game of poker. Okay. So think of it as you're sitting around the table with a group of poker players. Okay. So imagine you're part of a poker game, a 100-day tournament, 100 other people in the tournament. Okay. Each day is a separate day, a separate poker tournament to make up the 100. Now, everyone comes to this tournament with exactly the same money, the same capital. Everyone is about the same level. Some maybe a little bit higher, some a little bit lower. Everyone is using similar strategies. There's only so many strategies, right? But over time, right, the cards are dealt randomly. So over time, there should be a random distribution of who would win. But reality is that it's probably likely that the best players, there are better players in that game, will come out on top. And the lesser players will be the ones who come near the bottom of those 100. The better players will be the ones that come in the top 5. And that's because it's about how you play the game. And you play the game generally by playing your strategy, your system, but then avoiding going on tilt, avoiding behavioral slippage. That is the game. And the game is everyone else trying to get you to go on tilt. Okay. To get you to execute your system poorly, to get you to make dumb plays, to get you to go in on bets that you should never take. Okay. And not to stick to your process. And of course, you allow that to happen. So this is the challenge of trading. This is why it's so similar to poker. Everyone has the ability to succeed. Only a few can win. Okay. And this is the game. If you can execute your system without going on tilt, the chances are you'll follow your process and you'll be more likely to be a winner. So that's the poker analogy. Now, of course, you're not playing against people around a table, but the market is your opponent. The market is always trying to get you to go on tilt. It wants you to make the mistakes that you make. It needs you to make the mistakes that you make. The other players on the poker table, they need you to make the mistakes because your money becomes theirs. They win and they share those proceeds between them. And you're part of that as well. You're trying to do that to everyone else. So your job is to try and execute your system and avoid going on tilt. The market needs you to behave suboptimally for it to win. That's another one of the concepts in the book. So now for you, it's about fighting back. And that helps, that starts with gaining a better understanding of what you are up against. And you're, of course, up against two opponents. You're up against the external opponent, the other players in the market. They are the market. The market is collectively everyone else, including you. Okay? So there's a challenge from that sense. The other opponent is yourself. You're up against yourself. Okay? And this is the bit that you need to work on. Okay? Because you've got a process or you've got a system that actually should enable you to beat the market and to succeed in it. Therefore, the behavioral slippage comes from within you. Okay, so if we go back to this trader, the one I mentioned at the very beginning, the client from the hedge fund, okay, he had the system there. It wasn't a system as such, it was a process. Okay, he understood the market. He knew how to find value. He knew how to find good trades. He knew what they were. But it was him that was limiting himself. So he was up against himself. It's a little bit like this. The battle is between yourself and a part of yourself that actually makes you think you can beat this. And that is your ego. Okay? So that is the internal enemy. Collectively, we call it the ego. It's lots of different parts of us that come together in what we term the ego. So what is the ego? What is your ego? Now, I talk about that at length in this book. I kind of want you to think of the ego metaphorically as a kind of psychological organism. Like your heart is an organ, your stomach's an organ, okay, your liver's an organ. They all play a different role within you. They have a good role, but when they misfunction, it affects you and becomes a threat to you. Think of the ego as a psychological version of that. Okay, it actually has a purpose. I'm not going to go into the in depth in it at the moment. Okay, and it has a positive, good purpose. It's there to benefit you. Okay, and it's there with you all the time. Like these other organs, you can't get rid of them. You can't function without them. Okay, its intention is good. It's there to protect you, but often it'll sabotage you because we don't have a good relationship with it, and it isn't used to the world for trading. We have to remember we didn't evolve for this world. We evolved for a different world, a world where we're part of groups, where we're a social world. Okay? The ego did not evolve for the game we're playing. Therefore, we have to learn to play the game whilst acknowledging how the ego is and how it functions and the damage it can do. Now, in the book, I introduce what's called the performance process cycle. So again, if you look at the front cover of the book, you can see this on there. Okay. This isn't something I just invented. It's an adaptation of a framework used in a particular form of psychotherapy, which I studied when I was studying to become a coach. And I don't use it in a psychotherapeutical sense because I'm not a psychotherapist. I'm there to take people forward in their work with risk, engaging with risk. But this framework is there to help you understand yourself, how you are, and what's happening with every single task you engage in with trading, when you're engaging with a trade, when you're navigating your journey through the markets. I'm just going to introduce a few basic concepts from it. Okay. If we just take the thick black circle, that black circle represents a boundary between you and your inner world, your internal world, okay, and your external world, your external system, the external market, and your wider external world as well. You know, your family, your friends, other people, maybe the people in your organization. Now, you are constantly in engagement with that, and that happens at this boundary line where the circle is, okay? So you're playing the outer game, we call it the outer game against the external world, against the markets, whilst playing the inner game against yourself, okay? And the mediation between the two, where those two meet, that's the process system, okay? That's where you play your mental game. That's where you mediate between the two. As you engage with the market, there's this constant exchange of information. So you're looking at price action, you're looking at news, you're looking at other people's ideas, and they're coming into you and they're changing you. And you're reacting to that, and you're using that to decide what you're going to do next in your engagement with the market. And as you engage with the market, you're doing the same as many other people who might also react in the same way, and that changes the market, which again, it becomes this kind of reflexive system that's going on all the time. You are changing, the market is changing. It's a constant process happening at all points. So here we have the model. Now I've added on these extra bits, the cycle, which is a circle moving clockwise, okay, with 4 different elements to it. And those 4 elements, the start, reset, the trigger, they represent 4 different quadrants of this cycle. Okay, the first quadrant being the being phase. This is about how you are. You haven't actually come to do anything there, but this represents how you are as you engage with this job, how you sense the market, how you do your analysis, how you gather your intelligence. It's about being optimal in that point, trying to be unbiased, trying to be balanced, trying to be curious, trying not to hold opinions which could be distracting and destructive. Okay, you try to exercise what we call detached curiosity without a bias one way or the other, not holding a view. So you can see things as objectively as possible. Okay, that's an incredibly hard state to be in. But the closer you get to that state, the much more likely you are to go around this cycle effectively. Okay, then a trigger event happens. That happens at the 9 o'clock position. Okay, that means something has piqued you, something has got your attention. Something demands you to actually go in and look more closely. And now you start doing what's sense making sense of all that intelligence you've been gathering, all that research. That is where the trade idea comes from. Okay. Making sense of what you've seen. Maybe it's just a news story. You've watched the reaction of the market. You thought it should have gone higher. And you're like, okay, I'm selling this because it can't go up on that positive news story. I'm getting short. Now that's an idea. It hasn't actually happened yet. You've generated the idea. Now you construct a plan for the trade. You might have a very simple plan. You might want to spend a bit of time thinking about it, where you're going to get in, where you're going to get out. You know what you're going to do on a certain scenario. What happens if new information comes out and changes that? You want to be strategizing it and planning it. That takes you to the 12 o'clock position, which is where you act. This is where you actually engage with risk. This takes us into the performance phase. You've produced the trade. Now you've got to perform it. This is where you are actually at risk in this third phase. Okay. And whatever happens here, you get to an outcome. And you might even be thinking about that outcome at the very moment you act, which is often distorting because the outcome should follow. But if you bring it forward, you often get into trouble. And I'll show you why in a minute. Then we get the final phase, the letting go phase. Now, this is where the game is won. It's that simple. The very best traders are masters at letting go. Okay. And not letting whatever that outcome was distract them. And staying focused on the game so they can reset and then get back to the being phase. As I said, in the being phase, you have to be optimal for what's about to happen. As you go through the top part, the production phase and the performance phase, your mental capital depletes. Okay. You become angry, you become frustrated, you become emotional. It's this letting go phase that gets you back to balance, back to the being phase. I overlay this red circle, we call it the emotional donut, over the cycle, because this shows what happens as we get towards the act. As we go through the production phase, we start to feel more emotional about what's happening. We have risk on. You can't have risk on and not be emotional. It impacts you, it affects you. That individual hasn't been born. They'd have to be a robot for that to happen. Okay, so it's at its peak as you go through the performance phase. And as you see, the letting go phase is about what gets you back to balance, away from that emotional stage, back to that balance stage, balance setup that you can see in the first being phase, where you see things objectively. Okay, now, I want to show you that that's called an optimal performance cycle, optimal performance process cycle. I want to show you a suboptimal performance cycle, what we also call the death spiral. Okay. Now, what happens is if you don't get the outcome you want, or even if you anticipate a suboptimal outcome, is this. Instead of letting go, instead of going back to reset, we rush straight back into the act. We don't think about the trade, we don't process it, become emotional, and we do it again. So in that example I said before, maybe the market, we thought, it shouldn't have gone up, it should have gone up on that, it's not, I'm going to go short. So you go short, market jumps up a little bit, you panic, you get nervous, you think your outcome's negative, you don't let it get to the stop or anticipate the stop, you rush in and close it out. Then it comes down, it doesn't go through your stop. Now you rush back in and do it again. But you shouldn't have actually, you're now off plan. You haven't let go the previous one, you haven't got back to being, you've rushed straight back in and you do it again. Now you're doing it without being optimal. Okay. And this is where you start to become owned by the market, rather like you become owned by the other players at the poker table. And you start rushing back in again and short circuiting the cycle. And you do that again. And so on and so on. And now you're on tilt. You're in the trader's death spiral. You're not leaving that emotional zone. You're stuck in there. And this is where you become owned. Okay. And we call it, obviously being on tilt is the term you'd be used to. We talk about two types of tilt, soft tilt and hard tilt. Hard tilt is the preferred one because you realize I've been an idiot, I let go. Well, quite easy, maybe you don't trade the rest of the day, maybe you have a day off, whatever. Soft tilt happens over time and you don't even see yourself going into that. That's the part far more pervasive and dangerous version of tilt. And that's where you start to lose the plot a little bit. But that is the concept of the suboptimal performance process cycle. The only way out of any death spiral or any suboptimal cycle is letting go. That gets you back on the optimal cycle. And that's why we call the letting go phase the super skill phase. That's why the very best traders are masters of this. They don't not go on tilt. They go on tilt like anyone else. They do daft things like anyone else. They misread markets sometimes. They panic. They become gripped with fear. They become emotional. Sometimes their ego will get the better of them. But what we see time and time again is their ability to just let go, snap out of it, reset, and get back into trading without blowing up. So letting go is where the game is won. Letting go is what keeps them present to the cycle. I talk often about these different things in the program. Great performers stay present. I love to quote this quote from The Last Dance, where sports writer Mark Vanciel said, Michael Jordan's gift was not that he could jump high, run fast, shoot a basketball. His gift was that he was completely present. And that was a separator. He didn't allow what he couldn't control to get inside his head. He would say, why would I think about missing a shot I haven't taken yet? He could be in the being phase, optimal, balanced, not affected, ready to go every single time. And he could let go just like that, because letting go is what gets you back to being present. And that was his super. You think about it, that was what distinguished him from all the other basketball players around. That's what made him great. And when you look at great performers, great athletes, great sports people, great leaders, they all display this same incredible ability. So I'm going to just sum up the key points from the presentation. We talked about behavioral slippage, that gap between what you could achieve and what you do achieve. The poker analogy, how the markets need you to go on tilt, how they want you to go on tilt, how subconsciously they're always trying to put you on tilt. How that comes around because of the battle between yourself and your ego. I introduced the performance process cycle, the core model from the book. I introduced the trader's death spiral, which shows us using the performance process cycle, how we go into these suboptimal cycles so easily. I then talked about letting go as a superpower of great traders. And what that does is it keeps you present. And you need to be present at all times in this really challenging job. Now, I want to show you one of my favorite quotes from the market, and this came from Market Wizards. It was said by the trader Victor Sperandio, also known as Trader Vic back in the day. The key to trading success is emotional discipline. If intelligence were the key, there would be a lot more people making money. This book is about emotional discipline. What I've been talking about is about emotional discipline. That's the end of my presentation. You can see a lot more about me on here, my email connections, my websites. I co-host a podcast with my colleague Mark Randall. We've done over 130 episodes so far. We have traders on there, psychologists, coaches, authors, a very large spectrum. I know you've got a few people coming up on TraderLion over the next few days. They've been guests. I always ask people to check out some of the interviews we've done with some of the people that you'll be having on here on the next few days. In particular, the Jason Shapiro interviews always go down very well. And that's it. That's the end of my presentation. And there is the book if you want to find out how to get it. It's in Audible, it's in paperback, it's on Kindle. I spent a lot of time writing it, so I do highly recommend it.
Perfect.
If you want to advance your own trading.
Yeah, well, thank you so much, Stephen, for walking us through that. I definitely have a lot of questions that I want to ask you based on what you discuss. But first things first, to add a little bit more context to both the presentation as well as the book, could you walk us through a little bit more about your background? What were the type of instruments you were trading? What strategies were you employing? And then how did you make that transition to a performance coach? And what was that process kind of like? I think that might be helpful for everybody.
Okay, so if I go back to the mid 1980s, the kind of 1980s were a period where the markets opened up, and it was a time of a lot of creativity, a lot of new instruments, interest rate derivatives, options, futures, swaps. Banks started expanding their trading rooms. I was a young guy in London at the time, had a lot more hair than that, and it was the right color. And I found myself working at a Japanese bank in London. I didn't know what the hell I was doing, but it seemed exciting. It seemed everyone else was doing it, and they wanted young people who were willing to just sort of, I don't know, we weren't particularly well trained or didn't know what we were doing, but we were just sort of having a go was the way we describe it back in those days. I found myself on the rates desk. I didn't know how to make money doing it. I discovered that there was these opportunities to make money doing what we called arbitrage, which is where you could go long and short of different instruments at the same time, that you could create synthetic versions of them, and that there was money on the table if you could do that with what seemed to be low risk. It wasn't low risk, but it certainly felt like it was, and you could put on a lot of size and make a lot of money with it. And I did that in my early years, and I did that at this Japanese bank. I then moved on to the Swiss bank, Credit Suisse, in the early 90s, which was a great trading environment, very active, very big trading business. And I was doing it there, but the arbitrage opportunities were disappearing. The market was getting tighter, and it wasn't. I wasn't enjoying it. And then one day I found out that that the free money isn't as free as you think. There's a thing called basis, which every now and then will collapse, and you find yourself in a huge loss. And that was a bit of a wake up call. And I decided I'd rather directionally trade. So I started trading in the interest rate and FX markets, started trading directionally, taking risk. And I found myself surprisingly very good at it. I'd read Market Wizards sort of voraciously to try and get some sense of what I'm doing. I still didn't know what I was doing. And after a couple of years of good performance, they moved me to this prop desk at Credit Suisse that they started. Not the big credit desk that was upstairs, where we had an amazing team that became the foundation of the Brevin Howard hedge fund, but on a desk in the business that we were part of. And that didn't go so well. For what, I won't go into the ins and outs of why, but that lasted a couple of years, and then I moved on. And I moved to a German bank, Commerzbank, still trading the same sort of style that I was doing, or a mixture of different styles, a mixture of the arbitrage and directional. But I kind of lost my way a little bit there. I lost my mojo. There was a lot of political challenges there. That happens in organizations, and that can dent your enthusiasm a little bit. And after 14 years, I found myself sort of struggling. I got fortunate that I got put into an experimental coaching program that they were running. And they asked me to join that. Being a trader with an ego, I kind of like sort of pushed back on it. I don't need coaching. But actually, it was the best thing that I ever had. It was brilliant. I worked with this amazing performance coach now, who's a colleague of mine as well, and a friend, and he actually wrote the foreword to the book. And that experience, just sort of exploring me, that's where a lot of the foundational stuff that became this book really started from. I always thought the answers were out there, that there were secrets, there was ways you could find the market, you could find the answers. But actually, I started to find out that the answers were in here, and you had to work on that. And I came out of that process, and for the next 10 years, I traded better than I'd ever traded. Directional trading again in rates markets, bond market, bond and bond futures, foreign exchange, taking a lot more risk. It wasn't any less stressful. It was more stressful, if anything. This job is never not stressful. And the more risk you take, the more you engage with uncertainty, the more you're engaging with that stress. But I was able to ride it much better. I was able to sort of support myself through it much better. And therefore I was able to make more money, and I would say I was less going on tilt, more being present to the job. And, I had 10 great years, and was consistent. I surprised myself. This is what I always thought I could be good at this, and I'd sort of sustainably, and I was. And I moved on to the banking arm of American Express a couple of years later, and things were great there, and I had a lot of fun. Now in 2010, I found myself at a crossroads. American Express had sold the bank to another bank during the financial crisis. They didn't really want prop trading going on in their London office. So I found myself looking for a new job. I was talking about going to a hedge fund. I had some offers on the table that I really didn't want. And I went back to my old coach, Peter, and I had a discussion about, what direction I should go in terms of being a trader next. And he sort of planted the idea in my head of becoming a coach. And, I just fell in love with that idea. I thought I could carry on trading for myself whilst coaching. Okay, I didn't need to work for anyone. I thought that's what I'd do. And I decided that was the direction I was going to go. And as it so happened that the coaching, I found it very difficult to do both. And I decided that actually I'm going to go in the direction of coaching. I'm really enjoying this. I'm really enjoying working with people. I love the idea of helping people. That had my curiosity, and that became my direction. I still trade a little bit. I still do trade a little bit, but I call it my sort of fun hobby account. It's just a small PA account on the side. It's secondary. I might put on one position a month. I'm running one position right now. But that's not my job. That's not my income anymore. This is what I do. This is what I love doing. And I love helping people. I don't just trade traders. I work with managers and leaders. I work with teams. I work with whole businesses, sometimes coaching them. And then always in the trading space. But it's something I love doing. So that's where I am now.
Yeah, excellent. And I wanted to ask you, when you first meet with a client and are starting the process and starting to build that relationship, what are the first few meetings like? What exercises do you go through with them to try to, identify what goals you both have, and also, where to work on the weaknesses and hopefully work towards improving that behavioral slippage and of course, help their performance?
Yeah, well, it's really interesting because they've already reached out to me. They want to get better. There's
And that's important.
It's important. I ask them, what made you press that email? What made you hit send? Usually it's an email. So, what was it that inspired you to do that? And, they're not expecting that question. So I need to know what their why is, and as I said, what is your vision as well? What is it that you want to see? What does better look like? You obviously believe you can get better. Not everyone is struggling. I work with some individuals who are making, working at hedge funds. They're making over $100 million. They actually want to get better, or they want to be able to do it without being so consumed by it,
right? Or
they want to be sustainable at it, or they want to build a team. They can do it on their own. They need a team of analysts, and so there is so many different angles to it. But it's I often tell people not to look at it as that you're failing at something. It's because you want to succeed at something. I often, we got Wimbledon on this year. Okay, we got the Euros on. Every single one of those sports people who's at the top of their game is having coaching the whole time. They want to get better and they want to stay elite. So there's a fair degree of people that will come with me with that. I'm at the top of my game. I want to stay here. I want to get better. I've got one client who's been at the top of his game for 30 years and he still wants to get better. He still every now and then screws up. He still does things that mess up. Now, last year he just had his best ever year in 30 years. So everyone has areas that they can be wrinkled out somewhere along the line. So that early coaching, I would do some psychometric profiles with them. I'll ask them to complete a questionnaire before we start. And then, it depends on the level of coaching we're doing, but I may do interviews with colleagues or managers or even wives or husbands to try and understand that person through a neutral lens rather than, an objective lens. So I'm getting a picture. And through the coaching, we explore their trading, what they do, how they do it. how they engage with markets, how they engage with risks. I'll use my frameworks. I'll bring them out. We'll introduce, I'll ask them to tell me, trades they put on that they'd like to sort of just pull apart and unpick so we can understand what was happening against those frameworks. Okay, and we'll explore the system. What's their understanding of the wider system they're in? I often say it's like our time together. It's like we're looking at them under a microscope. We're putting them under that microscope. We're putting them as an individual. We're putting their trading. We're putting how they engage with markets. We're putting their philosophy of markets, of risk. We're doing that together. We're building it up through our conversations. Okay, it's not me telling them how to be better. They've already got it in them. That individual who came to me, he already knew. He already had the system. It's just how can we get him closer to it? How can we reduce his behavioral slippage? So as we explore that together, and as we explore his trades, he starts to self-fix or she starts to self-fix. I work with a lot of female traders as well, some incredible ones. They start to fix, okay? I don't have the answers to what they need, okay? I've not given someone the answer to make them a better trader, although they'll often come back to me and say, yeah, it's great you gave me that tip. And I said, well, actually, we spoke about it. I didn't give you that tip. It came out of our conversation. Okay. That's what we do over our time together. And, that's what helps people grow. Most people have the answers within them. Sometimes we've just got to help them pull them out. And that's what, for me, that's what great coaching is.
Yeah, excellent. And you mentioned some questionnaires that you have them fill out. What are some of the most helpful questions for you to ask them, or maybe really it's what's most helpful for them to ask themselves?
Yeah, well, do you know what I've got one here. I'm not going to share it with you, but I'll just tell you what some of the questions are that's on there. And I don't ask them a lot of questions. I just ask them to fill out one sentence, first thing that comes, on their mind. So I'll ask them, starting with the end in mind, if coaching was going to have what you would judge as a successful outcome, what might that outcome feel like to you? Not look like, but feel like. So I want some color. I want them to describe it. Then I'll ask them again, what is the purpose of this coaching for them? Okay. How do they want to be at the end of this compared to how they are now? Okay. What do they consider the most difficult challenge within their work? I'll ask them a question about, in the book, there's another framework which I didn't explain in this time, but it looks at the trading system. And I asked them a question which brings up for me, the trading system looks at trading as actually one of two different types. All trading is either one type or the other. And I discussed that in the book. And depending which one you do, you have to be using the right behaviors and philosophy and risk approach and attitude that aligns with that approach. So I'll ask them a question that reveals to me what their philosophy is. And then I'll find out from that if they're using the right philosophy for the right approach. And if they're not, often that becomes a great source of tension for them and becomes one of the reasons why they're struggling. So there's lots of questions, I'll put in there. Where does your edge come from? What do you feel your personal edge is? What's a source of tension and anxiety for you? So we go through this, and that reveals a lot. But then we go a lot deeper when we're doing coaching.
Yeah, perfect. And one thing I wanted to circle back on, I really enjoyed the poker analogy, and you mentioned a lot in there that the market's trying to make you make mistakes, or the other participants are trying to make you make mistakes. And when you were saying that, it kind of reminded me. I played baseball up until the varsity level in high school, and a lot of what our coach would focus on in terms of improvement is just making less mistakes. He called them free bases, walks, errors, things that were within our control, but we gave up a free base. We let people get on first base, second base, whatever, stolen bases. He would have us track those and focus on those specifically to minimize them and have a goal in mind of, hey, we're trying to give up less than 8 free bases today. And just trying to focus on making less mistakes led us to win games and push us over the edge and all of that. So I really enjoyed that discussion of the poker analogy. I don't know if you had any color to add there, but I think it's a really good way to think about and Jared Tendler, who I'm not sure if you're
Yeah.
familiar with him, but he focuses on improving your C game, and it's a similar vein of just trying to improve your worst case scenario, just try to be a little bit better and improve over time. And I think it's a really important point when it comes to trading and in any performance endeavor.
Yeah. No, look, Jared's a great coach. He wrote a great book. He was a guest on our podcast once.
Yeah.
Got a very similar title for the book. That was just an unfortunate coincidence. I know his one came out first, but this was a title which we'd already had working as a perspective title.
Mm-hmm.
It's a brilliant book, and you know what? There's different types of coaches, different types of roles. You look at great sports people; they have multiple coaches. I don't go into the technical bits. I'm working on the trader themselves.
Mm-hmm.
Other coaches, engage very much on the technical aspect. How can you get rid of those mistakes? That's not something I would do. That's not where I go. I'm looking probably at how you are as a being and what your being is like. But yeah, 100%. And, sometimes out of that does come those, I'm making daft errors all the time. I'm over trading, for a lot of people, I get them to realize that they don't need to sit at their desk for 10 hours a day trading. In fact, you and I talk about it in the book, your mental capacity to trade, your mental aptitude goes down, it depletes as the day goes on. Okay, and I show some interesting research in there about that. Generally, especially if you're a day trader, it's less of a problem if you're not a day trader. But as a day trader, you're going to be your most powerful in the first 3-4 hours of the day.
Mm-hmm.
After that, you're going to progressively become your enemy. After about 6 or 7 hours, you are your enemy. Okay, if you was to analyze your trading by time of day, it's highly likely that your afternoon trades cost you money. I had one client who used to stop trading at 1 o'clock in the afternoon. He wouldn't take any trades after that. Even if his system or his method identified a great setup, he wouldn't do it because it's either all or nothing, and he would run no overnight risk. Okay, but in those first 6 hours of the day, 5 hours of the day trading, he was a demon.
Mm-hmm.
I know other people that trade the first 15 minutes of the day. I know people who trade the pre-open. Okay, they are amazing traders. They choose their time of day where they want to trade. I was most deadly to myself, even as a non-day trader, trading into the evening. My biggest losses came when I tried to trade. Like for us, the Fed meetings always happen about 7 o'clock, 7:15
Right.
at night. So by then I'd been 12 hours at my desk, and I was a disaster trading at that time of night. Okay, my biggest loss happened trading that time of night. You are suboptimal. It's almost like, I don't know if you're familiar with online poker.
Mm-hmm.
There's these people who love to pick off people who go on just when everyone else is coming home from the pub, they've had a few drinks, they start playing, okay, and they're fresh and they haven't played all day and they're waiting for those people to come online, a little bit of alcohol in them, tired, been up all day, and it's just easy money. You pick off those people. That's what it's like in trading. It's the same thing.
Yeah, that awareness of when you're not going to perform at your peak. That's really important.
Yeah.
I love that. Yeah.
Yeah, I used to play online poker just for a bit of fun, again, not serious.
Yeah.
And I had this curve that would always go like that. I'd get bored with 1 or 2 tables, so I'd open up more tables to keep the excitement going. And my P&L would go up. Eventually, at some point with 6 tables after a few hours, I would give it all back on one mistake.
Yep.
One thing that I didn't see happening. Okay. And that's an example of that. That's what happens all too often. So if you become more aware of yourself in those moments, and also other things like, have you got distractions going on outside of work? Are you not sleeping well? If you're drinking too much or taking substances too much, a lot of people have these rings now, Oura rings, just sort of maintaining their readiness for the day. Things like that. Just can you get yourself in an optimal state, as well as get your trading optimal, the Jared Tendler stuff, go to the minutiae of what you're doing. There's a lot more to it than that. There's multiple different elements of coaching. There's a Steve Ward element, he's very much focused on get your mind right in the moment. That's again different to my sort of coaching, which is probably more holistic. I know people who've got 3 or 4 coaches, believe it or not, at the top level for all different parts of their game, including a psychotherapist as well. Normally, these are big hitters. They're, the more you can get, if you think of it as a performance activity, I like to think of trading is a performance activity. In the world of high performance, artists, singers, actors, they work with mentors, they work with coaches, they work with people giving them feedback. They explore their activities on video, getting feedback, analyzing it. Okay. A lot of the best traders I know, they do that.
Yep.
They look back at their performance, keep journals, keep a journal. I talk about that in the power of journaling. It's one of the greatest free things ever. So yeah.
That was actually going to be my next question about journaling. So it's interesting you bring that up. It seemed like it was incredibly helpful for the trader you mentioned who, identified basically the disconnect between his thoughts, his awareness, potential trades with his actual execution. What are a few guidelines for people watching about journaling? What can they do to make it more effective and help them spot, where they're going wrong and where they need to focus on improving, different weaknesses that they have?
Yeah, well, I would make it almost like a religious activity. It's something you should be doing every day, or at least every week. Okay, I used to do it. I used to write in you can't even see them there behind me. There's a whole stack of old A4 binders. I used to write in that. You've got these incredible electronic tools as well, so you can go into a lot more data about you. But I used to review them. I didn't just write in them. Okay, and I wouldn't write a lot in them. I like the idea of doing it lightly. Okay, otherwise it becomes so
A chore,
boring,
yeah.
mind-numbingly. You don't want to make it a chore. Okay, so you can write a few points about what you do, maybe track a few trades. One of the biggest moments for me in my career was when I decided during a quiet period to look back over some old journals, from a couple of years earlier. And I noticed some trades that I'd done. And then I noticed that I hadn't followed up on them. And I was pretty sure that on one occasion, the view I'd written, the idea that I'd written down, had worked out really well. So I couldn't understand why it wasn't mentioned over the next few days. So I then pulled up my blotter, looking at the trading, what I did. And I could see that I'd not followed my plan at all. I'd not executed what I said I was going to do. I'd moved my stop. I'd moved the entry. The plan I had for the market, the trade, worked out brilliantly. It was to buy. The market was too high at the open for me, but I thought if it could come down during the day, there was a decent buy level. There would be a stop a little bit lower. I would get long then, and then for me, it was going to take off and run over the next few days or couple of weeks. That's exactly what happened. The levels were absolutely exceptional. I traded it horrendously. I actually lost money on the trade. Okay, I tried to get cute, but the market came down quite rapidly in the afternoon. I suddenly panicked. This isn't going to happen. Let's take the bid out, and then move the bid lower and move the stop lower, so maybe I can get the bid at a lower level. And it never got to it, and then it took off and it went up, and now I'm not on board, and I could see myself chasing it, buying it just as the market came down, and now I'm in the spiral and I'm losing money on this trade. So I thought I'm going to buy some more, and then it comes lower again, and I panic out, and then it goes up, and got in a complete mess with this trade. And I saw that in the journal, and I thought that's crazy. And this was in a really good period of trading overall. So you particularly look at the good periods and the bad periods, because you're sucking in the good periods as well. You're leaving money on the table, okay, in the good periods. And I thought, have I done that anywhere else? And I started going through the journal, and I noticed that I'd done that almost on a weekly basis. I was doing something similar. And I was thinking, this was a really good year where I made a lot of money. So exactly I must have left an awful lot more money on the table because I was being an idiot. And if you think about it, we have good periods and we have bad periods. We have periods where the market is generous and is giving, and other periods where the market is just not doing anything. It's not trending, or it's just stuck in a sideways. Or if you like to trade a sideways bit, it might be when it's trending that you're struggling.
Right.
We are going to have those poor periods. If we're giving away money in those poor periods, okay, right, because we're doing that, and in the good periods, we need to optimize it. We need to be making the most so that if we go through those periods, we can survive. Because trading doesn't go in a straight line, as we know. Okay. So if you're leaving money on the table in good periods, it's going to hit you even more in a bad period. Okay. Yeah. And it's going to have an even harder effect. And that's what the great thing about journals are. They're like taking a bit of a microscope of your trade. It's like a video. You talk about a baseball player.
Yep.
Yep. If you can watch your hitting action or your pitching action on those videos close up and examine it with someone, okay, you've got the opportunity to get better. You've got the opportunity to eliminate mistakes that you didn't even realize in the moment that you were doing. That's what golf pros do. They analyze their swing, or tennis players, they analyze their backhand or their feet position or something. That's the equivalent of what journaling is.
And do you have some favorite questions that you like to ask yourself in the moment? I know you mentioned that you don't want to make it too long, so it becomes, this laborious thing. But are there a few things that you think are really important for traders to track and keep track of while they're journaling?
It's not so much whilst I'm journaling, but when I took a trade, we all have lots of biases, lots of behavioral biases going on all the time. One that I was particularly subject to, which a lot of people are, is confirmation bias. Mm-hmm. It's falling in love with an idea and then looking for confirmation which validates the idea. I'd noticed that I was very prone to that. So I readjusted my trading process so that whenever I had a trade idea come up, I would try and destroy it. I would try and tip it upside down. I would try and, where's that not going to work? Where am I wrong? What is the possibilities? So it was almost trying to disconfirm every single trade. And that would really help me. It would sort of help me think a little bit about the idea more when I put it on. It would filter out quite a few trades. It would make the trade more robust at entry. So my stop would be better. My sizing would be better. Sometimes the reason I'd ask, why could this go wrong? Here's the idea. It should make X. Mm-hmm. Okay. I mean, I would start with how much can it lose as a starting point, but then, if it works out well, I can make X. What's going to stop that happening if it works out right? That was the question I would ask myself. One of them would be confirmation bias. One would be getting my sizing wrong. People always talk about oversizing. Undersizing is a massive problem as well.
Yeah. That's
due to leaving money on the table. That's you getting that great hand and playing it all wrong and not putting enough on it. Okay. Taking risk is a real performance activity. So it's making sure, and asking yourself those questions. Am I right today? That's another one. That's at the start of the day. Trying to step back. When you get locked in that spiral, okay, if you don't see yourself in there, okay, so sometimes just stepping away and then going, what's going on? Again, that is what some of the very best traders I work with do. That ability to let go is that ability to almost separate themselves from what they're doing and see themselves and then go, okay, I've got to get back to presence. And at the moment, this is not happening. And sometimes they'll just close it down, or they might just keep it running, but they're going to walk away for the rest of the day, leave levels in there. So it's becoming really acutely aware of yourself as well as you're doing this job. And that's how you end up mastering the mental game of trading.
There you go. And I really loved I didn't love the death spiral concept, but I think it's really important because it's so true. And I really liked how you mentioned that the best traders, they're just able to let go and move on with their day, move on to the next trade. Are there any specific things that traders can do when to help them identify when they're locked in that trading death spiral to break away? or is it just more of a function of, you know, journaling, as you mentioned, just being more introspective? But is there any specific exercises that you have clients do to help identify when they're in that vicious cycle?
In a way, it's about getting the foundation right.
Mm-hmm.
The more you get the foundation right, the more you get your being state right, the more able you are to be able to see it. Okay, so yes, you can do things when you're in it, but you know, it's like all these sticky notes you put on your screen. You know, you stop to see them after a while when you're caught in the trade.
Mm-hmm.
Now they start to become invisible. So if you think, what can I do when I'm in there? The problem is that when you're in there, you don't see it. Okay, but if you change your way of being, you know, if you go, okay, I don't know, you're gonna put in a routine. You're gonna put in journaling, for example.
Mm-hmm.
When you write it out, you're like, yeah, I did. On a daily basis, you can see yourself because the spiral lasts weeks, you know, even months sometimes. And you know, one of my worst trades, which became one of my best trades, was me caught in that spiral for a week and not seeing it. And when I decided to start writing out my journal, when I wrote 3 pages of stuff, suddenly I had this clarity and I saw it. And then I suddenly saw, you know, not only are you in the spiral, but actually you're missing a great trade. It's still on and you're
Right.
not seeing it. So it brings you back to that clarity, that reset, that, you know, and then it's like, okay, production, go to the production bit. How am I going to put this on? It's still there. Now find a way to get this on. What could go wrong? That was just before the entry, thinking that what could go wrong. If this trade is still on, I want to make X. What could go wrong? What's going to stop me? One of them, because I could have my stop too tight on this one. Okay, let's work out a good level. There wasn't an obvious level. Maybe my size is too big. You know, maybe my size is too small. What's the optimum I want to get? It's not going to stop me out. It's not going to cause me to panic, and it's going to keep me in the trade and keep it. It's a bit of a science, or it's a bit of an art, to be honest.
Yep.
Not a science, and that takes quite a long time to get there. But you know, and then if you do that bit right, the performance bit sometimes just takes care of itself, and you don't get into that spiral. And letting go, by the way, the spiral, it can come from success as well.
Mm-hmm.
That's where you become complacent. You know, you become arrogant. You lose your humility. So the letting go is also letting go of winning periods as well, regrounding yourself. You know, that's why we use the example of great sports people. You know, Michael Jordan is, you know, Novak Djokovic, they're two of the greatest people at that. That's how they sustained themselves. That's how they kept winning, because they could deal with winning as well as they could deal with losing.
Excellent. Yeah, I 100% agree. And Stephen, this has been really fantastic. Just one last question for you. Do you have any kind of advice? Could be trading wise, could be life wise, for everybody watching this, to kind of wrap everything up today?
Big question.
It is a big question.
Yeah, listen, you've got to get the foundation right.
Mhm.
Okay, it's about you. You know, it's you know, identify as a trader. What do great traders do? Make yourself like that. It's not about what you do. It's not about the system. It's not about the market. You know, your process that you get to, eventually, you know, that should deliver. It's about you. You know, if you can't handle a losing period, and losing periods are going to happen, everyone has it. If you think, oh, this is going horribly wrong, I'm not going to put a trade on, and the next trade would have been a winner. If your system says you've got to put a trade on, you've got to put a trade on. If you get a foundation right, if you get your being right, you're more likely to adhere to that process. That it makes money over time. Read the great books. Okay. My number one book is Fooled by Randomness. I tell every single person, everyone I work with, if you haven't read it, go out and read it. Read it. If you've read it, go and read it again. Okay. I'm not going to pretend it's an easy read. It's not. You know, if you've read it, it's not the easiest read, and you know, and Taleb can sometimes wind you up, but it's just an extraordinary book. Another great book, by the way, is Annie Duke, Thinking in Bets. You know, between those two, go out and read them, as well as, of course, Mastering the Mental Game of Trading.
There you go. Well, Stephen, thanks again for being a part of this. I really enjoyed this. To everybody watching, I hope you did as well. Leave a like down below. Thanks, Stephen, in the chat. And we'll be right back with the next presenter. So stay tuned. Okay, we did it. Welcome everybody to the end of day 2 of the TraderLion annual conference. It's amazing that we're already kind of halfway through at this point. But don't be too disappointed, because next weekend is going to be something special. We've got a fantastic lineup both on Saturday and Sunday that you do not want to miss. Here's a quick sampling of the speakers. Again, it's impossible to fit everybody on one slide. Stan, Linda, Mark Ritchie, Amit Rai, just a small sample. They're going to really, blow our minds, I believe. So make sure you guys stay tuned for that. I will be sharing the links to that, later on this week, and, through your email as well. So we've got a fantastic lineup next week, and there'll be more details to follow on these specific lineups for both days. Again, just a quick reminder, if you're wondering how to download the slides, go ahead and sign up for the free VIP using the QR code right here, and then go over to the conference resource, and every slide that's been presented should be over in that module for that speaker. Also, signing up for this not only gives you access to the slides, but it gives you access to special giveaways, such as for signed books from Mark Minervini, as well as other free bonus resources such as model books, classes, as well as the ultimate training guide. So make sure you guys do this 100% free, and you get a ton for it. So definitely go ahead and take the time to scan that QR code and go ahead and sign up. Also, this is the second day now. If you've watched at least one presentation, please go ahead and donate at least $1 over to St. Jude's, which is located right down below. You can click that donate button, and it just takes a few seconds. If you find value in this conference, if you've enjoyed it, got at least one golden nugget from one of the presenters, please go ahead and give back, pay it forward. $1 is great, $5, $10, that's fantastic. We had many people donate 20, 50 yesterday. That's amazing. And let's try to blow yesterday's numbers out of the water. And there's a fantastic cause that I think everybody can get behind. So with that, thanks so much for coming, and we'll see you guys next weekend. Take care.